Good morning, dear colleagues. Welcome to the first day, full day of Econ of Payments. Yesterday we had the overlap day with advances in financial technology and started with our conference. And it is my pleasure today to announce Petia Niederländer. Petia is Director of Payments, Risk Monitoring and Financial Literacy. So she's like responsible for a very big portfolio, but what keeps her most busy at the moment, I believe, is that she is the OeNB's representative in the high-level task force on the digital euro. So the digital euro agenda is very much in her hands. And I should also take the opportunity to thank Petia that she supported us very much in bringing this event about, both in raising the budget and in all kinds of things. So we're very grateful for that. And we're very happy that you're going to address us now, Petia. And before Petia starts, let me remind you that we have a very long day today with a tight schedule. And it is very important that all speakers, discussants, and chairs help us to keep this tight schedule, because if we don't stick to that, we will not be able to arrive in time to our dinner, which is taking place tonight. So I wish you a very nice day and ask Petia to take the floor. Please, Petia.
Thank you very much. Thank you. It's also for me great pleasure and honor to welcome you here today in Vienna for the first day of the Economics of Payments conference. Ladies and gentlemen, distinguished guests, distinguished speakers, I will start speaking about payments in general and hope to persuade you why new innovations here also on the central bank side, like a digital euro or central bank digital currencies, are important evolution of what we are doing. So for decades, payments have not been at the forefront of economic discussion, often seen as a mere technical mean, like for example as a back-end transaction or a payments leg of a financial markets transaction, as a pure back-end process for corporate treasurers or government, or just a commodity in the vast world of financial services. Economists, decision makers, and policymakers alike have often underestimated the vital role that payments can play in shaping economic systems. However, now we stand at a pivotal moment. Why is that? Because through the advancement of technology, and particularly algorithms, artificial intelligence, and alike, we have brought value of payments. They brought us both for economic theory and business practice important value, and one scattered across fragmented regional standards, which have been difficult to evaluate and even ambiguous to interpret. The payments now become a rich source of data that enables us to capture and study customer choices, market dynamics, and evolving economic behaviors in an unprecedented way. Payments are not anymore just transactional. They have evolved in a critical factor for competition as well. Companies that process the necessary scale or have technological capabilities can harness network effects and extract value from payments data, build robust business models upon that foundation. That firms are able to innovate and offer increasingly personalized services, gaining competitive advantage, and in unimaginable way explore new forefronts of economic activity, what was not possible before. And here, new evolutionary services like digital euro come to play. Institutions that collect and assess payments data in structured way are also able to identify early shifts in economical behavior and develop more granular qualitative policy responses to simply serve society and decision makers with better and transparent indicators about economic activities. But we must anticipate a challenge, and this is that the majority of companies lack size or capabilities to compete on this level. As a result, they find themselves vulnerable in environment like that, which is rapidly shifting towards data-driven competition. As payments become increasingly digital, they also bring new risk. The surge in fraud and financial scams, often driven by the misuse of personal data, highlights how fragile trust can be when payments data is poorly managed. While additional fraud checks and AML CFT rules are meant to address that issues, they sometimes worsen the problem by creating a sense of heightened surveillance and insecurity rather than delivering the true solutions. Yesterday, thanks to the overlapping day, I've learned that AML and CFT measures are among the least efficient regulations. Banks reportedly spend €100 to prevent just €1 of illicit activities or funds. This inefficiency underscores a fundamental issue. Trust is the cornerstone of our financial system, yet our current approach seems to fail to address it. And questions which we face is what is the right balance of efficiency fraud here, where we should aim for. One thing is certain, ignorance is not an option. So for that reason, institutions like the Eurosystem, ECB, and central banks start working and exploring digital currencies and digital euro in particular as a mean of new payment, new mean of transaction, which at the one side fulfills the needs of the civil society and brings payment anywhere at any time where it's necessary, and on the other side also provides a new benchmark for data protection or privacy-driven digital mean of payment. But one is certain, we must find a way to build trust while ensuring that regulatory frameworks and security measures are both effective and efficient. And that's is not done just by starting the design of CBDCs like digital euro. Here, the academia and institutions play an essential role. Through research, open debate, and collaboration, academia and policymakers are uniquely positioned to challenge assumptions, provide rigorous analysis, and help society understand the economic forces at play. We need to ground these discussions in shared facts, figures, guided by mutual respect and commitment to the public good, although I'm sure that you will have a controversial discussions today and tomorrow. As the American economist Peter Drucker once said, the best way to predict the future is to create it. So I look forward to hear how our panelists today envision shaping the future of payments and of the digital euro, and I'm confident that we have a fascinating and insightful discussions ahead of us. Let's begin this journey together. Very warm welcome again, and I wish you an exciting debate. Thank you. I guess I have to give to you, right?
I'm Anne-Marie McKiernan from the Central Bank of Ireland. Thanks, Petia, for the invitation to the conference, and welcome to the second day. So this morning in this session, we will have two papers and two discussants. First one is on payments, reserves and financial fragility by Ming from the University College London. And the discussant will be Paul Pichler, I hope I pronounced that properly, from the University of Vienna. So we'll have 20 minutes for the paper presentation, if that's okay, then 13 minutes for the response, and that gives us 7 minutes for questions and answers. So over to you. Thank you.
All right, so first, thank you for including the paper into the program. So my topic today is payment reserves and financial fragility. And this is joint work with E. Tigerstein and Yao Zhen from Wharton. All right, so this is something about the 4,000 years of history of like payment and money, like from like shells to gold to fiat money and to maybe the next generation payment systems. And why people like accept money as payment? Okay, so the common explanation is that people believe, okay, so it has a value and it helps store value, and then people are more willing to accept them as payments. And this just speaks to the two fundamental roles of payments or money. Okay, so that is store of value and also medium for exchange. And they are typically complementary to each other in the long run. Okay. But this is not what our paper is about today. So in our paper, actually, we observe, okay, so many episodes in history and even in like modern times that, okay, so when people do not make payments using money, okay, even though there's no doubt about the value of money. So it is not about like whether people are willing to accept it. People are always willing to accept them, but it is about like whether people are going to use them. So for example, so here, okay, so the so-called big problem for small change. Okay, so what's that? So that refers to the phenomenon that the small face value coins, okay, so historically, okay, so just gradually disappear from circulation. So people just stop using them as payments. So for example here, the farthing, okay, so this is just some small coin in UK, and the value equivalent to is equivalent to like maybe $6 today. So people know it has a value, but people just do not use it gradually. Okay, and we want to understand why. Okay, so why it disappears from circulation. And also, like the Höchstadt crisis is another example. So Höchstadt Bank is a mid-sized bank in Germany, and in 1970s, it failed to make some payments to some large US banks. And the amount was not so huge, but it just, but after that, so the large global banks and also US banks just are very reluctant in paying each other. So actually there was a wave of delay and interruptions of payments between those banks for almost 6 months. And actually this leads to the creation of the Basel Committee, which plays a huge role in nowadays like bank regulation. Okay. And also, like, so then we want to understand, okay, so why such kind of a small shock can, in some sense, disrupt the payment system, like, for example, cross-bank payment system. And also, even just in normal times, not in crises, so we know that nowadays the US banks, the large banks, are reluctant to make payments to each other. Okay, so typically they wait until others make like incoming payments to them, and then they make payment to other banks, make outgoing payments to other banks. And this delay and this kind of like history dependence in cross-bank payments actually is understood as kind of like the driving force behind the September 2019 repo crisis. Okay, so where the banks were reluctant to make payments to each other. Okay, so although the banks knew that okay, so the payments or the money they are using are actually valuable. So it is not about whether they accept it. It is about like whether they want to use it to make payments. Okay. So here, so in the paper today, we want to highlight a conflict, okay, between the payment functions and non-payment functions of money. And the assumption is that the payment always ultimately involves the transfer of some reserves as a medium of exchange. Okay? And this reserve, at least in the shorter run, is limited. Okay, so it's scarce. But it also has some other function, okay, so multifunctional. So they are useful for other non-payment functions. For example, it has intrinsic value, okay, so it can store of value, okay, or it earns you interest, okay, so those like other non-payment functions. And we highlight the conflict between these two, okay, so, and here in particular, we observe that, so the transactional gains will be generated if the banks successfully transfer the reserve good, okay, the when you move it. But if the others just hold the reserves and do not make the reciprocal payments, so then you suffer from an opportunity cost. Okay, so that's the cost, and that conflict will be referred to. Okay? And we want to highlight that, so this conflict seems very simple, but it generates the fragility. Okay, so both across different equilibriums, and also even within one equilibrium, we are going to see some fragility of the payment system. So later I'm going to show you using a very simple example, a simple model. Okay, so here, the model setup. Okay, so we have a dynamic model, infinite horizon. Okay, so t from 0, 1, 2 to infinity. And we have two agents. You can think of them as like banks. Okay, suppose they have discount rate delta. And alternatively, we can think of like delta is not discount rate, but 1 minus delta is the probability that some bad aggregate state happens. Okay, so game over. And then in that case, the reserves become very precious. Okay? So that's just some alternative interpretation. And in the baseline model, so we just consider a single unit of indivisible reserve. Okay? So in the paper, actually, we consider extensions with divisible reserves or like multiple agents. Okay, so but here, just to make it simple, we only have 2 agents. Okay, so you can think of them as like 2 banks. We have only 1 single unit of indivisible reserve. Okay, in the baseline model. So this reserve, other than like used as payment, okay, so this reserve also holds value from non-payment functions, depending on its nature. Okay, so at this abstract level, so it can be like intrinsic value or stored value, whatever. Okay, later I'm going to give you some examples. And this just reflects various opportunity cost of using the reserve as means of payment. If you use it, you cannot enjoy the intrinsic value or stored value. Okay, so that is the conflict. Of course, there must be some rewards for making the payment. Okay, so when you successfully making the payment, transfer the rewards goods. Okay, so you are going to basically you can use reserve as a medium of exchange, and it will create some gains to you. For example, if you are a bank and your clients ask you to make a payment, and you successfully make a payment timely, and then you are going to receive some like rewards in terms of like good reputation. Okay, good service. Okay. Okay, so now I'm going to use a cartoon animation to illustrate the timing of the game. Okay. So here we have 2 banks, okay, and now it's time 0. So this bank has some reserve. Okay, so for example, it could be central bank reserve, or in the ancient old days, could be gold, whatever precious metal. So now, with probability lambda, so this bank receives a payment shock. Okay, so that could be, for example, the client or the customer of the bank, okay, so ask the bank to make a transfer to some account in the other bank, okay, with probability lambda. And the bank can decide whether to make the transfer, so that means A equal to 1, or do not make the transfer. Of course, you may wonder, so in practice, okay, so no bank will announce we are not going to do this service for you, but there are many. But they can delay it, okay, or they can, or at least they are not going to. So at least this delay is not, or their intention is not publicly observable. Okay, so basically they can delay it until, for example, next day. Okay, so if this demand arises again, so then they send it. So that means delay. Okay. So then if they do not make this payment, make this transfer. Okay, so then we move to the next period. So t equal to 1. Okay, so again, so there will be some payment shock. So it could be from the customer again saying that, okay, so I still want to make the transfer. Okay. Or if the bank decides to make the payment, okay, to make the transfer of the reserve, okay, so then A equal to 1. And then there will be some technological shock. That means the transfer will be successful with probability mu. Okay, so this captures the technology of this payment system. Okay, so the higher the mu is, the better technology it is. Okay, and after the successful transfer, so the bank will receive some rewards. We call it Z. Okay, so these rewards, for example, could be the good reputation, accumulation of the good reputation. Okay, so from successfully make the transfer. Okay, and then now this bank loses the reserve, at least in this period. Okay, so it suffers from some opportunity cost. So you can think of like if this reserve refers to central bank reserves, so then it suffers from some interest or whatever. Okay. So then, next period, this bank, who is holding the reserve, also may receive a payment shock, again, for example, from this bank's client. And then this bank also needs to decide, okay, so whether to transfer it or not. And again, if it decides to transfer, A equal to 1, so then, again, subject to some technological shock, so mu, which is the probability of a successful transfer, conditional on that this bank decides to transfer. Okay, so then this reserve is transferred to the other side, meaning that this bank now makes payments. Okay, and of course, after successful transfer, So this bank enjoys some reward, again, Z. And of course, now this bank loses the reserve, at least for this period. Okay, so there will be some cost, C. Okay. And then t equal to 2, next period, again, the customer of this bank may initiate a request to transfer or to make payments. Okay. So that is kind of like the model, very simple, only 2 agents and only 2 banks. Okay, so and indivisible unit of reserve. And this is a baseline model, so we do not consider endogenous production. Okay, so for example, how much rewards to generate whatever. Okay, so we consider it in some in the extension of the model. And also we haven't considered the money supply in different forms, so endogenous emergence of money, so that's kind of a fundamental philosophical question, and also like credit markets. Okay, so these are not considered in the baseline model. But we highlight, again, the frictions. Okay, so we highlight the payment function of a given money form, okay, and especially in the fixed supply in the shorter run. And then we highlight the conflicts between the payment and non-payment functions. And later we are going to use a model to generate some equilibrium to show that even within equilibrium, okay, so you are going to see like the sharp disruption in payment system. Okay, so here I just provide like 2 examples to give you some sense, okay, so how to map the model setup to some applications. So for example, you can think of like nowadays, okay, so the application is the real-time gross settlement, okay, so the interbank payment system, okay. So in this case, the reserve refers to the central bank reserves. And of course, in the shorter run, it has limited supply. And what is the opportunity cost when you do not own it? Okay, so when you do not hold it. So again, store value. Okay, so because from like the interest income, it also helps you to meet the regulatory requirements and also avoid discount window and daylight overdraft. All of these are costly, so that's the benefit from holding this reserve. And what is the reward? Okay, so fees. Okay, so if you successfully make transfer, you are going to earn some fees from your clients, or you are going to earn some good reputation, whatever. Okay. And also, you can think of this model in the context of like cross-border bank payments. Okay, so between different countries. Okay, so for example, in this case, the reserve can be considered as the US dollars. Okay, so of course, for a given bank, it has limited supply in the short run. And in this case, what is the opportunity cost of not having it? Okay, so then the foreign transaction risk, okay, so, and also it helps you to store the value and a lot of different values, okay, so it is valuable to hold US dollars, okay. And what is the reward? Of course, you are going to charge your clients fees, okay, so in local currency, okay. So for example, consider the cross-border transaction payments, okay, so between like Canada and Japan, okay, so then you are going to receive the fees, the rewards in the local currency in Japanese yen or Canadian dollars, okay. Okay, so now, given that I only have like 8 minutes, so let me just briefly show you the equilibrium concept and some typical types of equilibrium. So here, because we are considering a fully dynamic system, okay, so infinite horizon, so we adopt the concept of perfect public equilibrium. Okay, so basically it just refers to the equilibrium involving strategies based on all the public histories. So it can be a very large class of strategies. Okay, and such PPE, okay, so perfect public equilibrium, can be history dependent if the strategies depend on the public history. Okay, so in this case, what is the public history? So that is whether last period I received the payment or not, or whether 3 periods ago he makes a payment to me, or whether I make a payment to the other side. Okay, so that is the public history. If the strategy in the PPE does not depend on the history, okay, so then it is called history independent. Okay. So first, let me just give you some. Okay, so you can ignore the formulas here. Okay, so first, let me just give you 2 like history independent equilibrium. Okay, so these are very simple. So the one extreme is the good equilibrium, in which the reserve holding bank always makes the payment to the other side, regardless of the public history. Okay, so this equilibrium hold if Z, okay, so over kappa. So recall that Z is the reward from the successful transaction, and kappa is the present value of the opportunity cost. So basically, that captures the conflicts of these two functions. So when Z over kappa is large enough, okay, so then you can support this equilibrium. Okay, so that is intuitive. Okay, so basically the rewards from transaction is much more than the loss from losing this reserve. Okay, and it will be more likely to hold. So this equilibrium will be more likely to hold when the conflict is low. Okay, so when kappa is low or Z is high. Okay, and this in some sense provides a complementary explanation to explain why we have non-interest bearing checking deposit. Okay, so the conventional view is that so because of the market power of these banks, they don't want to pay interest on your checking account. And here actually alternatively our model can interpret this phenomenon as that because checking account, so that is by design to make payments to each other. Okay, so to facilitate this function, the payment function, okay, so you want to minimize the opportunity cost. Okay, so then in this case, interest earned on your checking account, so that is kind of an opportunity cost, so you want to minimize it to make it very smooth. Okay, and another extreme is the bad equilibrium. Okay, so in this equilibrium, again, the bank's strategy does not depend on the history, but it does not depend on the history in a bad way, in the sense that regardless of the history, as a reserve holding bank, I will never make the transaction, make the payment to the other side. Okay, so essentially the whole system just died. Okay, so it is frozen, and this equilibrium can hold. Okay, so when Z over kappa is smaller than 1, and essentially, basically, when the conflict or the opportunity cost is so high, or the rewards is so low. Okay? And it is more likely to hold when the conflict is higher compared to the transactional needs. Okay, so smaller Z over kappa. And this helps us understand the big problem for small change, as I mentioned at the beginning. Okay, so recall that for the small face value coins, so nowadays, as I mentioned, so for farthing, actually, it is equivalent to $6 nowadays, so it is valuable. So that is the intrinsic value. Okay, so that is the opportunity cost from losing it. But the face value is so small. Okay, so that corresponds to the rewards or the transactional value in terms of payments. Okay, so then Z is small, kappa is large, so then it disappears. It does not exist. Okay. And then clearly, there is a range of the parameters. Okay, so within this range, we have multiple equilibrium. Okay, so the good equilibrium, the bad equilibrium. And the traditional view is that, so we have the very fragile payment system because, because there's some sunspot such that you switch from the bad to the good. Okay, so our model can generate this feature, but this is not the end of the story. Actually, we can also generate history-dependent equilibrium such that without switching between different equilibrium, even within one equilibrium, you can see the disruption of the payment system. Okay, so then, let me just describe this type of equilibrium. Okay, so the simplest type of this kind of equilibrium is that, so you consider some Grimm trigger equilibrium, in the sense that if I do not observe payment last period from you, I'm going to stop paying you. Or you can think of more generally, if we haven't seen, if there are n periods of non-payment, so then we are going to stop paying you. Okay, so n can be any number. Okay, so those are history dependent, and you can see all of these type of equilibrium such that at the beginning, so the payment system functional well. Okay, so you pay me, I pay you, but because for some unknown reason, so there is no payment, and then gradually we just do not pay each other. Okay, and as a theoretical result, we can also describe the whole set of PPE, public perfect equilibrium. There are infinite many equilibrium. Okay, so and this equilibrium actually are characterized by some triangles. Okay, so in the plane of like the two continuation values of the players. Okay, so we can describe all of these history-dependent equilibrium, and those points just correspond to the good equilibrium and a bad equilibrium, and this has some other meaning. Okay. All right, and we conducted some like comparative statics, and it's showing that even when you have perfect technology, so mu go to 1, okay, so you cannot eliminate this type of fragility. Okay, so that is some intrinsic fragility stems from the conflicts between the payment and non-payment functions of the payment system. Okay, so to summarize, okay, so we highlight these conflicts between reserves payment and non-payment functions, and we show that this leads to the intrinsic fragility of the system. And we can explain various historical and modern patterns of payment fragility. And it is worth asking, okay, so which payment system will survive in the future? Okay, so maybe not only those systems maintain stable values, but also it should minimize the opportunity cost of payments. Okay. Oh, some extensions. Okay. All right.
Thanks very much, Ming. Do you want to take a seat there? And now we invite Paul Pichler to discuss. Thank you.
So you give me timing signals, or should I? Okay, yeah. Thank you very much for inviting me to discuss this really nice paper. For the sake of time, let me maybe jump right into the middle, but start with a brief announcement of what you can expect in my discussion. So first, in the first part, I will try to highlight the contributions of this paper, and I want to highlight also the intuition behind the results. And then, in the very end, I will kind of pretend I didn't buy your story, and will present two critical remarks, I would argue. But in full disclosure, I did like your paper very much, so I'm trying to hide this a little bit. So what does this paper do? Well, I think it has 4 important contributions. So the first one is it provides a dynamic theory of payments, and in particular of payment fragility. And to this end, it creates a really simple model, a simple model economy where there's a conflict between the payment and non-payment functions of some reserve good. And this reserve goods is the medium of exchange in this economy. And the authors show that in this very simple model, there exists among the class of PPEs, public information equilibria, that you presented 3 different types: a good one, a bad one, and something in between, which is essentially a history-dependent payment equilibrium. And what the authors show is that what matters most in this economy, whether there is fragility or not in the payment system, is the scarcity of this reserve good. And the payment technology does not matter that much. It's also not completely unimportant, but it's really the scarcity. Now, this is the first contribution, so this development of this very simple theory. The second contribution, I would argue, is that the authors do a really nice job in mapping this very, very simple model to realistic payment contexts. So this is a part of the paper that I really liked. And they are also convincing in coming up with robustness exercises. So the model is extremely simple, and they extend the model then along several dimensions to convince us that it's not only because it's so simple that they arrive at these results. And the fourth contribution, which to me as also a monetary theorist was quite impressive, was that everything is analytically tractable. So even though the model is so simple, you can find proofs that take, I don't know, many pages, because the existence of this equilibrium and so can be shown analytically. Okay, so let me briefly walk you through the model, because I think it's really nice and simple. So it's discrete time, it's infinite horizon, and it's basically, for me, it's like a ping pong game. Yeah? So there's the reserve good that is moved back and forth between these 2 agents. Both are risk neutral. I'll stick to the interpretation that there is a time discount factor delta. And there are these 2 goods. One is the reserve good that is used for payments. The other one are the rewards, where you can think of, as you mentioned, some fees in interbank markets, or maybe let's put it also in a different context. It could be the utility you enjoy as a consumer, the excess utility when you purchase something. So what's important is that these rewards cannot be transformed into reserves, yeah? Which may not be that true for the example of the interbank market. Yeah? In the aggregate, it's true, but on an individual level, it's not true. As an individual bank, I can try to basically move some deposits I have with another bank into reserves by purchasing, for example, additional reserves. There's a payment shock that was already explained. There's a technology shock. And on top of these rewards that I get with every transaction, there's a cost that you have to pay if you do not hold the reserve in the end of a given period. Okay, so this is the timeline of events. And for this very simple model, the authors characterized the perfect public equilibria. So this is an equilibrium concept where strategies may depend on the public history of past outcomes. And let me stress here that it's truly only the public information that matters. It's not private information that the agents may have. This is, I think, an important part, and I will come back to this later. Now, there's the good equilibrium, the bad equilibrium, and then there's this history-dependent equilibrium that the authors characterize. And the authors show that in the parameter space, they have coexistence of these equilibria. Let me maybe try to give you some interpretation or intuition. What matters to the agents is essentially the question, when I pay, will I ever get back the reserve? Because if I won't ever get back the reserve, I'm going to pay the cost C from now on until the entire future. And this creates this cost kappa that is mentioned here, which is basically the present value of these costs if I do never get back the reserve. And that's basically the key decision that these agents have to make. Are they willing to let it go, the reserve? Will it come back? Yes or no? And you can see, for example, I think that's good for the intuition, that the good equilibrium is the only equilibrium that exists if this ratio between the rewards and this present value of the reserve is larger than 1. And that's kind of logic, no? So if the reward that you get by making one payment is larger than the cost, if you never get back the reserve, then it pays off to make this payment independent of what the other guys do. This is why this is the only equilibrium that you have in this area. If this Z over kappa is smaller than 1, yeah, you could also have the bad equilibrium. Yeah? So if I believe the other never pays back, I'm not going to give him the reserve because the cost of doing so is larger than the reward that I get. And of course, this is true for all of these Z over kappas being smaller than 1. And what the authors show is that these history-dependent equilibria, grim trigger equilibria, exist for some area where this Z over kappa is smaller than 1, but it has to be sufficiently large. The intuition being basically that this is the situation where it pays off to basically let the reserve go because there's a positive expectation that you will receive it back some time in the future. Okay? So I think this is the intuition for this coexistence of these 3 different types of equilibria. And this equilibrium multiplicity is connected then to fragility. Okay, so you see that when the reserve good is scarce, which means it has a high present value, basically, so the kappa is large, then you're in a region where payments may be history dependent and where there is this equilibrium multiplicity, and both are sources, potential sources of fragility in this model. And what the authors show is that this is completely independent of the payment technology and also of the transaction needs. Even if those are certain, you still have basically different types of equilibria. Now, one policy implication that is in the paper, you didn't mention now, is I think quite an interesting one these days in particular, because for this stability of the payment system, it's good, according to the model, to make the reserve really abundant. And of course, this feature contributes to the current debate we have about scarce reserve system versus abundant systems. So for the payment, from the payment perspective, the abundant system is better. And then another contribution, as I indicated, is the mapping to realistic payment contexts. I think the authors do a really nice job here, because even though you have this very simple model with this very complex type of equilibria, I would argue, in particular if you want to walk through the proofs, the authors can convince readers quite well that this is relevant. This has some bite in some true payment contexts, and in particular they focus on mapping the model and mapping the equilibrium outcomes or the equilibrium implications to real-world applications. So they explain how the reserves can be interpreted as either gold or central bank reserves, CBDC, stable coins. So you see there are many potential applications. And they also provide historical evidence for equilibrium outcomes. Yeah, so we've seen a few of them basically also in the presentation. So the good payment equilibrium would argue in favor of zero interest rates on deposits and also on CBDC, because you want to make it unattractive to basically to stick to the reserve. You want to use it for payments, therefore it shouldn't pay off to keep them. The bad equilibrium was referred to as the big problem of small change, where basically the value, the intrinsic value of the reserve is so high that you never want to let it go. Yeah, you rather keep the coin because the coin is more precious than its nominal value, so to speak. So you don't want to use it for payments. As examples for the coexistence of equilibria, they present the repo crisis in 2019, the German interbank crisis, and the Herstatt bank crisis serves as an example for the history dependence. And now, this was the part where I tried to give credit to what I really like about the paper. And my last slide are these remarks where I try to be critical. Now, my main criticism of this paper would be that while you spend a lot of time to map the model to the empirics and to map the equilibrium outcomes to the empirics, you spend almost no time in mapping the equilibrium itself, the strategies, to the empirics. How reasonable is it to assume that agents like banks really play these types of strategies? Because, as I said already in the beginning, they do not depend on private information. And I'm giving you an extreme example here. What happens in this model is that if there are these two reserve holding agents, and one of them is holding the reserve, and then there's the situation that there is no payment shock. So the agent knows, okay, I don't want to transfer the reserve because there's no need to do it. No payment was requested. And the agent knows this, that this is the reason why there was no transfer of reserves. Then even in this case, this same agent will stop making payments forever. And this is something that I think is very hard to buy, that actual banks or other agents truly play these types of strategies. And finally, the last remark, throughout the model, also for analytical tractability, you need symmetry. I buy symmetry for the case of interbank markets, but in most payment applications, and you also refer to many other payment applications, I think the symmetry is lost because there's hardly any economic relationship where it's true that one person pays the other and the next day the other person pays the one person. No, we have customers in shops. We have employees-employer relationships, where typically the payment only goes in one direction. So here, I think you could also try to improve a little bit why you think the symmetry assumption is warranted in your application. Thank you very much. And
Great. Great. Thank you, Paul, and thank you, Ming. Okay, so we have 6 minutes for questions. Yeah, over here at the back, and then a couple of rows in front. Yeah, there, thank you. Yes, then first, and then to the gentleman 3 rows behind. Thanks.
Oh, sorry, it's me. So Jean-Charles Rocher, Toulouse. So thank you very much, Ming, for this very nice model and very rich implications. I have 2 comments. One is that the repo crisis occurred at a moment where bank reserves were abundant, right? And I believe that one element that could enrich your model is including liquidity requirements, regulation. I believe the reason why the repo crisis was important is because banks were concerned about the liquidity coverage ratios. And it's also a way in which you could introduce public intervention in your model. And the second comment is also on public intervention. I believe that central banks typically, when there is a crisis, they allow banks they lend to banks, or they allow banks to have overdrafts. And the Fed is very good at creating new facilities for lending to all kinds of banks. So would it be, what would it change in your model if you allow the central bank to lend to the banks?
Yes, do you want to respond? And then we'll take the other question.
Okay, so thank you for these very good suggestions and comments. So yes, so first I think if you allow the central bank to intervene, so basically in the model just means, okay, so now the reserve is not that scarce. So that just means C or kappa, so the opportunity cost of losing it is not so high. And then that just moves to the right-hand side of that graph. Of course, that stabilizes the payment system. But on the other hand, okay, so there might be some like consequences which is just beyond the scope of the model. For example, the central bank also care about like inflation or the price stability, whatever, not just the payment system. So that is something outside the current model, but you can think of that as kind of a constraint. Why they cannot that easily to intervene or to increase the supply of the reserve. So that just contributes to the value of this kappa. And your first question is about regulation. Yeah, I agree. So actually, I think the motivation of your question is about the repo crisis in 2019. Yeah, I agree. So in that case, at that moment, I think it is about the reserve is abundant. But on the other hand, the liquidity requirement actually increases. So that also contributes to the scarcity in some sense because the requirement is more stringent. Yeah, thank you.
Thank you.
Okay, so my name is Adam Głogowski. I'm from the Central Bank of Poland. So I would like to I would say even strengthen the remarks of the reviewer regarding the realism of the model, especially for the interbank payments, because I think there would be a lot of value in distinguishing 2 types of payments made between banks, which have very different properties. One is payments on behalf of clients. If you don't make a payment on behalf of your client, you're stuffed. So the cost is really high. But on the other hand, you have the payments between banks made as banks lend to each other. And that's a different transaction. And so I would argue that many of the freezes that we have seen in the interbank market have been due to the increase, at least as perceived by the banks, of credit risk in lending in the interbank market. So I think that would add a lot of nuance if we would like to apply this model to explaining actual episodes of stress in the interbank market. Thank you.
Yeah. So thank you for the very nice comments. So for the first one, I think it is good to figure out. So there are 2 types of like payments. For the first one, the first type of payments, so you make payments on behalf of your client. Yes, it is very costly for the bank to just reject it or do not make it. But here in the model, actually, as I mentioned, maybe, so it is not just do not make the payment. You can delay it for 1 period. So, okay, so for example, you delayed, but there's some technical reason, that is just your excuse, but that is just some technical reason that could be the excuse. And then you make the maybe next period, okay, so when the request just arrives again, okay, so that is delayed. So that not completely just say you do not make payment. At least you cannot publicly say, I'm not going to make payment. Otherwise, you are just out of the market, right? So I agree. And for the second one, so interbank credit or interbank lending, so I think that is just another form in the sense of the application, in the sense that, yes, you make the payment, you lend to the other bank, and then that changes, for example, the central your account, the reserve in the central bank account, and then, of course, you lose this reserve at least shortly, and that is costly if you think that is costly, so then I think the model still applies, right?
Thank you. James?
Thank you. James McAndrews, Wharton Financial Institution Center. Thanks. Very interesting model, and I really appreciate it. I wonder about the timing assumptions in the model and your discussion of interest on reserves. In a lot of the models, you know, the time is separated into days so that payments occur during a day, and then there's a settlement in the evening, then another day occurs, and so on. And you have this ping pong back and forth with no, you know, it doesn't, I don't know what corresponds to a day or not, and so on. And also the absolute sequentiality of first one person has the payment shock and then the second, as opposed to a simultaneous thing. So I don't know if interest on reserves really is an example of a cost C. And the reason is your results are much like the Friedman rule, where you like to have payments to be zero cost for people. And interest on reserves is a way to achieve the Friedman rule in a world with positive inflation. So you can just talk about the timing assumptions. Thank you.
Okay, thank you. So I think I've received like similar comments or suggestions from my previous discussant, who is sitting there, who will be the next presenter, okay, Thomas. So also about like the timing. So yes, so first I agree. So this model is kind of like very kind of like a toy model, and just to highlight the fragility in this type of environment. So we are not very, at least without talking about the specific applications at the model level, we do not say, okay, so whether it is 1 day or 1 minute or one hour, whatever. So I agree. But in practice, okay, it really depends on the interpretation or the application. For example, like, okay, so if you are considering like, okay, so 1 day, okay, so the whole period is just the whole like, T period is just 1 day. So then you can think of like 1 period just corresponds to maybe 1 hour or maybe 10 minutes, whatever. So in that case, we can still interpret it saying that, okay, so at the end of the day, we know there will be settlement. At that moment, we are going to lose our reserve if I make a payment before that. Okay, so then in that case, making the payment just means I just give the central bank the information that I'm going to make a payment to you. It hasn't been settled. But I know that at the end of the day, okay, so it will be settled and I will lose it. And then that's related to your second question. So what is really the cost, the opportunity cost? So then in this case, yes, it may not be just the fees or the interest. It could be the case that, okay, so there might be some crises, okay, so for example, who knows, okay, so like the Hirschstadt crisis, people didn't anticipate it. There could be a crisis, and in that case, if I do not own my reserve, okay, so then I suffer from a big cost. And then so that big cost is a lump sum cost, and if you just flow it to each period, so that is also the opportunity cost. So that is just alternative interpretation, not just like, say, the opportunity cost is the interest. So it can be even more.
Thank you very much. Okay, so if we can wrap up this session with a big thank you to Ming and Paul Pichler. Okay. Thank you. And now to turn to our second session this morning, for which Thomas Nellen of the Swiss National Bank will start our discussion on payment fragility and queuing transparency. And James McAndrews will be the respondent.
Yeah, good morning, everybody. Very glad to be here, and I'd like to thank the organizers for the wonderful conference. This paper is going to be co-authored by Manuel Capel, because we haven't finished the paper yet. So this is very much work in progress, and data generation took us ages. So This is the very first preliminary version of the paper. And it's very much actually inspired by the previous paper, but also by papers by my co-author, by my discussant, Jamie. And actually, in addition to that, to my future board members. So I have to really be cautious about what I'm going to say here. So next to being inspired by these theoretical models, it's also inspired, of course, by the tremendous US repo market crisis, which told us or showed us substantial repo rate spikes that even exceeded 1,000 basis points, I was told. So this was really an enormous event, and we, of course, as members of financial stability and oversight, we are concerned or wondered whether this could actually happen in Switzerland too. So that's one of the reasons we engaged in this kind of work. So my understanding of the crisis, given the literature I've seen, is basically this kind of repo spikes were driven by dysfunctional interbank payments mostly. So there are people that emphasize other potential factors like liquidity regulation and other things, but these seems to have less of an effect on these kind of repo spikes that we saw. That's what I took from the literature so far. So is a payment system characterized by fragility or not, and what does define it? What does define delay and breakdown of a smooth payment system? No. That's the basic question here. And so there are two issues now that people put in the room. So one is this traditional view that there is a trade-off between additional liquidity, as I call it, and the delay cost that is there. So that's kind of the Beck and Garrett story, which is this simultaneous coordination game that's out there in the literature. So there are multiple equilibria, early and late equilibria, and the question is how to kind of design a payment system that allows for early or good equilibria. The second issue is the one that we just heard here. So I call that the trade-off between delay costs and the cost of draining liquidity. So what we heard before was essentially something about how to avoid draining liquidity, because there could be a cost to this draining liquidity. You don't want to empty your reserve account because of diverse things. No, they called it essentially the store of value, the opportunity costs of getting rid of reserves. No. So if there is this cost, what does this have for implications? So in order to capture that empirically, we look at the net debit position on the accounts of the participants of a large value payment system, a real-time gross settlement system. So the net debit position essentially tells you what's the amount of draining liquidity in your account. So we think that managing the net debit position allows you actually to address both trade-offs that we just heard about. So there is one solution to the first issue, so the cost of additional liquidity, that was actually put forward by Martin and McAndrews, so Jamie here, and Gillas and Martin in a second follow-up paper. So this is about conditional settlement. So the idea is that if you have a liquidity saving mechanism in the form of a central queuing arrangement, banks can just release payments to the central queuing arrangement without fearing to pay additional liquidity costs, because payments are pending in there as long as no other payments arrive or are settled on your account. So the settlement of your payments is actually conditional on the settlement of other banks' payments. So that avoids the additional liquidity costs. And this kind of eases the trade-off between additional liquidity costs and delay costs. So, but this solution doesn't work in a world of quantitative easing where reserves are as high as they are these days, not because if there is really a cost also of draining liquidity, then you have the problem of managing this kind of trade-off. And that's what the previous paper was about. Not. So we argue that a transparent central queuing arrangement actually allows you to better manage this trade-off. And why is that? So if you have available information on future payments that are going to arrive on your account sooner or later, not, this going to ease this trade-off between delay and the cost of draining liquidity. So that's the basic idea here. And this is how it relates to Goldstein et al. In the sense that the driving mechanism of fragility in their model is what I believe the private information of the payments. So payment shocks are private information. And if you can get rid of this aspect in the sense that you're releasing payments to the central queuing arrangement, then you can reveal part of that private information over time, and that's going to make coordination easier. And the way coordination functions is the coordination via release management that manages the net debit position into the future, actually. So to illustrate that, so we have Fedwire, not the US system, and we have the Swiss Interbank Clearing SIC system. So in one, settlement is immediate, in the sense as soon as you submit the payment is going to be settled due to the availability of overdrafts. That's not the case in SIC. There we don't have overdrafts, but intraday liquidity is granted via intraday credits. So you have to actively draw the liquidity to settle a payment. The difference here is that queuing is going to accumulate in the sense that you release a payment to the CQA and it is pending in the CQA for as long as the queuing duration takes. So that builds up the information on queues, on incoming payments to you, essentially. So what we're going to provide is evidence that the draining liquidity cost in essence is something real. So what we see is people are coordinated more to lower the net debit position. And this essentially requires a CQA because otherwise you cannot do it, and it requires a transparent CQA. And what we also see is that more queuing results in earlier release. So the more information is accumulated in the queues, the earlier other banks are going to release. So this kind of counteracts the scarcity of liquidity in the sense that it reduces fragility now. So I'm going to probably focus only on the second two hypotheses. The first three hypotheses are mainly about how the queuing system works. No? So if you have increasing net debit positions, what you see is that this goes along with increasing settlement balances. So if you engage in QE, no, what happens is the net debit positions go up. And you manage this via settlement coordination. And settlement coordination, so how the settled transactions are coordinated, aligned with each other, is depending on release coordination. So that defines how settlement coordination works out. Queues build up, of course, if there is not enough liquidity around. So queues decrease with increasing settlement balances and increasing settlement value. It's pretty mechanical in a way, no? But then the behavioral aspects of this, so how do banks react? No. So they decrease release coordination with increasing net debit positions and increasing settlement balances and decreasing queuing. And here we focus on incoming queues to a particular bank, looking at the panel regressions. So hypothesis 5 speaks to the release time. So how does release time react? Release time reacts as follows. So with decreasing net debit position and decreasing settlement balances and increasing queues, so the more information is there, the earlier banks are going to release payments. So let me quickly speak about the way we're going to arrange data. So we have 2 types of payments in the system. One type is institutionalized. That means the banks are not able to determine the settlement time or the release time of the payment. But that's done by a third-party institution. So an ancillary system, market conventions, whatever. It's about, for instance, repo transactions, transactions coming from CSDs or central counterparties. So these are direct debits entered into the system on behalf of the bank by the third party. So they are not able to determine the settlement or the release time of these transactions, but the third party does that. In contrast, non-institutionalized payments are directly entered into the system by the banks. So these are the strategic payments where you can actually change the timing. So we have both of these kind of transactions in the system, and both make up substantial volumes. Here you have a quick view on the reserves available in the system, and compared to probably most other systems, we had the biggest reserves in terms of GDP outstanding, I guess, during quite a long time. So we have started quantitative tightening back in 2023, still ongoing. So how do we measure things? So this is about release time, actually. So we measure release time in terms of a release curve and a settlement curve. You can do the same for the settlement, no? And it's simply the normalized release curve, and the release curve is accumulated released value by minute here. So if you normalize the x-axis and the y-axis, no, you can build an area under the curve indicator for release or for settlement. And you can differentiate different perspectives. No? You can do that for non-institutionalized payments, for institutionalized payments. You can do it for all payments. You can do it for outgoing payments. You can do it for incoming payments. So we want to measure queuing information, the available queuing information. And the available queuing information is simply measured as the difference between the AURC, the release curve, minus the AUSC, the settlement curve. So this builds an indicator that is value-weighted of what kind of information or how much information is available in the queues. And you can, again, do that for different perspectives, outgoing, incoming payments, and all payments. We do a similar thing in terms of measuring coordination. So how is coordination measured here? It's the release curve of outgoing payments minus the release curve of incoming payments. So how well are payments that are outgoing and incoming matched? So that's the same for settlement. How well are settled payments matched in terms of outgoing payments and incoming payments? What you see here is the net debit position. So if you look at these spikes all of these spikes essentially resemble increases in reserves. So that's when the Swiss National Bank essentially intervened very much in the FX market and built up Swiss franc reserves. So each spike is followed by a drop, and that's the way, or is one part of this drop is essentially banks trying to kind of manage the net debit position again. So that's the basic empirical setup we're in. And what we do now is we make a panel regression on most of these indicators. And what we really find is the decreasing release coordination. So more coordination comes up when net debit positions increase, when settlement balances increase, and when queuing increases. We do the same for the release timing. So the AURC goes up. That simply means that people release payments earlier. So what we see here is that earlier release is associated with decreasing net debit positions, decreasing settlement balances, and increasing queues. So if there is more information in the queues, people release payments earlier. So what we think we see here is that, or what we contribute here to the literature is about optimal RTGS payment system design in a way, not? So we think what we find is that CQA transparency reduces or can contribute to the reduction of payment fragility. So queuing information and coordinated release is both kind of trade-offs that are out there in terms of the theoretical literature. That's certainly, let me focus on one more thing. So we have always debates about what we do at the Swiss National Bank in terms of monitoring the large payment system. So people from the money market desk, they essentially say, okay, we have so much reserves out there, nothing can really happen. Not? So if you believe in this story here, if the queuing information goes down, we're back into a situation as FedWire is. So that means we're in a history-dependent situation, as described in the previous paper, and there are multiple equilibria are still possible. I mean, reserves ease this trade-off, but it's still there. And the paper, in a way, also invites to think about the design of the system in another way. So how do you nudge banks into using CQA information? We investigated some of the stuff, and in terms of, so the difference in SIG is we have like pull information. So banks need to pull the information, and we see banks pulling this information actively, but we also think that people could, or banks could pull that information more frequently. So one way to change that would be to install push information instead of pull information. Yeah, so there are different ways you can fine-tune the system if you want to. So there is very much more research possible in the way of how to design a payment system. Okay.
Thanks very much, Thomas. And now call on James McAndrews from Wharton Financial Institution Centre to be the discussant.
Thanks so much. I wanted to push this button ever since Martin demonstrated that. I want to thank the Austrian Central Bank, Martin Sommer, Helmut Stix, for organizing it, and Helmut, I'm afraid I don't remember your last name, who helped organize it, and Kim Hyun and Fumiko Hayashi for running the steering committee. It's a great conference. I feel very lucky to be here. I'm happy to discuss Thomas's paper, and the paper considers the effects of the amount of settlement balances and the net positions on queuing durations in the Swiss interbank clearing system. And Thomas posits that a transparent queue makes a coordinated release of payments more feasible. They also hypothesize that very high levels of reserves may actually increase payment fragility because that may lead to more of this history-dependent type equilibrium that may be not worse than an alternative. This is kind of paradoxical that high levels of reserves eliminate queues, and so people don't see, what future settlements they might receive, and net debit positions may actually increase. So Thomas suggests this may require additional monitoring when queues are not available. And this draws on the work of the paper we just heard. And I'd just like to point out that a quote from that paper: "The theory demonstrates that agents make payments only when reserves are abundant enough. Otherwise, history-dependent equilibria arise in which an agent's payments decision depends on the payment history of other agents within an equilibrium. The theory explains why payments frequently encounter delays and interruptions. Improving payment technologies may not reduce such fragility when reserves remain scarce and valuable for non-payment functions." So the combination of that paper and Thomas's paper, they're very thought-provoking, and I think they rightly draw attention to the nature of communication and information revelation that are part of the design of large value payment systems. The previous quote said, different designs may not resolve this fundamental trade-off that they focus on. So far, though, I remain skeptical that queue transparency is a key vector for increased payment coordination. There's a large literature on transparency in the Folk theorem and repeated games. So unlike the Goldstein paper, I think, days occur and not every period is the same, but that the payment system as we know it today occurs on a day, and then the next day you wake up and it occurs again, and so on. So it's has much the structure, I think, of a repeated game rather than this infinite sequential game. And several authors, which I point out there, show that there is the Folk theorem, which shows that cooperation is feasible as an equilibrium outcome in a repeated game, is a feature almost regardless of the information setting of the game, whether it's private information or public information or semi-private information. And I think perhaps the summation of these points was made by Aoyagi and others in 2019, and they show that cooperation is sustained under every treatment of these different information settings, but that strategies differ. And I think that's the important thing, that how the cooperation is sustained may differ in each case. So we should be attuned to the communication and information characteristics of the payment system, and it's highly likely that participants' behavior does change based on those characteristics. This is an understudied area, and so I applaud Thomas for investigating this case in the Swiss interbank payment system. Thomas suggests that coordination is highly dependent on the net debit position of a participant, and that's a very novel and interesting point, and it can be studied across payment systems. The observation that the queue duration in SIC was around 2 hours in 2005 to 2008 and 1 second in 2021 is a reflection of the, in the private value of settlement balances to participants as these settlement balances became abundant. So it's just an amazing thing that we've seen this. There's a lot of variation there between 2 hours and 1 second, and we should be able to draw some inferences from these if we make the tests sufficiently precise. Now, of course, now comes part of the presentation where I discuss my work, and but only a slight exaggeration. This is a paper from 1999 that I did with Samira Rajan, and we looked at the payment timing of payments on FedWire. And one aspect of these payments, so there's no queue, there's very little public information really on FedWire. People just see their balances, they don't see and from whom the payment came, not other people's position or anything. But at this time, back in 1999, the FedWire charged people an overdraft fee of 50 basis points, between 10 and 50 basis points, is complicated. And that was, the overdraft was measured at every calendar minute, at the end of every calendar minute. So they're about, at that time, the processing day was shorter. There are 1,087 calendar minutes in the day, and they'd measure your overdraft. Well, this shows how many payments were settled within the calendar minute. So no overdraft was ever observed. And you see it was about, $3 billion per minute at the height of the payment payment coordination, which occurred around 5 p.m. So there's just tremendous payment coordination. So this is very similar to the Beck and Garrett paper, where you have an equilibrium. You're waiting for the other person to pay. You don't want to pay. You're waiting for the other person to pay. Say, everybody, let's just pay at 5 p.m. And all the payments go out at 5 p.m. Perfect coordination, almost perfect coordination. Now, that's changed, and this draws on a paper I did in 2016, and this shows the average time of payment for the different percentiles of payments. So you can see the 10th percentile of payment in FedWire, which opens at 9:30 p.m. during this time, was settled about 11 a.m. And then when balances increased with the credit easing by the Fed in 2009, and then with QE2 and so on, payments just got faster and faster, were released by 8 a.m. in the morning, and the median payment time went from 4 p.m., let me see if I can keep this on here, down to before 2 p.m. So payment timing increased by hours on FedWire. So again, this shows that the abundance of reserves really led to quicker payment. And this was a regression coefficient on the amount of opening balances on payments timings. And you can see it was very, very strong for the central percentiles of payments, the payments 0 to about 60%. So in another paper that shows this, the paper by Garafonso, Daryl Duffy, Lorenzo Ragone, in Hyun Shin, shows that the amount of reserves in the system, and here we go from 2010 to 2022 or something, and then they look at the reaction function slope, the propensity of a person to make a payment in response to an incoming payment, and that falls with more abundant reserves from about 6 to 70% likelihood I'll match a payment with I'll send a payment based on an incoming payment to down to 20%. So that shows that this payment coordination actually gets less with more reserves. And we see this again, finally, in that same, this is another Duffy and Copeland paper. Here was the pattern of payments received on FedWire with this very strong coordination at 5 p.m., and then with high opening balances, the coordination is much less, and payments move much, much earlier in the day. And so what are we to make of this high early payments, but we lose the payment coordination? Are we really losing anything when we lose that payment coordination that occurred in the period of low payments? That's something that Thomas kind of alludes to. He doesn't make a central point. I think this is a great area of inquiry. I'm skeptical that transparent queues can lead to more coordination, but this should be tested more broadly. And the willingness of participants to endure these larger net debit positions by making payments earlier in the day, by just sending out payments, does not necessarily represent fragility in my point of view. It could occur if either payment orders to the bank arrive at different times and or banks are willing to extend net debits to their counterparties. So I don't think it's necessarily a sign of payment fragility. But we've lived through a period of very enormous changes in the payment systems, and it should give us opportunity to test some of these points of view. Thanks very much. Thomas, should we
Great, thanks very much. And now open for questions. Okay, you're first. This gentleman here, and then who's next?
Hi, thank you both for your presentations. I'm James Sanders from the Bank of England. I have two questions. The first one is that, as I understand it, the participant would observe a queue and then submit payments that are better coordinated and would not increase their net debit positions. I'm curious how these queues are formed in that case. So would there be a first mover disadvantage to put your payment forward if there is no queue? Would you be better off waiting for a queue to form and then submitting your payments? My second question is about how, so you're going to have to forgive me because I don't know exactly how the queues are then used in settlement in these systems. But in CHAPS, these queues provide a larger range of payments to be added to LSM cycles. So there's more options for the LSM to choose to offset these payments with one another. And that will improve the efficiency of the LSM and therefore reduce or improve net debit positions. So I was wondering if you had any comments on both of those observations.
So, so one thing is, I mean, every payment essentially in SIC needs to go to the CQA. And it's a one-stream payment system, so there is no multilateral or bilateral netting cycle going on, but every transaction is a real-time gross settlement transaction, in particular gross settlement, because real-time, I don't know whether we can talk about real-time, but if there is a queuing duration, not, but that's the way it works. So I'm not sure whether this answers both of your questions exactly or not, but
I think it does. I think it does, yeah. I don't think there's any disadvantage to putting your payment in the queue because, again, if it leaves the queue, that means you've received a payment that has offset the payment you put in the queue. So you get the benefit of making the payment, as was discussed in the earlier paper, the customer satisfaction or whatever, and you haven't used any liquidity. So.
if there are low reserves.
There's a question.
Right, yeah, depending on how much it offsets. But.
Thank you.
Mark Lofker from the Bundesbank. Just one question. Do you know if the settlement banks and SIG also have internal queues? Because in some other work or some discussions with market participants in Europe, we know they have internal routing system, also internal queuing systems.
Yes, so banks certainly do have that because they somehow have to manage the payment flow. No? So that's, every bank essentially has that. No?
But then, like, this is not part of your queuing in SIG, right? So
no, that's not. So what we see, what we observe is only central queuing, the central queuing arrangement. No? So if banks have their internal queues, then they decide to release a payment to the CQA. That's what we observe. The internal queue we don't observe. It's like in every other payment system too. No, it's like you just see what's getting in and not what.
But then, as an additional policy conclusion, this should be also shifted in the system, right? That other banks see also the internal queue, or what is going on in the next days?
So actually before, I think 2017, banks could actually release payments a few days before the settlement day already. So there was even more information in the queue in that sense, but I doubt whether that is really helpful in the sense that, I mean, you manage net debit positions and everything during a settlement day, you know, then what's in the queue is important on that day, but not a few days before. Maybe that's important for money market managers or people like that, but I don't think that this drastically changes things, because these payments were mostly about retail payments, so small value payments essentially.
Thanks.
Yeah, you cannot force banks to release payments in a way, you know, it has to be incentive compatible, and that's what we believe it is. No, it is incentive compatible for banks to release payments ahead, not of settlement, due to these two trade-offs, and that these two trade-offs can be eased by doing so.
Great. More questions? Okay, maybe we'll wait for some from the floor. Could I ask you a question, James? You mentioned that there's I feel like it's a fruitful area for study to look at how there are a lot of information in the communications and information issues in the payment system. So can you give us some indication of areas you think would be fruitful?
Well, one thing I'm thinking about is, for example, in the previous paper was discussing the Herstatt incident and Herstatt risk. As a result of that, CLS Bank was designed and created, and in addition, the CHIPS payment system changed its settlement system radically in 2019. So these are, you know, alternative ways to achieve coordination rather than it's changing the nature of the game altogether. In the Herstatt case, there was a situation in which foreign exchange transactions were settled in different systems. So Herstatt Bank in particular was paying Deutschmarks, you know, in the German day, and then receiving or paying dollars on foreign exchange transactions you know, about 20 hours later in a different system in a different jurisdiction in New York in the US day. And that sort of asynchronous settlement necessarily leaves open this enormous credit during that 18 hours or something that it took place. So after 40 years of thinking about it, the world came together and designed the alternative, which is the CLS Bank, where it's on a single system, it's simultaneous exchange. It's not net exchange, but it's simultaneous exchange. And that has greatly improved the risk position of all banks, greatly improved the payment system. And that's a sort of arrangement. CHIPS similarly changed its payment system from an end-of-day net settlement system to a sophisticated settlement engine that payments are put into a queue, but people all put up money at the beginning of the day, and then payments are settled versus that money, and no individual participant can rack up a net debit in excess, a net credit, excuse me, in excess of 2 times their initial pay-in. So these are all sorts of clever ways of making coordination happen, managing net debit positions, and making sure that payments still achieve the benefit that Thomas points out of releasing payments early to a queue. And CHIPS settlement time, which CHIPS essentially acts as the liquidity saving mechanism for the US dollar, their average settlement time is 4 to 6 hours earlier than FedWire because of this good incentives to make payments into the queue. So I think all these arrangements do suggest that we need to think more about how to make payments reliable and the, you know, what Thomas raises is that a transparent queue is very different from a queue where one sees only one's own position. And I just don't know. That's an interesting question. I don't know I don't know what to think about that as of yet. Yeah.
Okay, thank you. Okay. Yeah. One last question, and then we'll wrap up. Thank you.
Hi, this is Ajit from Bank of Canada. So I have a slightly different question thinking about the future when there is a possibility that AI agent could be making this decision of sending the payments to the system. So what do you guys have thoughts around that? Like what would that look like, and will there be a very different equilibrium or very different liquidity things mechanism, or something else might evolve? Thank you.
I'll let you.
What? Crucially going to depend on how you program it, no? So what's the decision rule you're going to impose, no? So, yeah. Maybe you can make it more sophisticated in terms of netting and stuff, but that's not really going to speak about the issue we were talking about, not, but yeah. So that's very difficult to answer.
I have no idea, but there are some people in this room who know more about this than I do, I'm sure. But how AI agents perform in games and what equilibria are observed with AI agents, I don't know. I mean, we know that they can beat humans at chess and Go and so on, but are those better games than... But those, of course, are zero-sum games, so it's hard to say. But, you know, it would. I just don't know what the literature says about how AI performs, let's say, in the prisoner's dilemma and so on. The original long ago experiments by, is it Rappaport, who asked people to submit agents to play prisoner's dilemma, wound up with tit for tat. But I don't know whether AI would achieve the same outcome or not.
Well, I mean, I know you were engaged in reinforcement learning. So one idea, because we are really bad game theorists, one idea was to put the game into a reinforcement learning model and see what's coming out of this. So you're invited to join this effort if you like.
Okay, I'm going to wrap up this session. Apologies for eating into some of your coffee break time, but it was such a stimulating discussion. Big thanks to Thomas Nellen and James McAndrews. Thanks.
Okay, welcome everyone back to the third session, and we would like to welcome Idana Rashidi from the IMF. Idana, please.
Thanks, Jeff. Hi, everyone. I'm very happy to be here presenting today. I've studied in Vienna, so it's always good to be back. Today, I'm presenting a paper that's focusing on payment platform competition, and more specifically, we're going to talk about public and private payment competition. This is joint work with two of my former colleagues at the Bank of Canada, who are actually both present in the audience today, Ming Liu and Francisco Rivadeneira, who have gracefully agreed and volunteered that all the tough questions will be handled by them. Okay, so why do we focus on platform competition? And more specifically, why are we focusing on public platforms? Well, as all of us in this conference by now know, in the recent years, there has been quite a lot of involvement from central banks in the area of providing public payment platforms. And by this, we specifically mean infrastructure that enables digital retail payments. And you can think of the most common examples being different fast payment systems or FPS systems being deployed by central banks all around the world, be it FIX, FedNow, UPI, etc. At the same time, there are quite a lot of explorations being done with central bank digital currencies that at the payments front resemble quite a lot the fast payment systems as well. While there's a lot of developments in this public payment platform area, their effects on the payments market is actually underexplored. There has been quite a lot of research that has tried to address the issue of how these public platforms can affect the market for retail deposits? How can they affect the competition in this area? But very little is known how they can affect the competition in the area of payments. And you can think of competition with, let's say, a Visa and a MasterCard. So in order to sort of try and fill this gap in the literature, we have been working in trying to address some of these questions that we have laid down. And first is there any difference between competition between a public payment platform or just private platforms in the market? Second, if we introduce a public platform, how would it affect the fees that the private sector charges? Could it induce them to charge lower prices? Yes or no? Could it increase welfare? And finally, we also want to address an issue that remains open for many policymakers in different jurisdictions, which is, let's say we decide to deploy a fast payment system or issue a CBDC. How should these services to consumers and merchants be priced? What is the optimal pricing structure? In order to address and to actually model these types of setups, we wanted to take into account the features that the payments market exhibit. First, we incorporate the fact that this market is two-sided, the retail payments market, meaning that there's consumers and merchants, and for any platform to be successful, you need the adoption of both. And at the same time, these markets feature network effects. So there's a codependency between merchants and consumers. The more one side uses it, the more value the other side sees in it. And also, the fact is that when we look at these markets, they appear to be competitive, but usually in most jurisdictions, they're quite oligopolistic in nature. They're usually dominated by one or two main platforms. Think of Visa and MasterCard in most cases. And what's also true is that these platforms not only facilitate payments, but they also quite often also give benefits to their end users. And these benefits can be either transaction benefits, such as the reward system, or they can be standalone in nature, such as the famous airport access lounges that maybe most of us will need when we go back. So in order to incorporate some of these features, we have built a model of payment platform competition that's two-sided. And what we do is that we introduce a public platform that is benevolent in nature, where the main difference between the private sector is that instead of maximizing profits, it will focus on maximizing the welfare in the society. And also, we have incorporated the fact that this public platform is going to be differentiated in terms of the benefits that it offers compared to the private sector platforms in the market. We believe this assumption to be crucial, especially because the public sector might not be either able to or willing to offer some of the benefits that the private sector does. And on top of this, consumers might also perceive some of these benefits as very different if they come from the private sector or if they're coming from the public sector. Once we have the setup, we're exploring 3 different cases. We see what prices in this structure would look like under the socially optimal pricing. We compare this with a setup where we have only private platforms competing in the market. And finally, we will compare the outcomes in a benevolent competition where one of the platforms is acting as a welfare maximizer. Shortly on our findings so far, we find that the pricing of a public platform is not as trivial as going and pricing either to marginal cost, as usually you would think, which is welfare maximizing, or even in this case, we find that it's not even equal to the prices that maybe a social planner would charge. We find that a public platform that's competing with the private sector faces a trade-off between wanting to decrease prices in order to increase competition in the market, and in this way serve more the surpluses of merchants and consumers, but at the same time wanting to accommodate the network effects that the private sector also generates in these markets. We find in terms of welfare that if you have an entry of a public platform, welfare improves. However, there are specific sectors under specific conditions that I will show that you might have, for instance, merchants that buy from the private platform actually being faced with higher prices after public entry. And Lastly, in these recent weeks, we have been exploring this idea that the public sector might sometimes be quite more restricted in terms of either the budget that it faces or the practices that it can use in terms of the benefits. So we're exploring setups in which the private platform might have to be only charging zero fees to consumers, or they might have to follow a cost recovery approach. And we're trying to ask ourselves, would platforms in those setups still be welfare improving? Okay, 2 words on the literature. This paper, in our view, contributes to 3 distinct literatures. We contribute to the literature on two-sided markets by adding a benevolent platform, which is something that's been missing from before. We also contribute to the literature that looks at private and public sector competition by focusing on adding the two-sided aspect to it. And lastly, as I said at the beginning, we contribute to the literature on fast payment system research and CBDC by focusing more on the payments front and adding this platform competition setup. All right, what are the details in the model that we consider? Well, we have a setup with only 2 platforms. One of them you can think of as the public one, and the other one as the private platform. The way they can attract consumers and merchants is by competing in prices, and we allow these platforms to charge fixed fees and also transaction or variable fees. And the only difference is that the private platform will be maximizing profits, while the public one focuses on welfare. What happens once consumers decide to join a specific platform? Well, in that case, they can interact with the merchants that have joined the same platform as well. But on top of this, we allow for the platforms to give benefits to end users. We have 2 different types of benefits that we enable in this setup: per transaction benefits that we mark with B in this model. And we also allow platforms to give end users idiosyncratic standalone or membership value benefits. And we allow differentiation in terms of these benefits with the platforms that we're modeling. And lastly, in terms of assumptions, when it comes to end users, we're assuming that on the consumer front, consumers are single homing, meaning that they choose one of the competing platforms in the market, while we allow for merchants to multi-home and either choose to join both one or neither of the platforms in the market. If we look at the utilities of these end users, it's easy to see that whenever you're trying to make a decision, let's say, of which platform to join, you're taking into account how many merchants on the other side are joining, and vice versa. However, you do not internalize the fact that you're also bringing benefits to the other side. Okay, let's start with the first case and look at the setup where there actually is a social planner that's in charge of setting the prices for both of the platforms in the market. What would the socially optimal prices look like? Because we are in a two-sided market, the socially optimal prices in this case do not equal simply the idea of marginal cost pricing. Here, the social planner will actually deduct or subsidize each side with the benefits that they bring to the other side. So these are the prices that will end up arising in a setup where we have a social planner in charge. All right, is this the case for platform competition? Well, before we get to analyzing the competitive aspects, it is important to also address the fact that usually in these two-sided markets, there's multiplicity of equilibria because of miscoordination issues. The decision of consumers to participate in a specific platform depend on the participation decisions of merchants. And in order to avoid the multiplicity, we're focusing on using isolated equilibrium concept, which basically makes the platforms that are competing focus on using insulated pricing, two-part pricing strategies, which makes consumers indifferent from the participation decisions of the other side. It's almost like you telling consumers that the benefits that you're gaining from interacting with merchants, I will extract this benefit with the variable fee that I'll set. So focus on comparing the surplus that you get from the membership values and the fixed fees that I'm charging. And in this way, we can focus on analyzing unique equilibrium setups. All right, so what happens when there's both platforms in the market are actually private? Do they charge socially optimal prices? Unsurprisingly, the answer is no. Because there's differentiation in the market, we see that the pricing structure of private platforms basically adds an additional distortion to the socially optimal prices. We have a markup distortion added, which is positive, and which means that there is an inefficiency in the market. Consumers and merchants are charged higher prices than they should be when only where only private platforms are competing. All right, in the next step, let's introduce a benevolent platform. And in the setup, we're considering that platform 1 is the benevolent, while we allow platform 2 to continue being a profit maximizer. What happens in these setups? So when we consider welfare for the platform that's benevolent, we consider a setup where this platform cares about the merchant surplus, consumer surplus, as well as its own profit, but also the competitor's profit. And we have found the following. When it comes to the socially optimal prices of a public platform, it's not as simple as going back to the socially optimal prices that a social planner would charge. And the intuition is simple. You are not in charge of both platforms' pricing. You can only decide for your own platform. So what we find is that while for the merchants, you'll follow a socially optimal pricing structure, which it's not exactly the same as the price that the social planner charges because the share of consumers are distorted from the private sector. For the consumer end, you are actually competing more fiercely because these consumers are actually single homing and deciding to use only one platform. So what we find is that while you do not distort the consumer or merchant prices with a markup, there is an additional term that adds a distortion in these setups. To consumers, you charge also a benevolent adjustment. That's always positive. And this term depends on two factors: on the market power that the private sector platform has over the consumers, and on the diversion ratio, which simply measures the share of consumers that would leave your platform and go to the competitor if you increase your prices. We were curious to sort of understand more what this benevolent adjustment means. So we're looking at a specific case where we have the membership values being distributed according to a type 1 extreme value distribution. And in this case, the dispersion parameters in this setup are going to capture the market power that these platforms exhibit. And what we find is that if the private platform offers higher network benefits to its end users, the public platform will increase the benevolent adjustment. It will set a higher price to its own consumers in order to induce the correct network effects that the private platform generates. Interestingly also, we find that if the private platform markup increases, the benevolent adjustment will be reduced, which in a way shows that the public platform is not only increasing or adding this benevolent adjustment because it incorporates the profit of the private, but because it's trying to induce the correct level of participation on both platforms. This concludes our talk with regards to what should the optimal prices be. Thanks. And we have also, in the paper, said that there is this main trade-off when it comes to pricing, that as a planner, as a public platform, you're going to have to decide whether you want to charge higher prices to increase the competitive effect, or you're going to want to charge, lower prices to increase competition, or to charge higher prices and make use of the network effect. Now we go back to the first question that I raised in the first slide, which is how is competition with the public different from that of privates? And in this case, we're asking, would the public sector charge lower prices compared to the private counterpart in the same setup if there's only two privates competing? And the answer is, to the merchants, always yes, but to the consumers, not always. It might happen that the benevolent platform charges higher prices to consumers. And in the paper, we also find conditions that actually, if they're jointly holding, they would imply that the competitive effect is dominating the network's effect. And in this case, you would want to actually charge lower prices to consumers as well. But mostly what we've seen in practice is the fact that the public platforms that enters, consider PIX, for instance, it focused mostly on lowering prices to merchants compared to the private competitors, and it did not focus so much on actually competing for consumers and going and charging or giving rewards or charging negative prices. So in a way, our finding is in line with things that we are seeing that are happening in practice. All right. The second question, the second part of the question was, how would the private sector react if there's public entry? Would it charge lower prices to consumers and merchants? And the answer is, well, to the merchants, no. Well, to consumers, it would. If you have a public platform that charges on both sides lower prices, you would be competing very fiercely with the private sector on the consumer front, which would induce them to charge lower prices to their consumers. But because you're private and you still care for profit, you're going to find ways to recuperate these losses somehow. And what you do is that you turn and you increase prices to the merchant side. So what we're saying is that the entry of a public platform can improve welfare, but it doesn't always mean that it cannot hurt at least some part of the end users. And in this case, we're showing that the merchants could sometimes be hit, the merchants that decide to still buy from the private platforms. So if we go back and look at the figure of PIX, for instance, it can happen that there's still improvements in welfare, even if we don't see these fees of the private sector actually go down after a while. All right. I have 1 more minute or so, or? Okay. Awesome. So in the last part of this talk, I would like to focus on something that's more practical. Whenever we've presented this paper, we've gotten questions that focus more on, but the public sector is more restricted in nature than the private sector. You know, there's either by regulations or law, oftentimes central banks are faced with either following cost recovery approach, let's say the PIX case, the FedNow case, or maybe additional constraints such as the public sector might not want to give rewards or charge consumers negative or even positive prices because of either equality issues, not wanting to create a platform that not all users can use. So what would happen in those setups? Could a public platform be welfare improving even if it's constrained? And what we show is that we give in the paper sufficient conditions that show that even if you are constrained, you might still be welfare improving for the market. So for instance, if you're a public platform and you're faced with only charging 0 fees to the consumers, you would still be welfare improving if, when you were unconstrained, the optimal prices to consumers would actually be negative. So if before being constrained, you would actually give rewards, you were supposed to give rewards because the costs are lower than the benefits that these end users bring, then you would be rewarding. Now you get hit with a 0 price constraint, you match that constraint, and in this way, you're still improving welfare because you were focusing more on the competitive effect rather than inducing correct participation in the other platform. And same for the cost recovery case. We show conditions that if before you were constrained, you were making a loss in profits, be it from charging negative prices to merchants or to consumers. In this case, if you're faced with a cost recovery constraint, you could still be welfare improving even when restricted. Time out. That's a bad sign. Okay. And finally, even if you have both constraints imposed, 0 consumer fees and cost recovery, if the merchants actually, before you faced any constraints, were actually targeted from a private platform that has very high market power towards them, in that case, you would actually still be able to improve welfare to these end users and in general, both for both platforms. So in a way, I'll start from the bottom up, just with the last sentence. We show that public platforms, even when faced with some of these more restrictive setups, can be improving for welfare, and you have to still be careful with the prices you choose on the other side if you're restricted, let's say, on the consumer front. So to conclude, this paper hopefully will help many policymakers have at least a base of where to go when they're thinking about pricing their own public platforms, and hopefully it can also help with understanding that in some setups, when there's no regulation, entry of public platforms might be required. Thank you very much.
Thank you very much for that enlightening presentation, Idona. Next, we would like to ask to invite our discussant, Daniel Garcia from the University of Vienna, to deliver remarks. Welcome, Daniel.
Thank you very much. Thank you. Idona was our student, so it's a particular pleasure. Although I didn't know she was going to present, so apologies for that. Yeah, so very natural question. One of those papers when you read the introduction and so on, you say, right, why didn't I think of that? How you introduce CBDC, and as he said, of course, there has been a big literature on CBDC and maybe disintermediation in the banking market, but question even more basic for most people will be CBDC as a payment system, and then you can think of the same problem with regards to Visa, MasterCard, American Express, or online PayPal or whatever. And there, of course, you start thinking about, okay, a simple model would be a simple platform model with network externalities, and how will a public provider that is welfare maximizer do things in that setting. In particular, how should it charge set prices, and what will be the impact in the market? And so that's basically what they do. And basically, the very interesting result is you would imagine, you could think, okay, price at marginal cost. Okay, let's be very competitive. Let's try to undercut. But that's not exactly what they find. And my main goal in this presentation is to try to see why is that the case. What is the reason why prices may not respond to our basic intuition that the CBDC should be very cheap, let me put it this way, as a way to increase competition. So suppose that you have a simpler model even with no network externalities. So cash is just as efficient for payments as this other CBDC and Visa, but it is that CBDC and Visa give you some convenience value. Well, in that model, this is actually a simple differentiated products competition, oligopoly, duopoly, okay? And let's say that the commercial network, the platform, sets a price equal to C2 plus mu2. Mu2 is the markup, okay? So that's, without loss of generality, whatever the price it's going to have this form. And the question is, what should the CBDC do in this world in which there are no network externalities? And because there are no network externalities, there is no need to do insulating prices and all that. Well, you can see this in this very simple graph. Here you have the values, the values for platform 2 and 1 of consumers. Each consumer is in a point in this space. And according to prices, you should follow, if you lie to the left of the blue line, you should get a Visa. And if you lie to the right of the blue line, you should get CBDC to make your payments. Okay, because consumer single home, there is nobody in between. Now, efficiency doesn't care about prices, it cares about costs. And so the red line says who should, according to social welfare, buy these products, and this is this other line, the red line, right? So these people in between the two lines in the market are buying CBDC because it is cheaper, okay? Because it is cheaper, but it is not the most efficient thing. So what should CBDC do? Well, CBDC should increase its price so that the price adjusts to the markup of Visa in a way that every consumer looks at the problem in the efficient way. I should buy Visa if and only if Visa is the most efficient option for me. And that means that the price that, here, sorry, should be, that the CBDC will charge is equal to the markup of Visa plus the cost of the CBDC. So if the CBDC is maybe less efficient than Visa, it may have a higher price than Visa. if the markup that Visa charges is higher than the markup of a typical competitor, because Visa is bigger, then CBDC as a competitor will charge higher prices than the previous challenger of Visa, which are some of the results that, they are very surprising, but my point here is they are not really a platform result. They are simply a, what's called in the literature, mixed competition result. And in this kind of simpler setting, I think it comes across clearly. So this is kind of the comparative statics, which I think are very interesting, very surprising, and they obtain in the very simple framework already. Now, there is a little bit of a twist in the model because there is cash as well, right? So what does that cash do? Well, cash is here the outside option. So people who don't like cards and don't like digital money will continue cash. In this country, in Austria, there will be substantial amount of people who stay in this square, okay? Now, when CBDC is, thinks of increasing its price, it's going to send some people to cash, okay? And that's actually very bad. Why? Because cash doesn't have a markup. So on the margin, the marginal consumer who's buying cash should not get cash, okay? And so that's where actually comes this so-called diversion ratio, because the CBDC should only charge the markup of Visa proportional to how many consumers it's going to lose to Visa rather than to the cash sector, okay? And that's where the diversion ratio appears. Now, there was a lot in the presentation about competitive pressure, and I think the competitive pressure, however, in this paper is a little bit muted. Okay? It's a little bit muted because, first of all, you have insulating tariffs, which the name suggests is a way to, of course, a very clever and nice way to get a unique equilibrium, but insulates competition in some sense. And so the pressure is a little bit muted compared with other models you could have. The second thing is a simultaneous move game. I think CBDC, and well, there was discussion before about sequential simultaneous, but in this case, in policy, you think of CBDC as a more sort of long-term decision, what will be the rules, and Visa can change, their schemes, adjust to that, okay? Negotiate, renegotiate, and perhaps a sequential model would be also possible, a Stackelberg leader, and there it would be really interesting because CBDC would have an impact with its policy on the price, while in the simultaneous move game, you do not internalize that a lower price may trigger a response by Visa as well. CBDC is here modeled as a takeover, not as an entry. It's a bit strange because probably it's not going to be that, well, maybe there is exit in the market, I don't know. And, there are other margins of inefficiency, which maybe you could discuss how would they interact, in particular the steering aspect, which is very important in the payment system with cards, whether, at the point of sale, do you change or do you use it? And this depends on the tariff. So perhaps sometimes this could be something to discuss. I think some of the policies you discuss, I don't want to discuss many very interesting points in the paper about these regulations, but some that I've heard, and I'm not an expert on CBDC, is that there may be a balance limit, okay? So it's no price, but there is a quantity, and it could be interesting to think in that sense. There could be coordination issues. So if CBDC is relatively expensive, you have the chicken or egg problem, which you don't have in the insulated model, but you want to have people to adopt it. Politicians probably wouldn't want to have introduced CBDC and 5 years later account for less than, 2% of the market or something. Maybe like, oh, was this good for anything? Maybe it changes things, but people may not see it. There is, these caps, and, as I said, you may want to connect to this older literature in the 90s. I don't need so much time, but in the 90s, there was this large literature on competition between, typical national, let's say telecom carrier or so on, public, and a private carrier, and how that competition looks. Is there, did we see higher prices? Did we see lower prices? There, typically, people found lower prices following the regulation, but they typically attributed it to more, efficiency gains. I don't think that this would be so clearly, the aspect here is unclear why CBDC would be so much less efficient than these companies, at least not in providing the basic service. So it could be maybe something to relate to this older literature. Thank you very much for a very interesting paper, and I really think it's a very good way to start when you start thinking about this question, is to open this, read this paper and have a, think of these first issues that immediately appear. So thank you very much.
Okay, thank you, Daniel. Okay, so we'll open the floor to questions, and I think maybe we'll start here. Thank you. Miko, thank you.
Thank you. Really interesting research, and then I agree with Discussant. This is a really good start to analyze this public-private competition. And my question is around public platforms. What can we do? Like FedNow, we implemented, but we cannot control the end user price. So, we offer, the Federal Reserve offer service to financial institutions. Financial institutions offer service to end users. So price cannot be set, we cannot set end user price, control end user price. So how your model can adjust if the public platform cannot truly set the price?
Thanks. Can I answer, or okay? Please. I think that's a very good point, and I think what we abstract away from here is basically this issue of intermediated markets, where you have issuer or acquiring banks. And I think the FedNow case is actually, yes, a very good example. Our paper directly cannot speak to that if we don't make, if we're restricting that the private or the public platform cannot charge directly prices to end users. One way that you could think of the setup being relevant is, for us, if the market of intermediaries, let's say these banks, is perfectly competitive, you could think that these fees that are being charged to intermediaries would be passed down exactly one-to-one to the end users. And then my advice in that case would be to try and maybe make the market, the intermediate market, more competitive in a way, if you don't have the ability to regulate the downstream market to directly set these fees. In other jurisdictions, central banks also have the power, right? We've seen the case of PIX, that even though you have an intermediate setup, you still have the ability as a central bank to even set the end user fees. So I guess increasing competition in Fed's case would be important. And also just on top of this, to make transparency a bit, because in the FedNow system, end users don't even know that they have the option to choose which platform to use. It's on the back end that this decision is made. So transparency can also help in that setup.
Thank you, Adana. Daniel?
Well, no, I very much think they have, this is again a very good first step, because the model is reduced form. You would have to have a model of pricing at the point of sale, and this would complicate quite a bit the analysis for here. But I think it could be maybe interesting to discuss, to look at this in a very simple framework, maybe to see whether a lot of this will be passed on then to consumers or not, under which conditions. So this could be also, but I understand that it's not in this framework so easy to do.
Agreed.
Yeah, thank you.
That goes to the point of
Can I? Okay.
Getting the power to regulate end prices or force distribution. They can go in the same direction, maybe.
Okay.
I think this.
Oh, sorry. Congratulations. This is a very nice model of platform competition. And actually what you do is you extend traditional literature on mixed oligopolies to platforms. The only thing that bothers me a little bit is I didn't see much payments in your model, in the sense that you use the Armstrong model where the benefits are fixed, they're exogenous, whereas in the payment industry, there is you need to endogenize the benefits and costs of using cards versus cash versus fast payments. And in particular, there is an important asymmetry between the consumer and the merchant, which is that it's the consumer that chooses in the end the means of payments. And you don't have that in your model. So I would like to know whether you will be able to extend your analysis to a truly payment industry.
Agree that these are very, very good points. Let's start from the end point. We think that in our setup, the single homing assumptions on the consumer front tries to capture a bit this fact that it is actually the end user who makes the last decision. Because you can think of setups where both sides are multi-homing. You know, merchants accept both platforms, so do consumers, but at the point of sale, it's still the consumer that will decide which card or which platform to use. So we're trying to capture it in a more simplistic way, I guess.
If I'm not mistaken, in your model, either consumers always pay by cash, or they always pay by card, or they always pay by fast payments. Whereas in the real world,
they have multiple, yes. So in the paper, we're motivating it more by the fact that usually you can hold many cards or many payment methods, but usually there is a paper by Wright and Edelman, if I'm not mistaken the names, that it says that even if you hold multiple cards, you usually are basing your transactions mostly with one. You're using mostly one. Quite often. But I agree that it would be also interesting to have a setup where you first allow decisions of joining platforms and then to also look at which one to use. Yeah, in our setting, we thought of single homing as a more simplistic manner, but yeah, it would be interesting to do. On the endogenizing benefits, it's exactly how we ended the discussion, I guess, this week of thinking, if you think of prices, you should also, let's say, especially at the public sector, think of what should these benefits be? And I think that's a natural way that we could extend this work. So thanks for the suggestion.
Any thoughts, Daniel?
No, I mentioned in my presentation the steering aspect of this, which was the American Express case, for instance, right, where many consumers, you know, at the point of sale switch, and the pricing, of course, affect steering. There is a reason, it's the American Express case. And so that's an aspect that perhaps together with the point of sale, as he says, that endogenizing this, but it's probably a different paper, but I think this is a very good first step, and these questions come naturally afterwards.
Okay.
I just want, as a co-author of the paper, just want to help a little bit more on this endogenous benefit or the payment element side. We explore over many solution concepts in the literature, and we find we pick this insulated equilibrium solution concept. We find it's powerful in the sense that even with the endogenous benefit, you can microfund it how platform are endogenize that, but with the insulated pricing incentive, it will lead to the same profit function of the platform. So regardless of how competitive the merchants are and how platform going to endogenize the benefit, it's always lead to the same social welfare functions and platform. So in that sense, it's robust, but it's coming from the solution concept. We definitely want to try different solution concept, different framework to see if the result can still there. Thank you.
Thank you. Any other thoughts? Okay, I think there are some questions over here. And while we're getting around to that, can I just ask, is it realistic, you know, to assume that merchants are not single-homed, especially given the push that the ECB and others have said is necessary to enable merchants to accept certain means of payment?
Is it realistic that they don't single home, is the question?
Yeah. Yes.
Well, in this
they're multi-home in our set.
Yes. Well, is that realistic?
Is it realistic? Well, I think because at the point of sale, at least in our view, is the consumer that most often makes the decision, it would be better for you not to lose the sale, not to use the opportunity to sell this product just because you didn't accept platforms. We see that actually typically merchants accept more than one at least payment method.
So what you're saying is that merchants aren't refusing certain forms of payments?
They are struggling. You see that they're faced with very, very high fees, yet you see many of them actually still accept more than one. Yes.
Very quick question. Daisuke Ikeda, Bank of Japan. So really enjoyed your presentation. So can you show that public platform is the best solution among competing government policies, like imposing taxes and subsidies or regulations? So, typical approach is that you study, private equilibrium, and then identify externalities, and then solve for constrained efficient allocations, and then come up with, taxes, subsidies, or regulations. to achieve, constraint efficient allocation. But you start with, public platform as a potential solution and show that it is, welfare improving. But I wonder, it is the best solution.
Right, that's a great question. I think, one, we're not advocating with this paper that a public platform should be provided as a solution to the inefficiencies. Usually, central banks have started thinking of, let's say, fast payments and CBDCs as a way to motivate other issues that are wrong in the market, either to try and include more people in the market or to try with CBDCs to protect their monetary sovereignty. But as another step, you might think of, okay, how would it affect payments if we introduce it? Are there other better ways? If you believe the simple setup that we're considering here and you have a social planner which could be equated to a regulator that's well informed for the setup, you could be better off by just regulating this market perfectly. We see in practice, though, that regulation is not that easy. And usually what happens is that it's either one-sided and it backfires, or let's say you're a great regulator, you know the literature on two-sided payment markets, you have the ability to regulate both on the consumer and on the merchant front. After a while, nobody guarantees that these private platforms who are motivated by profits won't introduce new fees. So what the public platform does is that sometimes it doesn't achieve the first best, but it offers an outside option that even if the private sector can get creative with additional fees, you'll have an outside option that can be more reliable and maybe cheaper than the private sector. Yes, please.
Hi, I'm Ivan Ágoston from the Central Bank of Hungary. And one thing that we see is that with the private sector, so Visa and MasterCard, these are global systems that consumers can use outside of their country. Meanwhile, the CBDC or the faster payment systems are going to be domestic or are domestic systems. And I was interested if you have thought about extending the model to have foreign merchants and consumers who cannot use the public system but can only use the private system, and whether you have any intuition on how this might change the results of the model.
Yeah, that's a good point, though I would want to start with the fact that there are some countries that are considering specific use cases where it's also offered to tourists, not only to domestic users. So I think that's the PBOC's case, that they're actually looking at use cases like that. How would it change the outcomes if you offer it to outsiders? It's not very clear to me right now of how that would be done. It might reduce a bit the competitive effect if the other platform can have more merchants or consumers to it while you're more restricted. That could be a setup to consider. So thanks for the suggestion.
Thank you. Daniel, any remarks?
No, as I said, and I think from the questions, there are many kind of moving forward questions that I think are very exciting. I think it's really, the clear first step that one has to do, and I think I learned quite a bit just reading this. So I think I recommend people who are interested in this to also have a look at the paper. And I think they have, a number of papers on this area on the different issues, as he said, and I think this is a very exciting prospect. Yes.
Thanks, Daniel. Thanks.
Thank you, Adana. Thank you, Daniel. All right, well, with no further ado, we would like to invite Topi Hakanen from Aalto University to give us a presentation on disintermediation and payment market impacts of CBDC. Welcome, Topi.
All right. Hello, everyone. Great to be here. And I'm from Aalto University. I'm presenting here today a paper I'm writing with Tuomas Takala, who's working at the Bank of Finland, whom many of you may already know. And before I start, might I say that I feel a bit scooped, perhaps, by the previous presentation, because a lot of my results, or our results, are going to be quite similar, although the model we use is a bit different, but fantastic job. I love the results presented previously. So the motivation for this paper is that European payment markets are highly digitalized, they are diverse. The payment card market that basically forms the majority of European payments today, because cash use is dwindling, that is characterized by essentially a duopolistic market with Visa and MasterCard providing the card network services there. So A reason we might think that dwindling cash use is a problem is because we might think that cash is the public's access to central bank money. And if cash is becoming less and less used in the future, then a central bank is going to eventually lose its relevance in the payments market. Right, now, one solution for this would be the central bank to issue a new public payment instrument that is going to be, well, at least the ECB is calling it, a digital complement to cash, which is basically keeping the central bank a relevant player in the payments market, even though the payments market is digitalizing, right? And let's call this central bank digital currency, or CBDC. But the problem with this is that the market effects of these new payment instruments are not that well understood. Well, of course, there's a nascent literature on CBDCs and their effects, and because CBDCs, as central bank issued digital currency, they're not just the DC, they're also the CB side. So they have effects on financial stability. They obviously may have effects on trade flows and international trade, even monetary policy transmission, and of course, perhaps of interest to most of this in this room, they may have an effect on deposit markets, and they may have effect on issuing bank-side disintermediation. So, as I already said, there are only a few papers looking at the payment market effects of central bank digital currencies, and why we think this is a good question to address is that we consider that primary demand for CBDC may come from a payment side, like as is, if it's to be a public payment good, then we should really consider a model in which we think about the demand, right? So what we do in this paper is take a very standard two-sided markets model of Rocher and Tirol, and of course we have an author sitting here in the room, so if I screw things up very badly, well, I guess I'll hear about it. Okay, so anyway, we have this basic model, and we endeavor to derive the best responses of incumbent card networks to the entry of CBDC, which is a new public payment instrument. And to be clear, we are considering CBDC here as a payment scheme. All right. And lastly, we want to think about the socially optimal design of such a payment scheme. And of course, this is very preliminary work, so that's why we only think about it. If I wasn't such a slow guy, then this would probably say derive the socially optimal prices, but I'm not there yet, so you'll just have to bear with me. So we're going to modify a very textbook model of two-sided markets, and we're going to have CBDC entry in there. So our economy is going to consist of four agents. We're going to have buyers, we're going to have sellers, then we're going to have issuing banks, which are the buyers' banks, and in place of acquiring banks, we're going to have payment card networks. We consider those the kind of the acquiring side, or if you wish, you can think that we assume perfect competition on the acquirer side. So we're going to allow buyers to be differentiated based on their affinity or benefit for card payments, this parameter B sub B that is in this interval. And if you want, you can think of this parameter as being, for instance, a type of preference for anonymity in payments, for instance, because if you have a very low benefit for card payments, you don't want to give out your details. If that's the way you want to think about it, that's fine. Other ways to think about it might be that you find cards very, very convenient all the time. You don't want to carry cash, like the convenience angle of it. But buyers are distributed on this line according to some standard distribution function f with the affiliated PDF. We're going to keep seller card payment benefits fixed for the moment and only consider heterogeneity on the buyer side. Now, I already said that there are incumbent card networks in place, and what they do is that they maximize their profits by setting up payment card schemes, which basically in here are characterized by two prices: the user price of a scheme and then the seller price or merchant service charge. And we're going to keep the interchange fees here fixed, and we're going to keep the transaction costs also fixed here, just for brevity and clarity, because as you see shortly, the model is complex enough as it is. So here is a picture of all the players in the market, all the prices, the scheme fees, what have you, and you can see that the buyers are heterogeneous, as I said, right? So the thing that we're going to have is that a buyer is going to choose a payment method that gives them the highest payment surplus. So, and we're going to assume that cash is always available to a buyer to use, and it yields an outside option surplus of this P lower bar. Now, if you pay with an incumbent card as a buyer, you're going to yield, of course, your payment benefit, your card payment benefit BB, which is your own taste parameter, minus then the user price of this card. Now, this gives a very kind of simple or mechanistic comparison of what buyers do when they're placed on this interval. It just gives us a result that if your card payment benefit is high enough, then you're going to choose to pay with a card, and if it's low, then you're going to choose to pay with cash. This, alongside the assumption we make, which is that we normalize total payment volume to 1, allows us to basically characterize the market in this stage by this simple single threshold case in which we divide the market in two, in cash and cards. Now, I'm going to be a bit ambiguous and a bit vague on seller side at this point, but like is usual in two-sided markets models, the sellers, with their fixed benefit of card payments, when considering what payment methods they accept, they're not taking into consideration only that parameter. They also consider the option value accruing to buyers for a given payment instrument. But I'll let that be slightly vague at this point because I have to economize on notation. So as I said, with cash and payment cards, this is the textbook case, we're going to see a market that is split in two, right? We have the ones who pay with cash and then the ones that pay with card, and this depends on, well, their private benefits, right? Now, as is textbook, we can see that basically if you derive the optimal prices for two market structures, and because I'm a lazy guy, I'm going to only compare the very extremes of market structures, meaning a monopolist and a Bertrand competition case. So we're going to have a textbook result of when there's a monopolist, then on one side, prices are something closely resembling competitive, but on the other side, in this case, seller side, we're going to have prices that are inflated beyond sellers' private benefits. This is just basically the monopolist using their market power. Now, under Bertrand competition, of course, this is extremely tight head-to-head competition. This is going to equalize prices on both sides of the market. But as happens in Bertrand, these prices might still be above socially optimal prices for card payments. And this is just, you can disregard the equations, but this is just a textbook result. Monopolist, we see prices inflated beyond seller benefits. Bertrand equalizes prices. Fine. So what about the CBDC? What kind of thing are we considering when we characterize a CBDC? So as I already mentioned, we are considering CBDC as a payment scheme, such that the central bank enters the market and it has this new payment scheme that we're going to call central bank digital currency. Importantly, we're going to have or assume that this payment scheme is an imperfect substitute for card payments, meaning that, well, perhaps you can think of it as such that it may have holding limits or certain types of payments cannot be made with it. As a result, if you choose to pay with the CBDC, your private card payment benefit you get from it is this alpha times this PB, where alpha is strictly between 0 and 1. This is the imperfect substitution. Now, we're going to also assume, and well, some of this I might not need in the end, but at this point we're going to assume that buyers need to pay a switching cost if they want to use CBDC. That is this gamma, meaning that on top of the existing cards that you have in your wallet, if you want to use CBDC, you have to go into your bank and open up a CBDC bearing account or something like that. And this is kind of like the switching cost we're talking about here. Of course, CBDC also has its own buyer prices that is denoted by this P sub D. So if you use your CBDC as a buyer of type BB, what you're going to be receiving as a payment surplus is this alpha times BB minus your switching cost minus the buyer fee of CBDC. So what the central bank essentially does is set a buyer price and a seller price for their payment scheme. And we're going to keep the interchange fee here fixed as well. And the thing that we have in mind and the thing that we want to model is kind of entry in this type of way, so that the market is kind of partitioned in three segments. In buyers that use cash, buyers that use CBDC, and buyers that use payment cards. Now, the reasoning for this and behind this is there are a few papers that try to estimate demand for CBDC, and they come up with things like, well, hope I'm not missummarizing the paper, but they say that CBDC demand may come from relatively kind of, high benefit cash buyers and kind of low benefit card buyers in the sense that well, okay. Now, why I kind of like this type of entry is that in the end, we want to have these two thresholds be endogenized so that this model would permit, for instance, that cash use would just go away or CBDC would have a zero market share, but having it be this kind of intermediate entrant kind of allows it. So, of course, given our normalization, then the induced CBDC payment demand is then just this FB1 minus FB0. Okay. So what are the incumbent best responses in these two market structures if we have an entry of this exogenous CBDC product into the market in this way that I just went over? Well, a monopolist is going to see that, well, since the market is now split in three, a monopolist is going to see their market share actually go down because their market is being cannibalized. But because we made this particular assumption on the heterogeneous buyer benefits, now this is not just bad news for the monopolist because, okay, their market shrinks, but the expected benefit of their customer now is going up. So they have, and they also have market power, so they can hike their prices up. So they best respond by increasing their prices. And as you can see, there is this distortion term there on the left-hand side. Now, if you have Bertrand competition in this market before the entry, then this is going to be a very stark form of competition in which you have zero profit conditions. So on one side of the market, that zero profit condition is going to kind of force your price down to like, well, this level that looks almost competitive, but might not be. So we see that if there's Bertrand, then only one side is actually now subsidized, meaning that the competitor is going to undercut the entrant. And the buyer price here is going to be below the socially optimal one. Now, of course, the effects of CBDC are going to depend heavily on market competitiveness. And in our paper, because it's preliminary and in this short talk, I can only contrast two different market structures. Now, we can do some comparative statics on the CBDC market share on the buyer and seller side, but I guess I'll skip that. So, well, the next step, after considering some exogenous entry by a CBDC product, would be then to think about kind of the socially optimal design of such a scheme. And the first thing that you have to keep in mind, or your first question you have to answer in such a design, is actually coming up with the social welfare function. Whose welfare are you going to maximize in this market? And previously I showed you the picture. We had 4 participants in this market. And we think it ought to be so that if a central bank is maximizing welfare by setting up a payment card scheme, then the welfare it should consider are the surplus of both cash and CBDC using buyers and sellers, and the issuing banks. This is because the CBDC may have these disintermediation effects and cause these disintermediation costs. So the only player missing in this funny-looking formula here are the card networks, actually, who end up being like the central bank's direct competitors. But that's not enough, right? This is just our objective function. There are also 4 constraints that this problem is going to have, which I'm going to name the monetary anchor constraint, the disintermediation constraint, the budget balance constraint, and the CBDC use constraint. And this is partly what we saw in the previous presentation as well, some of these things. So what are the constraints? Well, the first is going to be what we call the monetary anchor constraints, which means that, well, it ought to be so that the central bank's market position in the payments market should not be worse after CBDC entry than before it. Meaning that, well, okay, it's pretty self-explanatory, right? Second is a constraint we call the disintermediation constraint, meaning that issuing banks should not be worse off, meaning that a central bank should abide by the central bank Hippocratic oath of first to do no harm to payment systems, for instance. And so when issuing banks kind of compare the situation after CBDC entry, like the CBDC might cost them some transaction-based disintermediation costs, which I'm going to keep very vague here. It's just a delta parameter. But basically the thing to keep in mind is that the issuing bank should not be worse off. And this is an additional constraint on top of everything else, right? Now, especially in our model, since we have a very kind of, I don't know, simple objective function, we're going to need a budget balance constraint, meaning that the CBDC scheme should be self-financing, meaning that whatever interchange fee you're going to put on it, this is going to have to be financed by buyer and seller side fees. Because, well, in our model specifically, if you would not have this, then an entrant with extremely deep pockets could subsidize their scheme and basically, well, in our model, make welfare, arbitrarily high, but I don't know. And maybe in the real world, that is something that needs to be done because of the chicken and egg problems, but I know not. And lastly, we have a use constraint that is simply saying that CBDC should be used in equilibrium. So I hope I've convinced you so far that this is a rather complex optimization problem. Now, unsurprisingly, this problem has many optima, depending on which of these constraints are slack. And of course, I haven't solved all of them. But the interesting thing in all of the equilibria I've found are that the CBDC buyer and seller prices are non-zero in all of the optima, which contrasts with kind of like, some of the CBDC designs that we have seen or heard about where kind of, one side is already, or, the central bank is already tying its hands on one side saying that, okay, should be free to these people or those. And of course, because of our model and, the thing is that if CBDC gains zero market share, no one uses it, then nothing's going to change because, it's going to cause zero impacts on the incumbents. Now, so the results I have so far is that in two-sided payments markets, well, the entry of this public payment scheme is going to lead to an increase in incumbent pricing on both sides of the market if there's a monopolist in this market, and it's going to lead to a decrease in incumbent pricing on only the one side of the market if it's characterized by Bertrand competition. Crucially, all these effects, of course, depend on CBDC market share. Like if no one uses it, then in this model, it will have no effect. In a richer environment, if you're considering entry deterrence, for instance, then it might have an effect. But in this model, we don't have it. And finally, the optimal design of such a scheme is a rather complicated affair. So that is it. I think we're under 20 minutes. Thank you.
Thank you, Topi. So next we would like to invite our discussant, Philipp Schmidt-Dengler from the University of Vienna. Welcome, Philipp.
So thanks very much for giving me the opportunity to discuss this very nice and interesting paper. So the starting point is to introduce CBDC in a textbook model of platforms, very much in the spirit of Jean-Charles' seminal papers. And the starting point is just cash or credit, and I'm not really sure whether it's a four-party scheme, because in the end there's just one monopolist who sets both buyer and seller prices, but that's just a question of language, and in the interchange fees is exogenous. The cash is provided by the central bank, and is the outside option generates some benefit P lower bar for the buyers, and the card offered by the monopolist charges the sellers a user price, and the sellers have a benefit BS, and the buyers pay a price PB, and the buyer benefit is distributed according to some distribution F. Now, the monopolist maximizes profits subject to an individual rationality constraint, which is the match surplus, and I'm going to have a question about that, and the IC constraint, so that you get this sorting. And then you have a threshold equilibrium or sorting equilibrium where the low types use cash and the high types use the card. Now the CBDC enters in this market. It introduces this new means of payment and charges a usage price PD. It's an imperfect substitute, so while the card yields BB, the CBDC only yields alpha BB, so the alpha is between 0 and 1, and there's also a switching cost. So regardless of whether you've used cash or card before, you have to pay a switching cost gamma. Now, the paper assumes a very specific timing, namely that the CBDC first sets the prices, so the usage price of using the CBDC for buyers and sellers, but also, I guess, does it set the interchange fee? No, that's given, or it's a technology parameter. I'm not sure.
Well, let's keep it as a technology.
Yeah, let's keep it as a technology parameter. And then in stage 2, the monopolist best responds to this CBDC by setting its own fee structure. So again, it maximizes the profit subject to an individual rationality constraint and an incentive compatibility constraint. And again, for a given positive market share, so obviously that's endogenous, right? So it's difficult to do the comparative statics here. The buyer price would actually increase. So the buyer price for cards. So again, you get this sorting equilibrium where the very low types use cash, but now you have this intermediate range of types who use the CBDC, and the high types use the credit. Now the difficulty is, you think like, I mean, it's the most natural thing. Take the seminal model and introduce CBDC and see what happens. And unfortunately, it turns out to be very, very complex because actually you don't get any like closed form solutions. So actually, these prices that you get are characterized in terms of the threshold B1, which again depends on the endogenous objects. But in terms of writing it, I think I would just write it that way. So like making clear that these prices are only characterized in the, implicitly in these equations rather than explicitly. Yeah, well, what also was not clear is whether the market share of cards can actually be ranked with or without CBDC. I would assume it goes down, but was not necessarily obvious to me when reading the paper. So what about the design? You could think now, like going back to the first stage, the CBDC, the central bank sets the prices of using CBDC as a buyer and the seller, and then maybe the interchange fee as well, as we discussed before. And yeah, so the difference to the paper we had in the first part of the session is that the central bank only maximizes the welfare generated from central bank money, which is, I'm not sure whether that's the natural choice or not, because obviously there's something happening to the rest of the market. So it's just a surplus of cash using buyers, CBDC using buyers, and CBDC using sellers, but not of card using buyers and card using sellers. And there, and then there are a bunch of constraints, and I think simply formulating those constraints is an important contribution, because it mentions all these desiderata that have been mentioned, or the wish list that we have for CBDC, and you wonder when you read through them whether, you know, in most countries this introduction of CBDC will remain a more academic discussion. So one was the monetary anchor. So the sum of cash and CBDC has to be more than the sum of cash or total cash use in the absence of CBDC. The second constraint is what they call financial stability, or I think what the retail banks themselves call financial stability is that their profits are not heard. So actually the governor here invites economists like twice a year for like an evening of discussions, and once we had the discussion about CBDC, and there were also, I think, 2 chief economists from the 2 major Austrian retail banks, and there was serious concern about their deposits. So I think it's important to have this constraint in there as well. And then budget balance. So the CBDC should, in principle, finance itself. So here it really makes sense to have this as a technology parameter rather than a choice. And then, if you want to introduce CBDC, it should actually be used. It's not necessarily the case, right? If we think about it just being a threat there out in the market and constraining the card networks may have a purpose as well. Now, in terms of results, again, it characterizes the solutions for the prices of CBDC for buyers and sellers for a given interchange fee pi. Again, this is written in terms of endogenous thresholds, and it would be good to write those out explicitly. And sorry, the second one should not be proposition 2, but 3. That characterizes for the solution for a binding monetary anchor constraint. But again, this depends on several other conditions which depend on endogenous objects. Other results, so I think that the first bullet point is that, there's no free lunch. So again, when marketing CBDC, at least here, people go out and say it's going to be free for everyone. So it can't be free. Yeah? You can't do it with either violating the budget balance, so it has to come out of the central bank budget, or the banks are going to have to pay. The private banks are going to have to pay their share. So we can't have it both ways. And then in the case where there's a 0 CBDC market share, that's optimal from the central bank's perspective. The CBDC entry would not affect prices. This result, of course, depends crucially on the timing of the game. So here you might think about, and we had this discussion also in the first half of the session, is what if you assume simultaneous moves, thank you, or alternatively, you would think, actually, we have a market without CBDC, and I think you alluded to that already in your presentation, is you could think of the incumbents actually trying to limit price the central bank out of the market, but that, of course, we would expect that to have an effect on equilibrium prices. Some final comments. I think this is a very useful exercise. You think it's obvious it should be done. You've very clearly characterized the solutions, but they also proved to be extremely difficult to get tight results. Just tiny comments. What I was wondering a bit about was the IR constraint, that it only requires the total match surplus to be positive. So if the seller surplus is negative, you're wondering how the marginal consumer can be enticed to use the CBDC or card. I think the surplus would only be positive in expectation, but if they actually know their type, it's not clear to me why they would use the CBDC, and that's already a problem in the just cash or card model. So I was wondering why there are not 2 IR constraints in your optimization problem. Just some other comment, I think, on the financial stability constraint on the left-hand side. I don't think you need the expectation parameter, because in your model, there's nothing random on that side. I already said a bunch of times, there are a bit too many endogenous things floating around. It would be good to clarify that these are characterizations of the optima, but not the solutions. Maybe consider a bit more comparative statics. So from an empirical point of view, so empiricists, what we want to know is what are the crucial parameters we want to learn about from the data to evaluate this introduction, right? And I think that's where the paper could be really useful. You could say, well, for any kind of distribution, what really matters is, say, alpha or gamma or anything like that. or, be a bit more, audacious and just plug in some specific distributions and see whether you can get something explicit. And given that this is already very complex, I'm reluctant to tell you to do more, but obviously in the end we're wondering who pays for this in a sense of how is this going to affect the final consumer in particular, as we're always worried about the use of card, that is actually the cash users who pay that markup. And again, we're wondering how is the introduction of CBDC going to affect the price that end users pay, but that would of course require to model the downstream market so that the price is actually set by the retail firms. Thank you.
Thank you, Philip, and thank you, Topi. So we open the floor to questions. Yes, please.
Thank you. So congratulations. I wish I had the idea before you. So I think it's very promising, although there are still work to be done. And I would like maybe, if you have time, to discuss some detail with you on the furthering your contributions. And the second thing I like is that there is a remarkable consistency with the previous paper. With the result, there are things in common in terms of the policy implications, which show the robustness of both approaches. And the way you model these platforms really is so important, and there are things in common. But in terms of the CBDC, which has become a buzzword that everybody wants to have in the title of their paper, I believe that the detail of the design are important. And you can have very different behavior according to which way the CBDC. For example, I doubt that the central banks will manage the accounts of the population. And what happens is we have intermediaries. So who will be those intermediaries? Will it be the commercial banks? Would it be new payment service providers? So I think you have to explore, and this is also true for the first paper, you have to go deeper into the design of the CBDC.
Any reactions?
This is an excellent point. And of course, to me, looking at this from the outside and just modeling CBDC essentially as just a public payment scheme, that this is kind of like, I can hide behind my assumptions, but of course you are correct in that in the end we should really think about the intermediaries and what kind of incentives do we need to provide for the intermediaries. For instance, if the ECB is saying that the issuing banks or private banks, retail banks, should be the intermediaries who are dealing with this, then that kind of adds constraints to the CBDC design problem. And as I guess, I hope I argued at least somewhat convincingly that the design problem is already very complex. But then on top of the payment aspect, you're going to have an incentive aspect, and then the disintermediation deposit aspect or whatnot. It becomes a rather complicated affair. So I don't know if in my model we can really address this question in a proper manner, but in the future, definitely. And if I may take the time and address one of the comments you had about the private types and the higher match value, that the work we're doing now is mostly expanding this model to be more in the Roche-Tirol 2011 paper, in which the randomness or the type of the consumer kind of realizes when they go to the shop, and the major decision is taken as to what kind of shop you visit, whether you visit like a cash-only merchant or a merchant that offers cash and CBDC, and we allow the merchants to actually separate on that kind of dimension in the sense that they have different retail prices for the products. And but of course that wasn't in this presentation, and I'm sorry for that.
Thank you, Topi. Philip, do you have any reaction?
No, thank you.
Okay.
Thank you for that answer.
Thank you.
So Franz Seitz, Technical University of Applied Sciences, Weid in Germany. So when you introduced CBDC in one of your slides, you stated or you assumed that CBDC is an imperfect substitute for cards, and there are these switching costs, gamma. So I would have put it in another way. I would have said that CBDC is an imperfect substitute for cash, and at least in the eyes of the buyers, a perfect substitute for cards. And I'm especially thinking about the situation in the Scandinavian countries. In Finland or in Sweden, for example, when you ask the people, they tell you, yeah, it's different than cash, but what is the difference to card or mobile payments? So my question would be, what would change in your model if we would use these assumptions? And at least if I understood it correctly, it seems that this assumption, imperfect substitute for cards, drives a lot of your results.
Thank you.
Excellent point, and you are correct. This assumption drives many of the results we have in the paper. And what would change in the model if we would think about this in that way, in the sense that CBDC would be a perfect substitute for cards, but an imperfect substitute for cash. And I think, well, in our model, I guess the action would then switch to the cash side of the model, because the perfect substitution with cards, especially, well, it depends on if you still have switching costs and things of this nature, but I would venture that it would then kind of rein in kind of the incumbent card networks even more heavily. And the reason we kind of did it this way is we want to kind of adhere to, the word of God that's coming from up high on the ECB side, for instance, holding limits or something like that. So in the sense that we want to preserve in our model the situation in which all payments cannot be made with CBDC, like all card payments, for instance, because, for some amounts you can't do that. But that's a fair point, and we should probably explore that. I hope I answered your questions too.
I mean, it's probably maybe a very good substitute for debit, but not for credit.
Oh, sorry, please.
Yep.
And then.
Thank you. Balázs Kucian from Central Bank of Hungary. Thanks for the model. I really enjoyed it. I just have two questions, or rather suggestions. First is the Binzel Ulrich has been publishing on how the modeling of CBDCs should be handled, and one of his points is that we see in the economy that the usage of cash is actually decreasing. So I understand your model is quite complex already, so would introducing that kind of dynamic in the cash usage, like a decreasing cash usage and increasing card usage in the model, would it help in easing some of your constraints, for example, the constraint on profit of banking sector, because then dynamic is a bit more different or a bit more difficult to compute, I guess, but still it could help. The second one I would like to notion is with regards to your third constraint. It says that the CBDC system should be self-sustaining, basically, in terms of expenses. But if we think of CBDCs as a public good, as a part of providing payment services, if we compare it to cash, is cash really paying for itself? I guess it could be considered as a public good, and in that sense, it doesn't necessarily have to be paid by itself.
Fair points, excellent questions. Let me try and answer your first one. Like, if the difference in our model between cash and CBDC is the fact that issuing banks get nothing from cash. Basically, cash only causes them kind of, costs and compliance costs and what have you. While CBDC is kind of, well, imperfect substitute for card payment, but it has the added bonus of getting interchange fee revenue from CBDC payments. So in that sense, if we have a trend in which cash use declines, and then, if that portion would be taken over by CBDC, then maybe that would help lift kind of like the profitability or the financial stability constraints of the issuing banks. Now, I'm sorry, could you repeat the second question? I forgot it. Yes, of course. So the budget balance constraint we have in there just basically for, well, I want to say moral reasons, in the sense that, that the entrant we're considering here has considerably deep pockets. So within our model, like if we didn't have this, then we'd run into problems of, well, if you just subsidize it a lot, then you can make welfare as high as you want. But in the real world, I guess, that might even be needed because, as we know, like, entering payment systems in these two-sided markets, especially when there are network externalities, like high network externalities, you might need to subsidize your product for a long time in order to gain that network externality. So maybe that's not such a relevant constraint. We just wanted to have it in there to kind of make the point that, okay, these are all the things that have been said that the CBDC should abide by, and if we take them seriously, then this becomes seriously complex. But you are correct.
Thank you. Philip, any?
No, thank you.
Please.
Yeah, thank you. Thank you for the talk, Wilco Bolt from the Dutch Central Bank. I was just, well, the model is already pretty complicated, but I was just thinking about the role of the seller in your model. From what I got from the model, do they accept all options, so cards, cash, and in the end CBDC? So are they homogeneous in your model, the seller? Because I did not see much on the seller side. So I assume that they sort of accept everything. They're multi-homing. It is, of course, the question: not all sellers accept cards. Could also be an issue that perhaps not all merchants accept CBDC. And of course, we like, I think in a digital euro project, it is assumed or it's obligated to accept as a seller. Perhaps that's another constraint in your model, that they have to accept CBDC. Not sure how that pans out. And my last question perhaps is then about switching costs. It looked like that the benefits are sort of casted in a per transaction dimension. So you have per transaction benefits, and then you have also switching costs in there. To me, it looks you make switching costs only one time, and not every time you use your CBDC card or not. So it looks like switching costs has a very specific role here on a per transaction basis.
Thank you.
All right, thank you. So on the first part, on the seller behavior, so I'm sorry for being well, no, not purposefully, but being very vague about what happens on the seller side. Indeed, we do have multi-homing sellers in the model at this point. The thing that we are endeavoring to have is to have also seller differentiation later on in a draft in which sellers would be able to decide which payment methods they accept, and that may come along, as a result of increasing like the substitutability of CBDC vis-a-vis the card payments and stuff. So, and definitely like the seller acceptance and kind of like the merchant side has been on the forefront of the digital euro project as far as I know. And you are indeed correct that there is a mismatch in this switching cost, because we're doing things on a per transaction basis, and then the cost is in there, and then the cost is being paid per transaction, which that's not a good thing. But to our defense, I guess that the model is kind of, to a degree, it's over-specified. We have many different parameters. It may turn out that we do not need all of them. Maybe we can do away with the switching cost and just have the alpha there to represent that, okay, this is an imperfect substitute or something like that. I don't know if I answered your question, but.
All right, do we have any final comments from you, Topi, or Philip? Topi?
Well, thank you so much for bearing with me and tolerating my terrible slides and everything. So,
thank you, Philip. Any final remarks? Okay. Well, thank you very much. I think. Okay. So before we close, please.
Thank you. Let me just make a very brief organizational announcement. We'll have a lunch break now, together with a poster session. And you are warmly invited to check out very interesting posters. The posters will be placed here in this hallway, right next to this room. So enjoy lunch and the poster session. Thank you.
Okay, thank you. We'll reconvene at 1:45 p.m. And in the meantime, enjoy lunch. And let's thank our speakers.
Okay, I think we can get started. So it's my pleasure and my privilege to introduce our keynote today, Professor Jean-Charles Rocher. I won't dispense with reading his CV. Rather, I want to recount a kind of foundational moment in economics of payments. So the economics of payments has been, this is the 13th edition, and 20 years ago, though, was the first edition. Professor Rocher was the keynote lecturer there, and he talked about two-sided markets and platforms and time. And as you can see today, you've seen a lot of papers on platforms, and you'll see some more going forward. But I want to go back to Economics of Payments III in Atlanta. And show of hands, who was there? Okay, that's very good, exactly. And the person at the back, Wilco Boats, he and his co-authors, Sujit Bob Chakravorty, presented their paper using two-sided markets. Other differential privacy, there was a professor, we'll call him Professor X. He made some very critical remarks about that these models were not deep, they were not micro-founded. But Professor Rocher was very kind. He stood up and said to him, no, but they're very useful. Further to that, Professor Rocher gave up his dinner, spent the evening reviewing Professor X's research. And he used his keynote to have an impassioned defense of what payment economics is about, which is rigorous scientific research, but also useful for policy. So with that, I'm going to end my part and give all the time back to Professor Rocher. As they say, the parole est à vous. The floor is yours.
Thank you very much. I had forgotten this anecdote, but I don't look very sympathetic, you know. Okay, anyway, so it's a great pleasure for me to give this keynote lecture, and I really thank Martin and the organizers for inviting me. And I thought an appropriate topic could be, you know, Bitcoin and Hayek. Why Hayek? Obviously, because he's one of the most famous, brilliant Austrian economists, and practically 50 years ago, he published a book called The Denationalization of Money. It's an old idea. And he started by noting that many governments use their power, their monopoly power to issue money in order to defraud and plunder the people, I quote. And I mean, there are recent illustrations of that. Not in Austria, of course, not in the US or in Europe, but in certain countries like Zimbabwe, Venezuela, Lebanon, Argentina. And really, I'm joking, but it's a tragedy for the people on those countries where you have saved all your life for your retirement, and then you realize that all your assets are valueless. So Hayek proposed to deprive central banks from the monopoly of money issuance, and he suggested to allow private currencies to compete with public monies. It's this idea that competition disciplines agents. So the purpose, I quote Hayek, the purpose of currency competition is to impose upon existing monetary agencies a very much needed discipline. So I was really curious to see where the loyalty of Martin would go, either to Hayek, one of the most brilliant you know, Austrian economists, or his employer. And it turns out, as you all know, that in almost 20 years ago, 15 years ago, the blockchain technology allowed the creation of Bitcoin, the first cryptocurrency. And the mysterious founder, Nakamoto, is quoted by saying that Bitcoin allows online payments to be sent directly from one party to the other without going through a financial institution. And interestingly, it was just after the global financial crisis. And in the Genesis block of Bitcoin, there was a statement in the press that the chancellor of the Exchequer was about, once again, to bail out the banks. And so there's a group of people there who are fed up with central banks, commercial banks, governments, and say, we want to run our show ourselves without the interventions of central authorities. Of course, cryptocurrencies are criticized by experts, in particular Agustin Carstens, the head of the BIS, said to be credible, money requires institutional backing, which is best provided by a central bank. My friend and colleague Jean Tirole says Bitcoin is a pure bubble, and an asset without intrinsic value, its price will fall to zero, its trust vanishes. And of course, Warren Buffett, a well-known practitioner, who says that cryptocurrencies are they have basically no values and they don't produce anything. However, it turns out that cryptocurrencies are quite successful. Even though they are criticized by experts, they are used by people. And I will not, you probably know already all these figures, more than 9,000 actively traded cryptocurrencies, a total market cap of more than 2 trillion euros. Of course, Bitcoin is the biggest player, but there are others. But it turns out that cryptos are mostly used as store of values rather than payment instruments. And this is true especially in crises. In countries which are hit by a hyperinflation episode, by a monetary crisis, well, it turns out that the citizens, get protection from these cryptos. So our paper, and I should have said that this is a joint paper with Bruno Bier and Stéphane Villeneuve, is to take a standard model, a macrofinance model with informational friction, to use it to determine what would be socially optimal in terms of money creation and monetary policy, and then to compare with what a self-interested government, something I will explain in a few minutes, would do. And to show basically that, as can be expected, such a government, a self-interested government, would tend to print too much money and generate too much inflation. And the research question that we're examining in this paper is, can such governments be disciplined by currency competition? Okay, so let me start by, I'm sorry, I'm a theory guy, so I use a theoretical model, so I have to inflict some math on you, but I'll try to explain the ideas as clearly as possible. So it's a relatively simple model, but it uses a lot of math. It's a continuous time model with a government and a continuum of agents. Each agent operates a risky technology, and those technologies are independent from one another. There is only one good, actually, which can be consumed or invested. And there are financial frictions. In particular, the outputs of each individual are not observable by others, so you cannot exchange risk, you cannot trade stocks, you can only use money as a store of value. And agents allocate their wealth between productive assets and money, and governments fund public spending with taxes and seigniorage. And so there is a natural question: what's the optimal fraction of government spending that is going to be used, financed by taxes or by seigniorage? And what's the impact on the behavior of people, in particular the impact of inflation on investment and growth? So I have to explain a little bit of the model behind. It's a very standard model where agents have a discount rate row and a log utility. And so each agent considers his infinite lifetime and looks at the expected discount value of the utility of his consumption, CT. So small CT represent individual consumption, and capital CT will be aggregate private consumption. And there is another term which is not directly controlled by the consumer, which is the global public expenditures. Okay, so the consumers value individual consumption and public expenditures. And alpha is a parameter that weighs the public expenditures, and which may vary from one country to the other. So the important thing is that individual consumption varies randomly, essentially because it's an incomplete market. You cannot fully insure against individual risks. So you can partially insure by choosing some money holdings. At the aggregate level, though, by the law of large numbers, essentially, there are no risk left. So it's purely deterministic at the aggregate level. Aggregate consumption and public expenditures grow at a constant rate, in fact, in the equilibrium of this model. But at the individual level, there is risk that cannot be covered, except partially by money. So the government, of course, takes into account citizens' preferences. So the objective function of the government is the same as the preferences of the consumers. But on top of that, there is another term corresponding to discretionary expenditures that give no utility to citizens. So it's essentially, spending money on things which are useful to the politicians, but not to the individuals. And the size of this parameter, beta, measures the intensity of political failures. So there will be countries where beta is close to 0 and countries where beta is large. Now, independently of the monetary regime, we can show easily, because of this simple assumption on preferences, that the government will choose constant expenditure rates. So it will spend a fraction gamma of total capital stock, KT, on public expenditures, the ones that are useful to the consumers. And it will also spend a fraction delta of aggregate capital, KT, on discretionary expenditures. So this will not be affected by the monetary regime, the competition between monies. They only depend on the preferences of the government, and you cannot do much about it. So you will not discipline them on that. However, we focus on two other instruments, which are essentially the fiscal policy, the part of the expenditure that is financed by taxes. And here we can show that it's optimal to have a wealth tax. That is, you tax all the wealth of the consumers at a constant rate. And you also have another instrument, which is monetary policy, which is the growth of the money stock. And in this model, it's optimal to have a constant rates, both for the tax and for the money growth. So it's a very simple model. You have policy instruments, and each choice of the 4 policy instruments by the government, gamma, delta, tau, and GM, determines everything, determines the equilibrium, consumption, investment, inflation, and output growth, okay? In particular, if you look at GDP and capital growth, here it's there is no endogenous growth. Growth is entirely driven by investment. So the capital, the output, so I distinguish aggregate capital, KT, by individual capital, and the individual capital will be exogenous. It will be endogenous, I'm sorry. It will be distributed according to a log normal distribution, but I don't have time to explain. So it's an heterogeneous agent economy. And so each agent has the same expected return, except that the risks are independent from one another. So you have idiosyncratic risks. And of course, if you could pool them, you could avoid completely the risk. You could eliminate individual risk by diversification, but this is not feasible because of incentive compatibility constraint, because of the fact that individual outputs are privately observed and not publicly observed. Okay? So aggregate output in particular is deterministic. Aggregate output, GDP, if you like, is proportional to the capital stock. And if the capital stock grows at a certain rate, so GDP will grow the same rates, which is the real growth rate. In particular, the dynamics of capital here is output minus public consumption, and public consumption has 2 components, the one that is useful to consumers and the one that is discretionary, and minus aggregate consumption. Okay, sorry. So once the government has chosen the policy instruments, we have to look at the individual behavior, how individuals react in terms of investment and consumption. And in fact, it turns out that we are going to look for stationary equilibria in which the growth rate of the money stock and the growth rate of the economy are constant. It turns out that the problem can be simplified as a control problem with only one state variable. It's not wealth, it's real wealth, which is the ratio of total of the wealth of the individual by the price level. So in other words, it is as if we were taking the capital good as the numeraire, and valuing money holdings, MT, by the inverse of the price, or if you like, the price of money in terms of the capital good. Okay? So the total real wealth of the consumer is the sum of his capital holdings, KT, and the real money holdings, MT over PT. And at each point in time, there are no transaction costs, so the individuals can sell or buy capital in order to get more or less money. They rebalance their portfolio. So in fact, it's very similar to the Merton portfolio problem, except that we are talking of real investment rather than financial investments. And so there is an indirect utility, which is a Bellman function, if you like, indirect utility, which only depends on the state variable, the real wealth. So it's the maximum of the individual objective, but the instrument here are how much capital I buy, how much money I get on my portfolio. And the state equation, which determines the variation of the real wealth, are the sum of three different terms. One is the output, the production of the individual. Now remember that we are measuring wealth in real terms, so this is the real output. This is consumption, and you have two taxes. You have the traditional wealth tax, which is a multiple of the wealth at rate tau, but there is also the inflation tax, because if you keep money holdings, and if there is a positive inflation rate, your money holdings in real terms will depreciate. So the government basically determines how the taxes, the two taxes, bear on the wealth of the consumers. So in this very simple model, due to my assumptions and preferences, it's extremely simple to solve it. You have a Bellman equation, you solve it, it's explicit, in fact. And you find that the consumers consume a constant fraction of their real wealth, rho being the time discount factor. They invest a constant fraction of their wealth in capital. So at each point in time, they rebalance their portfolio to keep a constant fraction of their wealth in real terms. And the rest is invested in money. And the share X of the wealth you invest in productive investment depends on the inflation rate. Why is that? It's simply a portfolio choice equation. It's a mean variance, in fact, because of the log. It's equivalent to a mean variance analysis. So basically, the fraction X of your wealth that you invested in productive capital is the sum of the expected return on capital plus inflation. And why plus inflation? Because you compare the return on the capital, productive capital, and the return on money, and return on money is minus pi. So it's mu minus pi. It gives you mu plus pi, and you divide by the square, by the variance of the shocks. And so the important thing to note is that, in fact, this capital share, X, the share of your money that you invest in productive capital depends on inflation. In this model, at the equilibrium, the economy grows at a constant rate, which is expected return minus the public consumption rates and minus this term, which is essentially CT divided by KT. And since KT is X, it is this term X. So it shows that when X increases, the economy grows faster, and simply because there is more investment, right? So the cost-benefit analysis of the two types of investments is very simple. The agent chooses the capital investment share that equalizes the benefits of risky investment and public money. So the mu minus sigma square X is the standard thing, is the expected return minus the risk premium. And what is the minus pi? It's the minus the inflation rate. And there is no convenience yield here because you always have enough cash or money, I should say. In other words, there is no default in this model. So the only thing that you look at is the return on money as opposed to the return, the net return on investment. And so the important thing, as you can see, is that X, which is a function of the inflation rate, is an increasing function of the inflation. If there is a lot of inflation, people will invest more in the productive assets. Okay, so now how to determine the prices in this equilibrium, the price dynamics? Well, by equalizing the supply of money and the demand for money. The supply of money, as I said, is given by this monetary policy rule. Initially, you issue a stock of money M0, and then you grow it at a rate GM, okay? So there is an exponential money supply. What about money demand? Money demand is a fraction 1 minus X of the nominal wealth. It's not the real wealth, it's the nominal wealth. That is the sum of money and the value, monetary value of the capital stock. Okay? So in this equation, we know that PT grows at a constant rate, which is the inflation rate, pi. We know that KT grows at a constant rate, G, which is the real growth rate. So equality of money supply and money demand implies two things. First, at day 0, M0 equals P0, K0, 1 minus X over X, except that I put a plus to remind you that the quantity of money cannot be negative. So it implies that X must be less than 1. Otherwise, there is no equilibrium. And on the dynamic side, we have two exponential functions that depends on exponentially on time. And so they have to be equal, which means that the monetary growth rate, the growth rate of the money supply, is the sum of inflation and real growth. It's not, it's so new. You know, nominal growth is real growth plus inflation. Okay. Now, the first result of this paper is that when you have a monopoly, when the government controls completely money issuance, given its preferences, it will choose a money growth rate, GM, such that the investment share is XM solution, a unique solution of this cubic equation, where the parameters that appear are alpha and beta, which corresponds to the preferences for public consumption and discretionary expenditure. And here there is a term which depends on the volatility of individual shocks and the preference, the discount factor. But if you compare with what the citizens will do, citizens, if they were able to control money issuance, they will choose another level of X. And it's easy to see, it corresponds to beta equals 0. Because the consumers, they don't value the discretionary expenditure of the government. So there is a consequence of this political failure. You know, we talk a lot in economics of market failures, but I think it's important to discuss also political failures. Some governments do not act in the best interest of citizens. I think it's the understatement. So here, XM is greater than X star. Okay, so there is too much risk taken by the monopoly issuer, and as a result of that, there is too much inflation, because remember, inflation and X and the investment share go in the same direction. So in order to get a higher X, XM higher than X star, you will choose, the government will choose a rate of inflation pi m, which is greater than what would be socially optimal. Okay? Now, suppose beta is very large. Suppose there is a big government failure. What happens? Well, if beta is larger than this threshold here, it's easy to see that the solution of this equation here is greater than 1. But I told you that it's not possible to have a x greater than 1. What happens when x is greater than 1? Well, the citizens stop using the money. The prices of good is infinite. Well, it's hyperinflation. It's autarky. People cannot trade. They invest all their wealth in capital, but they cannot buy or sell it because there is no money. or the money is worthless. They lose a lot of their wealth. They also face high taxes. Why is that? Because two things. Such a government will spend a lot, especially on discretionary expenditures, but also the government will not be able to get revenue from seniorage because nobody wants the public money. And so the result of that, taxes are very high. And growth is severely reduced as well. So it's a nightmare, but it happens. It's hyperinflation. And hyperinflation is a big welfare loss to citizens. Question, can a private money discipline such a government? Okay, so let us introduce now. We have seen the monopoly version of money creation. Now let's look at the competitive equilibrium between a private money and a public money. In a sense, it's a kind of mixed equilibrium like the paper we saw this morning. Okay, so how does the crypto work in our model? There is a protocol that issues a certain amount of tokens. And for simplicity, I assume that the amount of tokens is fixed. I mean, I know that in reality it grows, but there is a limit, there is a cap on the amount of tokens, of bitcoins that can be issued. So here, I take it as given. So the protocol maintains a ledger that records token holdings. So it means that citizens can buy or sell the good, not only on the official market, using the official currency, but also on the unofficial or black market, if you like, or where they can use their tokens, their cryptos. And there is an endogenous price, P hat, on the unofficial market. So now the agents, they have three assets. They can invest in capital, the one that is productive. They can invest in public money, MT, and they can invest in the cryptocurrency. So they have more choices than before. So the real wealth is now the sum of three terms: capital holdings, real balances, and the real value of the tokens. And the portfolio shares that will be chosen, I assume that there are no transaction costs on either market, which is also a big assumption, but simplify the analysis. So people will adjust their portfolio shares as a function of their shocks on the price of the outputs, the wealth, how much they produce, and also the shocks on the value of the monies. So they know that the public money will depreciate at a rate pi, which will be endogenous, but the tokens can also lose their value. So there is an inflation rate. I can come back to that in a second. But the most important risk is that the crypto might crash completely, okay? Which is something that doesn't happen in our model for the government. So when you decide to invest in crypto, you balance two things, essentially. The risk of a crash, where you will lose your holdings, and the possibility to store some of your value. So people criticize the Bitcoin by saying that it's too volatile to be a store value, but it's better than nothing. You know, if you have no other possibility, this is what you will do. So what happens after a crash? We model a crash by an exogenous Poisson process with intensity lambda. So if the crash occurs, the tokens become worthless. The individual wealth falls. It was ET before, but now it's ET plus, which is the sum, which is ET multiplied by the sum of two terms. First of all, you have X corresponds to the capital investment, and this doesn't lose value because remember, we measure real wealth in units of capital. So capital is a hedge against the crypto crash, but there is also a hedge that can be provided by official money. Official money doesn't lose all its value, but it could be that the price of the good, or the value of money, if you like, the inverse of the price, changes after the crash. Why is it? Well, because before you had a certain wealth, aggregate wealth, and part of this wealth is destroyed by the crash. And so the price, since the capital stock doesn't change, the equilibrium or the capital conservation, if you like, as we call it, implies that there may be a change in the official price of the good due to the crash of the crypto. So it's interesting because it's a pure monetary phenomenon that has a real impact on the economy through this modification of the wealth of individuals. So we are looking for a stationary rational expectation equilibrium. So people form expectations on the inflation rate, on the official currency, the inflation rate or the change in the price of the crypto, on the growth rate of the economy, and they use these expectations to form their own portfolios. They optimize their own portfolios. So again, we are looking at stationary equilibria where the inflation rates are constant, which turns out to be optimal, but you could imagine that they are time-dependent equilibria, but we don't consider them. And also, we assume something that could be debated, namely that the crypto holdings avoid taxes. It's true that in some countries, in the EU, for example, you're supposed to include your crypto holdings when you declare your wealth to the tax authorities, but it's not always feasible. I mean, you're not obliged to do that, and many people use cryptos as a way to escape from the government. It's basically the main idea of this paper is how can you protect yourself against an extortive government? And one way to do that is to avoid taxes or avoid expropriation. So this assumption is consistent with the view that the crypto is a protection against political failure. So with some probability lambda, which is the probability of the crash per unit of time, you anticipate that if you invest in crypto, you will lose some fraction of your wealth, okay? And then there is an individual portfolio choice, again, characterized by Hamilton-Jacobi-Bellman equation. I skip the detail. I give you the portfolio equation. It's like a mean variance analysis. You have to decide on your portfolio shares, namely X, a fraction invested in real capital, in productive capital, a fraction B invested in money, and a fraction B hat, the rest, 1 minus X minus B, invested in crypto. Now, you maximize the expected return on your capital holdings minus the taxes, and you only pay taxes in you don't pay taxes on your the crypto holdings. This is why it's 1 minus B hat. This is per unit of wealth, this equation. You lose wealth from inflation on the official money, but also on the crypto. And again, pi hat, the inflation rate on the crypto can be negative, in which case the crypto would appreciate with respect to the official currency. There is a variance term here, like before. The new thing is this term here. With probability lambda, your wealth is multiplied by a certain factor, and this factor is this, okay? And so when you maximize this expression for the optimal portfolio choice, you will equalize the net benefits of all types of investment. For example, what is the net benefit of productive investment? Well, like before, it's the expected return minus this risk premium, which is proportional to the share that you invest in the risky asset. But there is an additional term, which is the hedging power of the capital. Because capital offers you a protection against the crash of the crypto, right? And what is the benefit of investing in the crypto? It's not very honorable, but you avoid taxes, tau, and you lose some fraction due to inflation. And the same is true if you compare public money versus cryptocurrency. If you invest in public money, you will lose due to inflation, pi, minus pi, but you will gain something because public money protects you against the risk of crash. And interestingly, it's the same term than here, except that it's multiplied by this change in prices due to the crash. And so it means that money and capital don't have the same hedging power. And so it's a bit subtle, but it's important. So I skip the detail, and I go directly to the, I don't want to bother, but it's an interesting model because you have 6 equations, 6 unknowns. They look complicated, but at the end you can solve it completely, and you find a result which is not totally absurd. So, 2 things. You have to take into account individual choices, equilibrium between money demand, money supply, both for the Bitcoin and official money. You have to take into account the government budget equation. For example, the government budget equation per unit of capital tells you that this is what you spend per unit of wealth, sorry, it's gamma plus delta, the rate of public expenditure, multiplied by capital divided by wealth, so it's X. So the expenditure here per unit of wealth is a multiple of X. You have tax revenue, but remember, you cannot tax the Bitcoin. So you only tax the official wealth, X plus B. B is a fraction of your wealth invested in money. You have seniorage, because you continue to issue your official money. So this is the total resources of the government. And it turns out that you can express them at equilibrium as something like that. Okay? So it shows, this is an important parameter, is basically the total expenditure of the government plus the money supply, the gross money supply, and it will determine the portfolio choice of the individual. But I don't want to, it's not so simple, so I go straight to the result, which is itself remarkably simple, namely that once you solve the model, you find that X is given. In other words, before, the government was playing on the inflation rate or the money creation rate in order to stimulate investment from the households, from the citizens. But now, because of competition with the private money, there is no choice. The share of the wealth invested in the risky capital at the competitive equilibrium, this is where I put XC as opposed to the monopoly XM. It depends on 3 things. It depends on the discount factor, on the probability of crash, and on the risk, the volatility of individual risks. So in particular, if the crypto is very risky, XC will be very high. And so the final characterization of the equilibrium shows that the main impact of currency competition is that the policy toolkits of the government is reduced. The government cannot anymore influence the investment share. The investment share, the competitive investment share, is given by these 3 parameters. The public expenditure rate is unaffected. You cannot restrict public expenditure through the monetary regime. The only thing you can do is modify the way in which public expenditure is financed. And in particular, the tax rate is completely determined by the public expenditure rate. This is a constant. This is determined by the model. And the government has no choice. So what's the interpretation of this equation? Here is how much you spend per unit of capital. Sorry, how much you spend per unit of capital is this, gamma plus delta. How do you finance it? By taxes, tau, and by seniorage. Except that before you were choosing the level of seigniorage. Now you cannot. Because of competition with the crypto, seigniorage is given, this term here. Particularly when lambda equals 0, suppose you have a perfect crypto that never crashes, no seigniorage. The government is restricted to finance expenditure entirely by taxes. And then inflation. Remember, before you were using inflation to influence the real investment rate. Here you cannot do that. Inflation is purely driven by money supply here. There is nothing you can do about it. Now, what is the welfare impact of currency competition? Because at the end of the day, the question we ask is whether or not it's a good thing for citizens to allow cryptocurrencies to compete with official currencies. We saw in our simple model that the main impact of currency competition is to drive down the real investment share, the fraction X of the wealth invested in productive investment, from the monopoly version, XM, that was chosen by the government. And remember, it depends on the beta, which is the measure of political failures. So if the government, if beta increases, if the political failure increases, XM will increase. And there is another level of X, which is the competitive one. And typically, it will be lower than, it is always lower than XM. Okay? So the main impact of currency competition is to reduce investment share from XM, the monopoly share chosen by the government that controls money supply, to XC, which is the competitive investment share. Is it good or bad for welfare? It depends. It depends on the ranking of XM and XC with respect to the socially optimal level. Remember, there is a socially optimal level, X star, which is smaller than XM, but it's not clear that it's bigger or smaller than XC. It depends on the parameters. So in fact, there are three cases. If XC, the competitive level, is greater than the monopoly level. For example, when lambda is very high, and when beta, the political failure, is very small. So in a country where basically things go well, the government does not distort too much monetary policy, and the crypto is not very reliable. It has a high probability of crashing. Then in this setup, no agent uses the crypto. I should say no rational agents, because, of course, one preoccupation of authorities is paternalistic, to avoid people to invest in things which are not in their interest. But I leave aside this paternalistic motive. So no rational agent will choose a crypto. So in countries where the political system works well and the crypto do not work so well, nobody will use them. So you don't have to worry. If XC, the competitive level, is in between X star and XM, then it's the Hayek case. Monetary policy, monetary discipline works. The crypto increases social welfare by providing an imperfect store of value to citizens and limiting the amount of inflation that the government would choose. So it's good for the citizens. But there is another case. If XC is smaller than X star, then the crypto hurts the citizens by restricting too much the policy toolkit of the government. When beta and lambda are small, when the political failures are small, and when the quality of the crypto is very high, if you like, for example, there is no crash, then crypto are a bad thing for citizens because they prevent the government from choosing the appropriate level of inflation. Okay, so I should stop here. Two things. First of all, if central banks the central bank is independent, then the crypto is useless, because it's very easy for the central bank to correct the political failures. That is to say, the central bank sets an inflation target, pi star, which is given by this. The government can choose any level of public expenditures. The central bank will correct that by adjusting money issuance to reflect that in such a way that the inflation target is hit. And so it's interesting to have a very simple justification for central bank independence, which has nothing to do with the timing consistency like Kidland Prescott, just to recognize that government might be self-interested. And therefore, a simple way to correct that is to give independence to the central banks. But of course, okay, so let me conclude by saying that in our model, public money and private money are endogenously valuable. There are no cash in advance constraints or money in the utility function. They are useful in the model. And the reason is that they provide imperfect, but still existing, store of values and buffers against non-insurable shocks. If the central bank is not independent, we show that it will tend to print too much money, and in extreme cases, it will lead to hyperinflation, which will severely hurt citizens. So it's a very simple argument in favor of central bank independence. However, we know that there are some countries in which central bank independence is a myth or is not possible. And then, in such countries, if central bank independence is not possible, Hayek's idea works when the cryptocurrency is not too risky, because it partially disciplines self-interested governments, and it can also provide imperfect insurance against hyperinflation. But in countries where public institutions work well, and the crypto potentially hurt citizens by restricting too much policy choices by the government. Thank you very much. Thank you. Thank you so much.
Thanks very much for a great lecture, Jean-Charles. I was wondering about dollarization, how that would fit in your model. Thank you so much.
Do I respond, Kim? Yeah. Excellent questions. I had a slide on dollarization, but I cut it because I don't have the time. So dollarization, and actually it's also work for gold in some way, because gold is also an alternative means for the savings, protecting your savings. But dollarization has a certain number of drawbacks. First of all, inflation is controlled by a foreign government. You don't know what happens in the US, so you're dependent on what the US decide. And if it's dollar bills, they can be stolen. If it's account in dollars, they can be stolen by the government. So it shows, and it's really a theme that I really like, this notion of political failures. That is, we discussed the feature of the CBDC. I believe that the features of an optimal CBDC from the point of view of citizens differ a lot according to the type of government that you have. If you have a well-functioning government, you can do a lot with the CBDC. If you have a dictator, you don't want to do a lot with your CBDC. So dollarization is a bit like that, depending. It's true that it has been used in Latin American countries a lot, but you lose one policy instrument. So if the government is reasonable, you cut yourself. You don't have a monetary policy on your own. You delegate it to the US.
Jean-Charles, thank you very much. It's a great talk. I enjoyed it.
Thank you.
I have one comment and one question. Comment is the assumption that's being made when you have central bank independence, of course, is that you have a benevolent central bank, just like you have to have a benevolent government. And I'm sure that's true, but it needs to be noted. And the second one is you challenged the speakers earlier today as to whether or not their models were actually models of CBDC. And I want to give you the same challenge as well, because I can see this story as a story of government bonds. And the government bond assets are competing with private assets, and the question becomes exactly, I think, the same question. Can this model be reinterpreted that way?
Okay, so the way in which we model crypto assets or cryptocurrencies, and I agree with you that we look at the store value, not the payment aspect, so it could be bonds, right? But the question is about the alternative assets. Can they be seized by the government in case of problems, or are they protected? And the argument of Nakamoto and peers is to say that what you have on the blockchain cannot be seized by those crazy governments. That's the difference.
Hi, great talk. Jason from UCLA. I wanted to go back to an earlier point you had in the presentation about the optimal amount of money and specifically about government discretionary spending. Of course, in the model, you look at cases where the central bank is not independent and thus is part of the government. And you look at the difference of what the citizens may want, in other terms, the citizens' optimal amounts of government discretional spending, which is zero. I believe there might be some hidden costs in what might be called optimal amount of discretionary spending, in other words, corruption. So do you believe that in a true optimal government discretionary spending amount, it might be non-zero?
Yeah, absolutely, no. Yeah, but I'm not defending this particular specification. I'm just saying that it's flexible enough to incorporate such extensions. It's relatively simple, and you can easily extend it.
Yeah, sure. It's on. Okay, sorry. So yes, I didn't see very clearly in the model. What is the kind of how does it work? The inflation on the cryptocurrency, is this chosen by profit maximizing cryptocurrencies?
No. We assume that also it's a restriction. We assume that the crypto has a very simple behavior. That is, it issues a fixed amount of tokens.
Right.
That's it. And then records transactions.
Right, but that means there is a monopoly on the cryptocurrency side, because otherwise there would be new cryptocurrencies coming in, basically creating scenarios on the older cryptocurrencies, or, I mean, there is also a literature on that this is also unstable on itself. So I think you here take a view kind of very positive of cryptocurrencies in that sense.
No, I agree with you that, again, it could be extended to allow for new entrant in the crypto market. And one thing that is missing, I believe, in our model is this notion that the probability of a crash is exogenous. I think the probability of a crash depends on a certain number of things, and it's probably a random variable. And so we plan to extend the model. But I believe that if you introduce several cryptos, we will lose the simplicity of the results. So I like simplicity.
Okay, Jean-Charles, thank you very much. I have two questions or remarks. The first is related to Jamie's question, but from a different angle. On your slide on hyperinflation, which you used for rationalizing the introduction of the crypto, you said that money demand goes to zero. So money is essentially cash in your model, so cash demand. No, it does not go to zero. It is still there. You have to be more precise. What is going to zero is the demand for domestic money. For domestic cash is going to zero. And when we look in the past, you mentioned Venezuela, Zimbabwe. What we've seen there is exactly what Jamie said, is the demand for foreign cash increases, dollars, euros, in the case of Zimbabwe, even South African rand. And that helps to stabilize the situation. That is, my question would be, can we say, then, after your slide on hyperinflation, say everything with two forms of public money?
So first of all, foreign money is a different kind of money. It's a
different kind of money.
But I already responded to Jamie that it's perfectly legitimate to put not all your eggs in the same basket and to have dollar bills, account in foreign countries, etc., etc. But this is a model, right? So in the model, we cannot take into account all aspects of reality. So I understand that it would be better to have several alternatives to official money. You're right. In practice, this is what people do. But the point I wanted to model is why those countries demand so much cryptos.
Yeah, but is this really true? That would be my second remark. What we saw is that the demand for these foreign currencies, that really happened. But what you have to assume in your model, that from hyperinflationary period onwards, from one time to the other, everyone is using cryptos and is accepting cryptos. That's what you have to assume. Yeah, okay, you say it's a model, okay, but nevertheless...
it's the next paper, and
okay.
you can do it with me if you like, but...
Okay, my apologies for my gross incompetence in keeping time. However, I've been assured by the OeNB, as all central banks, we will have a backstop and have more time. With that, I'll turn over to Peter to take the next session.
Thank you very much. Thank you.
For an excellent keynote address. So indeed, we'll go on to the next session. And my name is Peter Wiets. I work at the BIS. And I want to thank the organizers not just for inviting me, but also for putting together an excellent program, as we've just seen. Also because all of the session that's coming now, just like the previous session, has very complementary papers. So we're going to look at credit cards from a supply perspective. So who is better at offering credits, the firms or the merchants? And also from a demand perspective, so which groups in society are best in using the cards? And that's actually the one we're going to start with. So I give the floor to Carlo Wicks from the Federal Reserve Bank.
And it's always 20 minutes. Yeah, I'm horrible at keeping time, so much appreciated. So thanks a lot to the organizers for having me on the program. I'm very happy to present our paper here in Vienna. And this is joint work with Sumit Agarwal, with Andrea Presbitero from the IMF, and with my Fed colleague Andre Silva. And the usual disclaimer applies. So let's jump right in. As a general matter, when it comes to the use of financial products, then many consumers lack financial sophistication. I knew this would happen. To lack financial sophistication to make informed decisions, and therefore they often make costly mistakes. So in the context of consumer credit, for example, there's actually plenty of evidence that unsophisticated consumers, for example, overborrow on their credit cards or exhibit suboptimal repayment behavior. Now, in response to this, banks can design financial products to exploit these mistakes. And such products, they often combine salient and front-loaded benefits with shrouded and back-loaded costs. And so naive consumers, they might underestimate the costs down the road and therefore incur costs from using the financial product, while sophisticated consumers might be able to rake in the benefits while avoiding the costs, and therefore they benefit from using the product. And such products, they can therefore generate a redistribution from naive to sophisticated consumers, as shown theoretically in the 2006 QGE of Gabay and Leibson. However, empirically studying such redistribution is extremely challenging. Because for many financial products, optimal decision-making depends on hard-to-measure variables, and so it's often not that easy to determine what constitutes and what doesn't constitute biased behavior. Second, if you want to link this redistribution to individual borrower characteristics, then what you need is individual-level data on both the costs and benefits of using a financial product. So what we do in this paper is we're going to use credit card reward programs as an almost ideal laboratory to study these questions. Because credit card rewards, as we'll argue, allow us to readily quantify both the costs and the benefits of financial product usage. And so then we are going to study the following questions. So from a consumer perspective, we want to know, is there redistribution across consumers induced by these reward programs? Who exactly benefits from them and who pays for them? And what type of credit card behavior is driving such redistribution? We also look at the bank's perspective, where we want to know how banks design the pricing of reward cards and whether they profit from reward cards, and if so, how. I might take that, yeah. Thank you. Great. And then we're also going to look at the geographic implication of reward programs. And here we want to know whether this redistribution is associated with certain socio-demographic characteristics across regions. So credit card reward programs, and I assume most here are familiar with them, but they're essentially loyalty programs by banks that offer monetary benefits per dollar spent on the credit card. Reward programs are extremely prevalent, at least in the United States. So in 2019, the largest US banks paid out $35 billion in rewards. And now this means that on the one hand, consumers pay for the use of their credit cards through interest and fee payments. But on the other hand, these reward programs allow consumers to actually earn money with the use of their credit cards. And to capture this idea, the main variable that we look at in our paper is what we call net rewards. And we define net rewards as the monthly dollar amount as reward. So this is the monthly dollar amount that people earn through reward programs, minus interest payments and minus fee payments. And so net rewards capture the monetary benefits minus the monetary cost of credit card usage. And so these costs and benefits, they're likely not equally distributed across cardholders. So you have some consumers with positive net rewards that on net earn money with the use of their credit cards. And then you have consumers with negative net rewards that on average lose money or pay for the use of their credit cards. Now you might look at this $35 billion figure here and say, okay, so this is the amount of aggregate redistribution that is going on, but it's actually not true, because individual consumers can simultaneously receive rewards and pay interest and fees. And so this $35 billion figure here is not informative about the extent of the aggregate redistribution, and it's also not informative about who exactly benefits and who pays for reward programs. So what we need is individual level data on both the costs and benefits of credit card usage. So what we do is we work with the Federal Reserve's Y14M data. And so these data, they are collected for stress testing purposes, and they contain information on individual credit card accounts on a monthly basis. And the data cover about 70% of the US credit card market in terms of outstanding balances. And so we have monthly account level data on accumulated rewards, on interest and fee payments, on spending, credit card repayments, borrowing, unpaid, so credit limits, FICO scores, the consumer income, zip code, and many other variables. So this is an extremely rich and comprehensive data set that we're working with. For now, what we do is our analysis mostly focuses on the cross-section. So we chose a somewhat arbitrary month, in our case, March 2019, because we wanted to stay away from the COVID period, and we wanted a month without strong seasonal spending patterns, like, for example, December. Then we obtained the entire data set for that month. We do some light data cleaning, where most importantly, we drop corporate cards and inactive accounts. And so we are left with a cross-section of 238 million credit cards as of March 2019. So to start our analysis, we first study whether these reward programs induce redistribution across consumers across different FICO scores. And so we compare the outcome of reward cards to the outcome of very similar classic cards across different FICO buckets. So on the right-hand side here, this is a dummy variable reward card, simply identifying reward cards versus classic cards that do not offer rewards. D is a battery of FICO bucket dummies identifying subprime, near-prime, prime, and super-prime consumers based on these FICO thresholds. And then our data allows us to include an extremely rich and granular set of fixed effects. So we include interacted, so not separate, but interacted FICO percentile by income percentile by zip code by bank fixed effects. And on top of that, we include a host of card level and consumer level control variables. So let me start with an unconditional chart that I think really nicely illustrates our main findings. So these are the average monthly net rewards across the FICO distribution for reward cards, the solid red line, and classic cards, the dashed blue line. The vertical lines, they mark our threshold values for subprime, near-prime, prime, and super-prime consumers. And the horizontal line here is 0, meaning that cardholders above this line on average make money on net with the use of their credit cards, and cardholders below the line on average pay or lose money with the use of their credit cards. Now on the right, what you can also see is that for classic cards, these net rewards are always below 0, and that's of course by definition. So these cards can incur costs like interest and fee payments, but they do not offer rewards. Now on the right tail of the distribution, you can see that super prime cardholders on average make money with the use of their reward cards, and they also make money like in both in absolute dollar terms and relative to classic cards. So super prime cardholders benefit from using reward cards relative to classic cards. Now, in the left tail of the distribution, you can see that this pattern is actually reversed. So for low FICO consumers, the net rewards on reward cards are not only negative, they're also more negative than net rewards on classic cards. So low FICO consumers, on average, lose money with the use of their credit cards or their reward cards, and both in absolute dollar terms and relative to classic cards. And so this is the redistribution from low FICO to high FICO consumers induced by reward programs that we're after in this paper. However, as I said, this is an unconditional chart, so this pattern could simply be explained by the fact that consumers who hold reward cards are systematically different from consumers who hold classic cards. So that's why next we run our regression model, including our extremely granular set of fixed effects. Here the outcome variable is always net rewards, and in columns 1, 2, 3, we include different sets of fixed effects. And you can see that on average, net rewards on reward cards are about $3 to $4 or $5 higher compared to very similar classic cards. So on average, consumers are better off using reward cards relative to classic cards. However, as you've seen on the previous chart, this masks important heterogeneity across FICO scores. So here you can see that for low FICO consumers, net rewards on reward cards are on average $5 to $7 lower compared to very similar classic cards, while for prime and super prime consumers, they're on average $7 to $16 higher. And in the paper, we showed that this pattern here translates into an aggregate annualized redistribution of $15 billion, largely from low FICO to high FICO consumers. So this is a substantial annual wealth transfer. Now, what is driving this? So here we look at the individual components of net rewards, rewards, interest payments, and fee payments. And in the paper, we show that fee payments are actually less important in terms of magnitude. So here I focus on rewards and interest payments. So in the left graph, you can see that rewards are increasing in FICO scores on reward cards. And for classic cards, they are 0 by definition. So part of our redistribution is driven by the benefit margin in that high FICO consumers earn more rewards than low FICO consumers. In the right graph, you can see that interest payments are hump-shaped in FICO scores and that they are generally larger for reward cards than for classic cards. But this difference is large for low FICO consumers and fairly small for high FICO consumers. So part of our redistribution is also driven by the cost margin in that the interest payment differential is larger for low FICO consumers than for high FICO consumers. So looping back to my motivational slides, here you can see that high FICO consumers, they're able to rake in the benefits while avoiding the costs, and so they profit from using reward cards, while low FICO consumers, they likely underestimate the interest payments down the road, and so they end up paying for reward cards. So how should we interpret our results? When you look into the financial press, then you can see that these reward programs, they're often framed as a reverse Robin Hood story, where the poor subsidize the rich. So this is an article from Fox.com from 2021, where it says, "The ugly truth behind your fancy reward credit cards. America's poor foot much of the bill for credit card points, miles, and cashback." And here are similar articles. This is in Brookings and here in the Wall Street Journal. And so this interpretation could very well be consistent with our results. So if FICO scores and income are strongly correlated, then FICO scores might simply be a proxy measure for income, and this redistribution from low to high FICO consumers might simply be a redistribution from poor to rich cardholders. Our further results, however, showed that this interpretation or this mechanism is at best incomplete. So the first thing you should know is that FICO scores and income are not as strongly correlated as you might think. We do see this in our data, but there's also a paper by some of my Fed colleagues showing exactly that. So this means that in our data, we have quite a few low FICO consumers with high income and high FICO consumers with low income, and this allows us to disentangle the two variables. So what we do is we run the same regression as before, this time for 3 different income buckets. So in this graph here, low-income consumers have an annual income of below $44,000, middle income $44,000 to $79,000, and high-income consumers above $79,000. And in the right graph of the distribution, you can see that this is probably what you would have expected. On average, high FICO consumers with high income are the ones that benefit the most from reward programs. Now, in the left tail of the distribution, you see what you might not have expected, because the consumers who end up paying the most or have the most negative net rewards are also high-income consumers. So high-income consumers with high FICO scores have by far the most negative net rewards. This might be surprising, but if you think about it, it actually makes sense. So these are consumers, they have a lot of money, they can spend a lot. However, they tend to not pay back their balances in time, so they end up with high interest payments and and high negative net rewards. So this is average net rewards, and now you might ask how this translates into an aggregate redistribution, because while FICO scores and income are not strongly correlated, there are still more low FICO consumers with low income than low FICO consumers with high income. And so therefore, in the right-hand graph, we plot the aggregate net rewards across the FICO buckets, and you can see that also in aggregate, high FICO consumers with high income benefit the most from reward programs. But in the left tail of the distribution, you can see that aggregate net rewards, they're roughly of similar magnitude for all income buckets. And so this is also not really consistent with the reverse Robin Hood mechanism, in a sense that it's not only low-income consumers that end up paying for reward programs, but it's all low FICO consumers across all income categories. And again, so these results, by the way, so also these results here and these results, I'm just showing you the graphs, but they also hold in our regression framework. So if it's not a reverse Robin Hood mechanism, or if income is not the main driving factor behind our results, then how else should we interpret them? So we have this redistribution across FICO scores. Oh, 5 minutes, okay. And FICO scores, they're largely based on outstanding debt relative to available credit and on a consumer's payment history. And so this means that low FICO scores are largely capture the same type of credit card behavior that was found to be associated with the lack of financial sophistication, namely over-indebtedness and suboptimal repayment behavior. And so therefore, there's actually quite a large literature that uses FICO scores as a proxy measure for financial sophistication. And so next, we want to know whether we can also interpret our findings in terms of a redistribution from naive to sophisticated consumers. We do a bunch of things in the paper. So here I'm going to focus on overspending and overborrowing. If you look at these personal finance blocks, then you will find a lot of anecdotal evidence that reward cards might induce some consumers to overspend and subsequently to overborrow under credit cards. So this is an article on Finder.com where it says the potential for travel perks, cashback, and bonus points could cause you to spend more than normal, potentially resulting in high fees and interest on those purchases. And here, similarly, on Nasdaq.com, it says, if you find that you're consistently overspending in the hopes of getting rewards, it may be time to stop using credit cards until you can train your brain to think differently. So there is some anecdotal evidence that this is happening. However, empirically studying this, I mean, is extremely challenging. So the ideal experiment would be to kind of randomly assign a reward feature to a non-reward card and then trace spending and borrowing over time, which is unfortunately not a feasible approach for us. So what we do instead is we borrow from the credit card literature and we study the differential spending and borrowing response to an increase in credit card limits and therefore an increase in credit supply. And so the differential response between reward and classic cards. And there's one feature in our data that makes this approach very appealing, which is we can distinguish between credit limit increases at request of the borrower, which we drop because we want to rule out like an increase in spending or like a credit limit increase in anticipation of higher spending. And so we only focus on bank-initiated credit limit increases. And then we look at cards that have a credit limit increase in March 2019 and look at the 6-month time window before and after the limit increase. Here's what we find. So in the first row, you can see that an credit limit increase on credit card rewards induces a higher spending response, but also more repayments, but also higher unpaid balances, so higher borrowing than a credit limit increase on classic cards. Again, there's substantial heterogeneity across FICO scores. So if you only look at spending, you can see that the differential spending response is stronger for all FICO buckets. So not only for low FICO buckets, but also high FICO consumers exhibit a stronger spending response on reward compared to classic cards. However, for high FICO consumers, for example, in the bottom row, you can see that this increase in spending goes hand in hand with an increase in credit card repayments. And as a result, we do not find a significant increase in credit card borrowing. On the other hand, for low FICO consumers, we find that this increase in spending is not matched by an increase in credit card repayments. And so we find an increase in unpaid balances. And so these results are consistent with the interpretation of FICO scores as a proxy measure of financial sophistication. Okay, 2 minutes left. So let me rush over the bank perspective. Here we look at pricing and profits. Pricing is pretty self-explanatory. The profit function, so the black terms here, they are simply the inverse of rewards from the net rewards from the consumer perspective. but we also add interchange income. We add realized charge-off as kind of like a measure of ex post realized credit risk, and we ask the cost of borrowing. In the left graph, you can see that, unlike what you might have expected, interest rates are systematically lower on reward cards compared to classic cards. This also holds in our regression framework. And so we take this as evidence that banks incentivize consumers to use reward cards relative to classic cards. Why do they do this? Because they profit from reward cards more than from classic cards across the entire FICO distribution. And coming to the analysis of geographical heterogeneity. So here we plot net rewards across counties in the US. You can see there's substantial heterogeneity with darker values indicating higher net rewards in the Northeast and on the West Coast and here in Florida. And you can see that also in the aggregate, this maps extremely well into average credit scores across counties. So what we do is we regress net rewards on variables that we don't have in our credit card data set, so we only have them at a geographical level. And we find that, except for income, but we find that net rewards are higher in counties with a higher education, with on average higher income, and with a lower black population share. All these results, by the way, vanish once we control for the average FICO score in each county. But this doesn't change the fact that in a descriptive sense, these reward programs induce a redistribution from less to more educated, from poorer to richer, and from high to low minority areas, and thereby likely exacerbating existing socioeconomic disparities. Thank you very much.
So let's now give the floor to Mats Kuster from Central European University for the discussion.
Thanks a lot. Same disclaimer as last time I discussed a paper at the OeNB, or at an OeNB conference. I'm not an empiricist, so I'm almost surely not your referee, no matter where you're gonna submit this. So what I will try to give you is a slightly different perspective on the paper, and let's see whether this is useful or not. Okay, so let me start with a very brief summary. Motivation of the paper, and that's where more of my expertise comes in, is that theory suggests that sophisticates in these financial settings often benefit at the cost of more naive consumers. And the typical model in this literature looks at an equilibrium where banks set up credit contracts in such a way that naive consumers will overestimate how likely they will gonna repay on time. Then on the equilibrium path, they will not end up paying on time, so they incur unanticipated interest that in a second step allows banks to compete more heavily for sophisticates by lowering fees, like annual fees for credit cards, potentially introducing rewards. So the kind of redistribution we are talking about is, in essence, an equilibrium object. Okay? At the same time, there's little evidence on the magnitude of such redistribution, so it's great that you have this nice of a data set and that you start looking into this in detail. So the way I took your question from the paper, and this might have slightly changed from the version that I got, that is December last year, is how do reward credit cards, so the fact that banks can offer these rewards to consumers, how does this contribute to the redistribution between naives and sophisticates? So the kind of intuition that one might have is that where reward cards increase borrowing overall, they make borrowing more attractive because I get something back on the money that I spent. And then sophisticates keep repaying what they borrow. They try to avoid these interest payments. Naives do not increase repayments, so they end up spending more. Okay? So what the paper does in the end is it uses a proxy for the consumer's naivete, the FICO score that they have, and then they compare borrowing on very similar cards with and without rewards, and the headline figure is an annualized redistribution of around $15 billion per year. Okay, so let me start by thinking a little bit about what the question is that the paper is answering, and what the question I thought they would be answering after reading the introduction. So just reading the introduction, hearing all the talk about redistribution, I thought a natural policy question would be something along the following lines. Should we ban the use of reward cards? So should we prevent banks from giving these rewards to consumers, and how would this affect the outcome of different consumer types? So if I would want to answer this question, I would start looking at what would be the equilibrium in a setting where I have the ban in place. Right? So that means that we only have classic cards that don't have any rewards. So in this kind of setting, redistribution would happen via something like annual fees. I could still compete for the sophisticates, there could be still some redistribution. I'm just not allowed to use the additional tool of rewards. Now, if I allow for reward cards, that would probably result in a different equilibrium where we have potentially both types of cards. And if we have both types of cards, we would have redistribution across different channels, potentially via annual fees, potentially via rewards. And then we would want to compare the outcomes of different consumers in these two types of equilibria. So naive as I am, I started writing down a model and tried to solve for these equilibria. Turns out that is not as straightforward as you would think. Then I started talking to my co-authors, Paul Haitus and Boton Kusegi, who wrote some of the foundational papers in the literature, and Paul was saying, like, yeah, if you are getting rid of the reward stuff, you can be happy if selection goes in the right way, but it is far from obvious how the equilibrium would look like. So I think there's potentially a theory paper in this in itself. So I wrote down a little bit of what would lead me to an equilibrium, and what I can tell from this is that it's not clear at all that classic cards would look similar in the two equilibria in terms of interest rates. It's not clear that classic cards are otherwise similar to reward cards. So other features of these credit cards will almost surely change as well. And selection into different types of credit cards will be key for welfare. So that's almost immediately clear. So now how does this compare to what the authors do? Well, the authors compare reward cards to very similar classic cards, and you try to control for selection into different cards by controlling for consumer characteristics. So in this sense, the question you are answering, which is an interesting one, is quite different from what I thought the question would be. So the kind of experiment that you have in mind is, what happens if I randomly assign identical cards with and without rewards to consumers? So that feels more like a question of over-borrowing and not necessarily one of redistribution. Again, there's nothing wrong with the question. I think it's an interesting question. It just feels like it's slightly different from what the motivation was in the introduction. Okay, so let's take this question as given. So I think it's an interesting one. And again, it's not completely obvious what I would expect. So let's try to think through what we would expect to find. So this is a very simplistic model of credit card borrowing. The consumer gets some utility from consumption. There are some rewards to spending more money. And then I have to repay the money that I'm borrowing. If I don't pay on time, I have to pay some interest. How much interest I pay? Well, I have some belief over that. Let's call this P hat. Now, in the spirit of the literature, let me think of a naive consumer as someone who underestimates the interest he or she is going to pay. So P hat is less than the P that actually occurs. So one might argue that having a positive P is a mistake to start with, but in the spirit of the literature, let's ignore this for a second. If I do this, I can define, there's a well-defined term for overborrowing, how much more I spend for a given P if I believe that my interest is lower. And then it turns out, if you look at this, it's not even clear that credit cards or reward credit cards will amplify or mitigate overborrowing by naives. Turns out, if you do the math, this is a condition on the third derivative of the utility function. If the consumer is prudent, so the positive third derivative, it will amplify overborrowing. If not, it will mitigate. So I think there's on some level that's good news, because this means in the end this is an empirical question, validating the exercise that you are doing. And it also tells us a little bit about what we can learn from the kind of exercise that you have in mind. So in the end, it is kind of testing, if you're willing to go with this simplified framework, something on the consumption utility function of consumers. Okay, so let's try to move a little bit closer to an equilibrium, because that was the kind of question that I started out with, so I wanted to think a bit more what we learn here. And let's consider a consumer who's choosing between a classic and a reward card. Okay? So cards can have different interest rates, different annual fees. There's no reason to believe that they have the same. Taking my model seriously and doing a little bit of algebra, in particular using the envelope theorem, what you get quite immediately is that naives should select into the card where interest charges will be higher. Okay? So all else equal, we would expect naives, if they are really selecting between these cards, to end up where interest charges are higher. And then empirically, if I read the figure correctly, that should be reward cards in this setting. Now, at the same time, that was from the descriptive evidence in one of the earlier sections, cardholders of reward cards have on average higher FICO scores, which doesn't really sound like naives are selecting into reward cards. It more sounds like they are selecting in the other type of card, unless the FICO score is overall not a great measure of naivete, and that's something I have no expertise to judge. I found your discussion quite convincing in the paper, but it's not my strength. But so let's take this as given, so something else seems to be going on. So maybe it is firms trying to push naives away from reward cards. Maybe they don't even put it on the table for some kind of people, so they can't really choose them. And it would be interesting to understand if that's going on, and if so, why. Okay. Although I'm not an empiricist, let me have one word on identification that is related to the last point here. So maybe it is firms that are trying to direct consumers to borrowing on some card rather than another. So the main identification in the paper seems to come from these bank-initiated credit limit increases. And so at first I found this quite convincing that, well, if I increase your limit on a credit card by, say, $1,000, that is almost as if I give you a new credit card with exactly that limit. So that sounds great. But then thinking a little bit more, in particular about this last fact here, that it might be firms directing consumers into certain credit cards, it's not immediately obvious to me why these bank-initiated limit increases are random, right? And maybe I overlooked it, but I didn't really find a long discussion on who is getting these limit increases. Do they look similar on reward cards and on classic cards? So in particular, one question I would be interested in is, was the old limit binding? And is this the reason why the bank decided to initiate this limit increase? Was it more binding on reward cards rather than on classic cards? So that feels like important stuff to take into account if we really want to give your estimates a causal interpretation. Okay, so these are the main comments. Let me close by saying that I think this is a really, really impressive paper in that I haven't seen anything as comprehensive as the data set you have, and I think the descriptive results alone make for a good paper. I'm a little bit more hesitant on the causal stuff, in particular whether it is answering the right question, the one that we are most interested in, but the descriptive stuff is great. At the same time, it's a bit overwhelming. So you have so many different results that at some point I was reading, okay, there's another section. Now we are doing the geographical distribution. I was already at the limit of what I could take in. So in terms of writing a little bit more guidance on what are the results that are most important, how I should interpret them, and maybe starting earlier in the paper telling me in which direction this is going. But overall, I enjoyed reading this. For someone like me who has no idea, a little bit more information on what is measured and how it is measured would also be useful, but this is more like minor details.
So maybe let's first take questions from the audience here, and then if you want to also address them.
Should I respond right away to the, or first the question?
Yeah, first the question,
okay.
then you can maybe integrate it.
Okay, yeah.
Hi, so if you were to write down a competition model, you would see that the zero profit condition would have to apply individually, separately, observable group by observable group. Like the banks would have to compete over the low FICO and the high FICO customers and obtain zero profits independently in the two markets. So my question is how you can say that one group is subsidizing another. To me, if there's high profits in one group because that group is maybe behaving very badly, we should just say that maybe there's less competition in that group. And it's not clear to me how it can be said that one group is subsidizing another when they are observably different and should have their own separable zero profit conditions.
Yeah, thank you very much. That's a great question. I'm going to combine this with a question, one of your comments. So I fully agree what you said, that writing down kind of like a full-fledged structural model, doing welfare analysis, counterfactual analysis is really what would take the paper to the next level. We have consciously decided to not go there for now. As you said, the paper is already long enough as is, which is also, it is around since a while. We have got many comments and, you know, like it just adds up after a while. So how we think about, we almost like backed off from the term cross-subsidization a little bit, which we had initially, because I agree it's not crop subsidization in the strict sense of the word. So we say redistribution now, and how we think about it is kind of like this, you know, pool of money where some consumers pay in and other consumers take out money. And so also I want to say the title, Who Pays for Your Rewards, is a bit of a clickbaity title to make the paper more interesting, since in some sense you can say like any form of bank income, since money is fungible, could be interpreted as like paying for rewards. But we think it makes sense to compare like just like within this market, like within this credit card market, the income that the banks get through interest and fee payments, where does that come from, and who takes out the money in terms of rewards. Like who pays in to that pool of money coming from credit card rewards for the bank, and who takes out the money. And that's kind of like the redistribution that we're looking at. But yeah, I agree, it's not like cross-subsidization in a strict sense of the word.
So I guess I had a comment and a question. So you're interpreting that the FICO score is something about naivete, but these are also used for insurance, and you find that people with low scores are more likely to get in car accidents and burn their house down and stuff like that. So that feels more like responsibility, so responsible people pay on time, they also drive safer and so on. And then the question would be, like the CFPB right now is thinking about putting a calculator online where you can compare different cards and see what you should buy. So could you use the data you have or the model you have to try to predict what card or what type of card would be best for consumers?
Yeah, so when it comes to the kind of like that we consider FICO scores of a proxy measure for financial sophistication. So we have a discussion on that in the paper, and we're essentially fairly agnostic about where this lack of financial sophistication comes from. Could be a lack of education, a lack of, I don't know, mental capacity in some sense, or as you said, kind of like just like irresponsible borrowers or like myopic borrowers. So how we define financial sophistication is such kind of like an inclination to make financial mistakes. Like well-defined financial mistakes. So we have this analysis on overborrowing and overspending. We have another analysis that I didn't present here on suboptimal repayments, where we also show this correlates with FICO scores. So yeah, we're agnostic about where financial sophistication comes from. We just, in a very broad sense, identify it as like an inclination to make well-defined mistakes when using financial products. And sorry, that was on your comment. What was the question? Yeah. Yeah.
Where you can compare different cards and evaluate what's best for you. So I don't know if you could use your data, your model to predict what card people should get.
Yeah, so I'm not aware of that calculator. I think that's super interesting. Maybe we should. Yeah. Ah, okay. Yeah, I would be very interested in that. In principle, I want to say yes, we probably could do that. Like what card is ideal for you in terms of your spending and borrowing response, or like a spending and borrowing behavior. It's not something we have done yet, but I like the idea, yeah. Maybe that's just one thing. I wasn't sure if I understood that correctly. One of the comments you made early on was that reward cards yield a higher benefit of borrowing. So that's not how I think about it. I think it yields a higher benefit of spending. Like this kind of like these two features of a credit card. It's on the one time it's like a payment device where you spend money on. And if you spend a lot of money and then immediately like pay it back and like never borrow on your credit card, then reward cards are definitely the right thing for you. If you don't do that, if you actually use it as a borrowing device and possibly like borrow more than you initially want to, then it's not the right thing for you. And this would go back to like predicting which card is right for you. Yeah.
I think in the interest of time, maybe to move on, because otherwise we go too far in the coffee break. There's no coffee break anymore. So
I'm happy to answer any further questions.
So thanks a lot then.
Thank you so much.
Thank you.
Okay, so we move now to the supply side of the market. So what I learned from the paper already is that there was a time when merchants were giving a lot more credit than they are today, and that you can even use the yellow pages to get some data. So I'm very interested to hear your talk by Joseph Hall. Thanks.
Thank you so much. Thank you so much to the staff, the incredible AV staff, Kitchen, the organizers of this event, and especially to Kim Hyun, who loved this paper so much, he's flown me out twice now. So this paper is about historical evidence from the United States about really the time when these big monopolistic credit card networks came online and quickly shifted the equilibrium from one of store lending to an equilibrium of bank lending. I'm currently at the Georgia Institute of Technology, but this paper was written while I was at Stanford. So my question here is really, have credit card networks benefited retail firms? And we might think that they might or that they might not. Retailers constantly complain about these high fees, but they say we're basically required to accept these cards anyways because of sort of demand steering motivations that happen within the credit card market. So I'm going to take a very empirical approach to this, one might say reduced form approach to the main question, and then layer on a structural model where I think about the mechanisms underlying these effects. I'm going to document that banks have replaced retail firms as suppliers of short-term consumer credit in the US since 1958. I will show you a natural experiment using an unexpected regulation that occurred in 1978 to causally identify the effect of increased bank credit card use on firms' profits and net entry. And then I'm going to use a structural model that I fit to firm-level data using new data from Yellow Pages to answer questions like, what determines firms' choice of whether or not to accept bank credit cards? How large is this net cost reduction that they get from using bank credit cards instead of doing this activity on their own? And then how much do these credit payment options affect consumers' choice between retailers, which drives effectively how much these credit card networks might be able to extort retailers? I find that it's not that much is needed to explain the data. And my main finding is that with all of these bells and whistles, at the end of the day, it's just a cost reduction. Labor costs, administrative costs, and the price of risk are all lower for banks compared to retail firms, and this is all that's necessary to explain the main results that I find. So for historical context, back before we had bank credit cards, Americans were carrying around a dozen or more different forms of credit. They would have a different card in their wallet for every store that they shopped at. And so when the Bank of America salesman walks around Fresno, California in 1958, convincing these retailers to accept the bank credit card, it was the smaller merchants who were the most willing to accept this new bank credit card because it was the hardest for them to run this thing in the back of their offices. For example, this man that the Bank of America salesman went to was sending out monthly bills for as little as $4.58. Now that's about $46 today. But still, that's quite a small amount of money to be incurring a large labor cost and a large accounting costs over. So the bank, on the other hand, will give this merchant the money that he's owed immediately, as opposed to the merchant having to worry about how to collect it over the course of many months, and charged a merchant discount fee of 6%. and the retailer is so happy with this he's kissing his feet. Mind you, the Justice Department just sued Visa over network fees less than a tenth as big. And all of this 6% is going to Bank of America. Credit card rewards would not be indented for almost another 30 years. So this is entirely a fee that's paid to the bank. Additionally, the acquirer, the network, and the merchant bank are all the same bank, Bank of America. So we're talking about a completely monopolistic network that's allowed to set as high of a fee as the market can possibly sustain, and asking if that can still be good for retailers or not. Now, why might firms not benefit? We've already discussed sort of the classic Rocher and Tirole type reasons. These networks might be able to charge more than they save in real costs. In particular, if the real costs that they save are zero and all the payment methods are equivalent in terms of their efficiency, you might be able to charge a high price if that gets consumers who are on the network to shop at your store instead. This is sort of a prisoner's dilemma type of situation. All of the merchants would prefer that none of the merchants pay the fee, but some of the merchants start paying the fee to get more customers. Now all of the merchants have to pay the fee, and they get the same customers as before, and now Bank of America is taking a cut of the profits. So if that's what's going on, retail firms will not benefit. Another reason, which as far as I'm aware is new to the literature, is that interoperable credit cards may make firms better substitutes for each other and force them to lower prices. If these different credit methods that go store by store further differentiate these stores from each other, and it, for example, takes a friction to open a new card at a new store, customers are going to be more locked into the store that they patronize, and they will have a harder time substituting between stores that will allow stores to raise their prices. So I have a simple accounting decomposition and a first-order Taylor expansion for you. This is something that has to be true for the definition of profits and the definition of revenues, that the change in firm's profit rate has to be attributable to a change in cost and a change in markups. So let's say that these retail cards are saving firms money on net. That will be good for their profits, but if it's forcing them to lower their markups, then it's going to hurt their profits. And so at the end, I'm going to create a structural model that basically estimates these terms individually. And what I end up with is the markups change very little, costs go down a lot, and the profit rate goes up. That's basically the punchline. So I'm going really quickly through this roadmap. I'm going to show you some aggregate trends. Then I'm going to identify you some real effects with the natural experiment. And then I'm going to get into the mechanisms with the structural model, and I hope we'll have time to do that. So in the literature on credit expansions, I'm providing the insight that formal credit can crowd out informal credit, which is something to keep in mind when you're calculating how much credit there is and whether growth in credit is good or bad. I'm causally identifying a specific credit boom. In this case, credit cards were able to explode due to a specific technology, which is the verification of accounts and the validity of those accounts at distance and scale. This is closely connected to a literature on trade credit, where people focus on, okay, if firm A sells to firm B, firm A is a more efficient provider of credit to firm B because of their connection. On the other hand, when firms are selling to customers, they're actually particularly poor lenders to those customers, because at the time that those customers face an economic shock, they stop buying at the store at the same time as they default on that store. So due to that correlation, retailers are actually the least efficient holders of their own customers' credit risk in the economy. And finally, to the I/O of payments, which is of great interest to this group, I'm going to give you a quantitative comparison of a very inefficient competitive network with a more efficient monopolistic network. Now, I know we all want to know, what about an efficient monopolistic versus an efficient competitive network, but history has provided me with no such great example of such a comparison. So the data sources, I'm using many, and I'm adding a new data source here, which is these yellow pages. So I went to the Library of Congress and found all of these scanned, incredibly good PDFs of yellow pages identifying establishments all over the country, and I focus on the 1970s, which is the time of the natural experiment. And MasterCharge, which would later become MasterCard, as well as Bank Americard, published lists of merchants who accept the card in each location. And both they and the merchants have a high incentive to make these lists as comprehensive as possible, because the banks want to show that this card is accepted broadly at many merchants, and merchants want people who hold these cards to know that their card will be accepted at that merchant. So what this allows me to do is to go town by town and basically separately identify the effect of this shock that I'm going to show you on the firms that are already accepting the bank credit card and that are not already accepting the bank credit card, and then match those responses of sales at those two places to what the model suggests to identify the model. So in aggregate trends, we can see from the survey of consumer finance, this is the chart that I first made and noticed, okay, maybe we have something here. Spending on store cards has gone down since 1970, while spending on bank cards has exploded. At the same time, we can look from the firm side, not just the consumer side, and observe that it used to be the case that retail firms, this is the red line, these are firms that sell to consumers, used to have 30% of their revenue as receivables on their balance sheet. Receivables are money that you are owed but have not yet been paid. That's down to about 10% today. This has not been mirrored by an intermediation in the wholesale trade market. These are firms that sell to other firms. So firms that sell to other firms seem to be efficient creditors to each other, whereas firms that sell to customers are very inefficient at being lenders to those customers. Furthermore, these labor costs that firms used to be incurring to do lending activities were very high. 4% of the aggregate wage bill of the entire retail sector in the country was being spent on bookkeepers and bill collectors. And that has basically vanished today. And note that this is a lower bound on cost because you also have to consider the time value of money as well as the default rate, which for Bank of America was actually 20% on this program when they were first rolling it out. Now, to identify the causal effect is very difficult because I'm looking for an effect on the equilibrium of a group of firms. I can't do something like bankruptcy flag removal, which would tell me how much consumer A is affected relative to consumer B. I need the effect of one town where everyone gets credit cards and another town where people don't. This is very difficult to do, but in 1978, there was a Marquette decision by the Supreme Court which affected the cross-section of states, which is ideal for this purpose. What happened in 1978? Well, the Supreme Court ruled that banks can lend across state lines at the home state's maximum legal interest rate. So banks located in deregulated states expanded lending to consumers in regulated states, and some states removed their usury limit entirely, set it to infinity to attract bank headquarters, attract jobs, and those banks could now mail high-interest credit cards to citizens of any state in the United States. So effectively, we ended usury regulation nationwide overnight without the Supreme Court quite realizing that that's what they'd done. And this differentially affected different states. So in Arkansas, you could only lend at 10%, but in Nebraska, you'd always been able to lend at 21%. So these states that previously had been extremely tightly regulated very suddenly saw much larger increases in the supply of bank credit cards than other states. So that creates the variation in the cross-section. It was unanticipated. And it just happens to be very nicely uncorrelated with other decisions that state legislatures were making at this time, which are summarized by a very convenient index by Mian Sufi and Werner. Secondly, this is very relevant. So if we look at what interest rates credit cards actually had on them in 1977, we see lumps, we see bunching at 10%, 12%, 15%, and a massive bunch at 18%. After the regulation, after usury regulation was effectively ending, this bunching at the very low rates almost goes away entirely, and we see more credit cards creeping up above this old 18% limit, which had been almost sacrosanct. Secondly, these usury rates were very binding. You might think 18% is very permissive in the context of zero inflation. Inflation hit almost 15%. in 1981 in the United States. So when an inflation rate is right up against the usury rate, this usury regulation is going to be very tightly binding. So there's a binding constraint that went away very suddenly and was much more impactful on some states than others. And we see this in the aggregate growth of credit card lending. Over here, what we're seeing is card lending as a fraction of GDP. And we see that it is basically flat for banks that are headquartered in states that did not remove their usury rates. For states that did remove their usury rates, banks headquartered in those states drove basically the entire tripling of card lending as a fraction of GDP. So we have a very beautiful setup with a single time difference in difference estimate. We don't have to worry about staggered timing because it's all happening at once. And Zinman has already found that about 5.5 percentage points more people in the treated states, those that were very restricted before, more so than in the untreated states. So there's a much bigger growth in bank credit card use in the states where the regulation was very tight than in places where the regulation was very loose. So the first thing that I find is that firms that did more sales in the treated states reduced their fraction of receivables to revenue more. And that goes by about 3%. So it's about 3% reduction in lending for the stores that did more of their sales in the treated states. And their profits are higher by about 2%. Now, this is not a great regression. I have very unimpressive standard errors in an N of 185, which reflects the scarcity of accounting data for firms at this time. So I find a much better regression to do, which solves a couple other problems. First of all, consumer credit cards can increase aggregate demand or aggregate supply in ways that are not the subject of interest of this study. GAAP net income might not be a great measure of economic profits, and there's not very many firms that have public accounting data in 1977, and I don't want to be restricted to studying large firms because I believe this effect should be largest for the smallest firms. So I use the census county business patterns, which gives me count of firms by SIC code, by establishment size, and I difference out the general equilibrium effect and get this beta 2 coefficient on the clothing industry. And we see the clothing industry is, according to the SCF, as well as according to the telephone directory, the industry where credit cards are used to make transactions. So the general equilibrium effect should affect all industries, but the transaction benefit effect should occur in the industries where the transactions are taking place. And what we see, more firms with less than 20 employees, we see net entry, so fewer failing, more entering. More firms overall, and a higher fraction of them are small. So secondly, we also see which firms are accepting bank cards, firms that are doing more volume or more willing to become early adopters. However, single establishment firms are about 4+ percentage points more likely to be early adopters, which speaks to the importance of this geographic risk that I was talking about. Secondly, in the treated places, firms that already accept see actually slower growth of sales, but more survival. And that combination of results is really only consistent with lower cost, if you're able to survive longer despite having lower sales. Secondly, I compare the reactions of the failure rates of these firms during 2 recessions, one which was after and which was before Marquette. And I basically find that a 2 percentage point delta in the survival rates of small firms in the treated states during the recession and higher so in the higher adoption industries opens up post-Marquette that was not there pre-Marquette. So smaller firms, especially single establishment firms, especially in the clothing retail industry, are more resilient to shocks, which is what this risk mechanism was predicting. So what am I going to do in this model? I'm basically going to estimate this equation, and I'm going to have these 2 effects. Cost it might be going down if the merchant discount fee is less than the cost they were spending in-house, but also they might have to lower their prices if they become more interoperable. And why are they becoming more interoperable? Well, this is what we're basically going to do in the model. So we're going to have firms basically compete over customers who have a utility function like this. They care about price, they care about a fixed effect for each firm, and then they care about what credit card the firm accepts. So if all firms accept a common credit card, all firms get the same draw from this distribution, and they're not very differentiated. Whereas if all firms have their own separate credit card, they're much more differentiated, and they effectively are going to have to compete harder and lower their price. And that is the mechanism by which it could be possible in this model for firms, even if they're saving money on the actual credit function, to have lower profits if they're required to lower their markups. So these firms are going to optimally choose their price. Each firm has a level of quality that is fixed. And then the consumer has a taste for the firm that's driven by the taste for the credit product and a taste idiosyncratically for the firm. Sigma governs how big this is, and that's a free parameter. And I'm going to let this vary, and I'm going to estimate it from the data. So basically, what's going to happen is I'm going to simulate the effective market. More firms join the network, more consumers use cards, and now their costs of these firms are going to be changing, but also their differentiation is going to be changing. And so I can observe many of the parameters I need directly from the data, and I use method of moments to match basically the parameter for card taste and parameter for card costs. I match these moments of the data on how much these shares as well as the sales of these firms are changing. And I find basically that about 7% of all the variation between the firms can be attributed to a taste for the method of payment, which is pretty small and has a pretty small effect on markups, where we see basically, I estimate that the markups are going down by about 9 basis points, but the costs are going down aggregate by about 57 basis points. And note that that's mostly accruing to the relatively small, in this case about 20% of the firms that are accepting the bank credit card are making up this aggregate 57 basis points cost increase. So regulators, how does this apply to regulation? I have like less than a minute, right? The UK, merchants are very politically sympathetic, so people want to exempt them from regulations of lending. However, that runs the risk of pushing the credit function onto the retailers who are the less efficient holders of the credit risk. So that is the risk that regulators face when they're trying to help retailers. They might push credit risk onto retailers. Secondly, the United States is far out to the right in terms of credit card ownership, but there's a lot of countries, especially developing countries, that are still really relying on store credit, and financialization might bring them down into the right. So studying how this transition affected the United States is relevant to thinking how this future financialization might affect these firms as well. So thank you for your time so much, and please find me on social media and GitHub, and I'll can't wait to see the discussion.
Okay, let's give the floor to the discussant. I lost my program here, but okay. Correctly, from the University of Vienna.
So thank you very much for giving me the opportunity to discuss this interesting paper on credit cards and retail firms. And to start with the summary, so first of all, I very much enjoyed reading the paper and having a look at this, I think, very large amount of data collection. And I think a lot of effort went into this data collection. So the research questions are, why have bank credit cards become the dominant form of retail payment in the US? And who benefited from this transition? So which retail firms benefited, large or small ones? And in a sense, what does a new technology that basically takes away work from small firms, how this benefits them? And in particular, the paper has two parts, roughly, in the sense of providing empirical reduced form evidence using a Supreme Court decision as an exogenous shock to the retail sector. And also, this provides then causal evidence often on the credit card supply on outcomes. And the outcomes are lending to our customers, profitability, entry, exit, and sales. And profitability, in the sense, is measured by two things, like from accounting data, but also using net entry, like in the sense of that we think that the survival of firms is, at least you have to have positive profits. The second part then decomposes the changes in profits into changes in markups and in changes in cost. And this is then the structural models. So why is this interesting? I think, first of all, it contributes to the literature of analyzing merchant credit. So in a sense, whether I provide this by myself as a small firm, so by vertical integration versus outsourcing, also in a sense for whom it is more profitable, larger or smaller retail firms. It also contributes to the literature on adoption of new technologies and its effects on profits in the vertical chain. I think it also, in the sense of competition economics, so we have here, in a sense, a winner-takes-it-all logic. So in a sense, one credit card, so it's not the store card that survived, but the credit card. So we have competition for the market versus competition in the market. And also, you also mentioned this earlier, that there's a recent case also now going on in a lawsuit against Visa. So how did the technology adoption work? So we went from store credit to credit cards in the US. So we saw the overall trends. So we saw, in a sense, that credit card spending, bank card spending went down, credit card spending increased. Also, the fraction of cards from stores went down. And what we see is that we had regulated and non-regulated states in the US, basically depending on what is the maximum interest rate that you can charge. And this is then also used as an exogenous shock when there was the Supreme Court decision that relaxed these maximum interest rates. We also saw that in the general trend, the labor cost for store cards went down in the sense of the bookkeepers and bill collectors, the numbers that have been employed went down. And we saw then later already, in a sense, justifying the counterfeit or the exogenous shock, we see higher credit card growth in deregulated than in regulated states. And this was, in a sense, the historical context that after this Supreme Court decision, that bankers and state legislators reacted, and basically by 1983, 14 states had removed their usury limits, and this led to an unexpected deregulation of the maximum interest rates. Before heterogeneously regulated states became, in a sense, a national geographic market, and so we have an exogenous shock to the supply of credit cards. And then using the data that has been collected from various sources, the paper estimates then the effect of lending technology on store profits, also measured by entry, and also having then a look on how can we decompose these changes in profits to changes in markups and changes in cost. The empirical strategy is a standard diff in diff. I think, in a sense, what we see a two-way diff in diff on, we have state-fixed effects, we have time-fixed effects. In a sense, as a small comment, one could also think about having state-specific time trends, maybe also include some other observables that control for differences in the different states. But by and large, this gives us a causal effect coming from this exogenous shock. The second part is then also relating this in the sense of a triple diff in diff to have a look on the retailing sector versus all the other sectors and have a look on what is the output effect on revenues, establishments, small establishments, and so on. So what are the results indicating from this diff in diff analysis? It's basically we find a significant decrease in the amount credit extended by stores to their customers, significant increase in the number of firms in the clothing retail industry, and the firms that are entering that are relatively small. We also, the results also show that larger firms and not smaller firms are more likely to accept the cards, but also single establishments are more likely to accept the cards. And generally, these results hint to cost reductions. Now, having a look at the structural models, starting with a demand side model.
So using a discrete choice model, studying that the utility of a firm, buying at a firm, depends on the mean utility, depending on the price, on unobserved product characteristics, in this sense firm characteristics, and then whether the firm is offering the credit card. So this is a measure of the product differentiation here. And in a sense, if two firms are offering a credit card, there would be close substitutes in the sense of that you can go as a customer to both, because both accept the same credit card. If they're not offering this, both the same card, or another firm is offering only one card, no card, then basically they are less closely substitutable. And basically what you can do, this goes back to a result from Barry 1994, is basically you can rewrite, basically you can, because we assume the type 1 extreme value distribution, basically you can aggregate this distribution and get a market share equation. So basically the market share of product J over the market share of the outside good is a linear function. Here it's missing the price, here as well, sorry. And so, then basically what you get is this linear function of these different product characteristics. If you then assume on the supply side model of, for example, Bertrand competition, you can back out the marginal cost. And in this way, you can decompose prices, the changes in cost and the changes in markup. In a sense, and this is in a sense also for me a little bit the question here, how do you do this if you do not have any price data, but you have only sales data? And in a sense, I think here the paper could be a little bit more clearer how you can do this. Basically, what you find here in the counterfactual analysis, basically this is the baseline model. We have a particular cost index, markups, and price index. And basically in the treated area, what we see is lower prices, lower cost, and also a lower markup. And then in a sense, the counterfactual analysis checks in the sense, assuming first no cost changes, how markups and the price index changes. You reduce the cost and fix it here, and how does the price index and the markups change. Generally, I do not have that many comments. I think the paper is very well written. It's also liked it a lot reading it. I think it's a very nice contribution to the literature of technology adoption. As I already said, there's a huge effort that went into data collection, and I also think it's a nice combination of empirical analysis and theoretical analysis. I think, as I already said earlier, I think in some of the estimations, you could also include also state time trends, also additional variables. Maybe you could also think about testing the intensity of treatment, because in a sense it's a distance to the maximum interest rate. And as I said, in the structural model, for me it's not clear how to use sales and no price data, how to estimate structural demand and supply. And here I would be a little bit more clear what are the implicit assumptions that you are making. Also, what I think is, in a sense, what you should discuss a little bit more, in a sense, you use a static model of competition, but given, in a sense, there's also a dynamic aspect to the winner takes it all logic, it could be interesting also to consider a dynamic model that allows for gradual adoption of a new technology. Thanks a lot.
One question from the audience and then to combine,
Yeah, of course.
I think there is a question, yeah.
Thank you so much. That's just a great, great paper. I really enjoyed that. And this is kind of more on a wish list, but in reference to the previous paper, the question about the previous paper is there was no counterfactual of what would have been the alternative method of getting credit to people with low FICO scores. I was wondering if you might be able to tell, how did black consumers do back in the store credit day? How did low FICO consumers do back in the store credit day? I know that's extremely...
The answer is quite poorly. There's actually another paper and that I cite, but their names escape me. They specifically study the effect that this had on black consumers. And they find basically they gained an enormous amount of access to credit, so much so that it actually showed up in the aggregate rates of entrepreneurship of black Americans in the census. And my second point is that, prior to this and even coexisting with this, in very, very low information environments, we see a lot of very primitive forms of debt collection. My favorite example is from Rocky Balboa, where we see him walking the streets of Philadelphia, breaking the thumbs of people who don't pay their debts. And so for all of that we say about the negative effects of debt in society, I think it is really important to remember what is the primitive solution to this problem. And it looks a lot nastier than modern debt collection practices.
Thank you for this really great paper and talk. I wanted to focus in on something that you said at the beginning, which was that acknowledgement of the Visa debit card case. And I guess, forgive me if this is naive, but that's about debit cards. And I understand that there is credit provision inside the debit card world, but it's not quite the same as a credit card. And it seems that the results that you showed were principally about the shift from store credit to bank credit. Now, I wanted to ask you, in light of that observation about debit cards, can you point to research that, or have you looked at research that tries to quantify the sensitivity of profits to credit provision full stop and to the amount of credit provision that had been provided, and whether that can also be part of this story? Thank you.
Yeah, I think you're absolutely right. I would say there doesn't need, by first principles, to be any connection between how you choose to do your payments and how much you can borrow. It's the case in the United States that these two things go together very tightly. And for sort of reasoning of why that might be the case, I really enjoyed the reasoning of my classmate Lulu Wang on this, which is that sort of the Durbin Amendment capped these sort of Roche and Tirole type interchange dynamics that can take place in the debit card market, but not in the credit card market, leading more people to use credit cards than really would choose them in a fair market. So I would refer you to the work of Lulu Wang on that. It's a really nice paper that he has.
Okay, so if there are no more questions, well, thanks a lot, everybody. Really interesting, and let's give him a hand. So it's coffee break.
Dear colleagues, welcome back to the last session of today. We have two papers in this session. The first speaker will be Gudong Chen. Unfortunately, he was not able to travel, but we resolved this by technology, and Gudong will be with us online exceptionally because of these short-term obstacles to travel. And he will give the first paper in this session, Mobile Payment Platform Competition, Evidence from a Bank in China. Please, Gudong.
All right.
Thanks for joining us.
Yes, thank you very much. Very appreciate the conference organizer to give me the special commendation. Good afternoon, everybody. So this is actually a joint work with two of my colleagues, Yiqing and Christina, and also one of our former undergraduate student, Zixin Wang. He is now studying at Howard. This paper is about mobile payment platform competition. We basically use some data from a bank in China. Okay, so here are some basic motivating facts. So we can see there has been a very rapid expansion in terms of the mobile payments in China in recent years, especially after 2015. So this chart shows us the transaction value in trillion yuan. So you can see actually up to 2023, it's almost like 555 trillion RMB in terms of transaction values in just 1 year. And if you look at the number of mobile payment users, it actually also grew almost like 9-fold in past one decade. So this, in terms of the transaction frequencies, even though I have only data up to 2018, so if we start from the 13 to 18, we can also see a very rapid expansion in terms of transactions. Okay, so why we want to study this topic of a China case? So there are basically 2 reasons. First of all, Chinese market in terms of the mobile payment network is probably the largest and also one of the fastest growing market, expanded over 10-fold just in 5 years, and still keep growing even more afterwards. And also it actually substantially changed the Chinese commercial markets, especially like related to the e-commerce market, and we call it like the light cash era. And it's very important to understand 2 things. So first of all, how the consumer spending behavior will respond to this new technology change. I mean the mobile payment technology, and especially in the circumstance when we have different mobile payment platforms coexist. For example, in China, the 2 largest ones are WeChat Pay and Alipay. So in this paper, we are trying to mostly address these questions listed here. So first of all, does the introduction of the access to new mobile payment platform will change the consumers' payment patterns? For example, in terms of transaction frequencies, transaction values, and so on and so forth. If so, then which categories are mostly affected? Let's say whether it's our daily, related grocery shoppings, or large payment like durable goods consumptions with lower frequencies or whatsoever. And second question here is how does it affect the payment on other platforms? For example, if we introduce one new platform, payment platform, which will compete with other existing platforms, whether this will be a case of competition or a case of complementation. And also regarding the competition, there's not just about competition among different payment platforms, but also about mobile payments competing with other like method of payments, like non-mobile payments methods. So to address these questions, so we actually use a novel data set of all credit card transactions, about 81,000 customers from a large commercial bank in China. We have all live transaction records from July 2017 to June 2018. It covered about a year. And we are trying to explore an exogenous introduction of the mobile payment platform competition in January 2018. I will talk about more details on this event. And in this paper, we're trying to use a difference in difference kind of methodology combined with propensity score matching to achieve some causality argument. Especially, we will define a group of users as naive users and the other group as sophisticated users. Let me give you the definition in maybe 2 or 3 minutes. Okay. Just in case, if I don't have time to go over all the details, so here is a preview of the results. So first of all, we find the introduction of the one payment platform, which is WeChat Pay, actually has increased the naive users' monthly transaction frequency by 3.75 transactions. And with the increased value of spending by 7.55%, which is quite substantial. Okay, and we argue this convenience of mobile payment basically with the lower transaction cost will boost up the consumer's willingness to consume. And this effect actually is not homogeneous across different categories. It's mainly focused for the low value products like daily groceries, clothing, and household utensils, and so on and so forth. And regarding the platform competition, actually we find instead of a purely competition effect between this WeChat Pay and other mobile payment like Alipay and Apple Pay, actually this introduction of the WeChat payment will serve actually as more or less like a complement to other mobile payments. So in other words, actually it actually also helps other mobile payment platforms to increase their usage and transactions. On the other hand, comparing to the non-mobile payments, like offline payments like credit cards and other things, there actually was a substantial spillover effect. Okay, so mostly the mobile payment increase in mobile payments will spill over like other non-mobile payment transactions, and the overall benefit actually will outweigh the mobile payment platform competition even for other mobile payment platforms. Okay, relative to literature and our contributions, I think it mostly about three things. Given the time constraint, I will just quickly go over this. So firstly, it's about this new payment channel on the overall consumptions. So there are some papers discuss this topic under different contexts. And also regarding the platform competitions. So here, this mobile payment platform competition is kind of a new fact. But in the past, there are some similar contexts, for example, credit card competitions and other competitions as well regarding the payments. What do we find actually this complementarity is some novel finding. And lastly, it's also related to the adoption of new financial technology. So there are also some recent papers discussing about this. For example, about this cashless payment method on economic growth. This is Pernamdam and Dubey 2023. And there are also some other papers about technology, introduction of new technology on investment side as well. Okay. All right, so here's the data. So we basically have this data from a commercial bank in China. It has almost 6 million credit card transactions from 8,100,000 users in this 1 year. I have very detailed information about the method of payments, whether you use a credit card or pay via mobile payment platforms. And we also have very detailed information about spending categories, whether you spend this on clothing, buying coffee, and so on and so forth. And on top of that, we also have these bank users' demographic information. And also a nice feature is we also have the digital footprints when the bank users browse their account information via a bank webpage or this WeChat public account. Basically, we can see whether the users browse their credit card consumption, transaction records, whether they browse their balance information, so on and so forth, and how long they spend time on each website. And so all variables are constructed at a monthly level because the trading frequency, like transaction frequencies for each individual is not very high. So we mainly focus on the result by using the monthly level data. But for the robustness check, we also will show you some weekly data result, which is qualitatively similar. Okay, I'm also dealing with some outliers and some special payments by dropping them off from the sample. Okay, so here's summary statistics. Let me just show you some quick numbers. So here we can see the average transaction is about 5.1 transactions per month. And for this, we define so-called sophisticated users. It's very much more frequent than the naive users. Okay, so let me give you a quick definition of these two groups because this is very important in our paper. So here, basically, we define this sophisticated users as someone has been used mobile payment before. So basically, they already know the technology. And for the naive users, we define them as like never users before the WeChat Pay was introduced. So this group of users, basically, we can treat them as someone not quite familiar with the new technology or not really use the technology yet. Okay. All right. Let me skip some details, but overall, we can see comparing these sophisticated users and naive users. Basically, sophisticated users are younger people, and they are better educated, and they are richer. Okay, and we also will dealing with some potential selection issues by using propensity score matching later. Okay, so these are some transactions by different method of payment. So we can classify them as Alipay, Apple Pay, some offline payment like credit card payment directly, and website pay. For example, if you go to some website, they will ask you to type in your credit card information. Those are classified as website pay. And lastly is about this WeChat Pay. So we can see for this particular bank, actually their credit card can be linked to this WeChat Pay only starting from January 2018. So before that, their credit card cannot be used via WeChat Pay. Okay, so this is like the event we are mostly looking at. But if you look at the trend, so we can see basically both WeChat Pay and Alipay are actually went up, okay, in terms of transaction frequencies. If we look at the proportions, so we can see the offline payment, this marked in the red bar here, actually declined substantially. So this basically captures the spillover effect to the non-mobile payment. All right. A little bit institutional background about Chinese market. So actually mobile payments can be traced back to 2006. And in China, we have two major mobile payment platforms, Alipay and WeChat Pay. But they actually start their mobile payment business from kind of like a different ways. Alipay, for example, they actually is closely connected to Alibaba, Taobao, and other e-commerce platforms. So that's why it's kind of a natural way to build in this mobile platform to facilitate like e-commerce transactions on Taobao and Tmall and Alibaba. But WeChat Pay, on the other hand, is kind of different because it's built in from. Only have 5 more minutes. Okay, let me speed up a little bit. Building with a social interaction platform. So you might use like WhatsApp in outside of China. You can think of WeChat as a Chinese version of WhatsApp. So it's built in basically with like a social interaction platform. So for Alipay users, actually they might know mobile payment better because they might start online shopping and so on and so forth. But WeChat Pay users, for example, my mom, she doesn't really use WeChat Pay much or other mobile payment much until they start to sending and receiving like a red packet, like some monies from the chat groups. Okay, so here are some hypotheses. So basically, hypothesis 1 is the access to this WeChat Pay will increase the naive user like my mom. Their mobile consumption, right? Relatively other sophisticated users like myself, for example. Okay, and secondly, increase mostly come from the non-durable goods consumptions, like because of the convenience, we can spend more money for our daily lives. And lastly, there will be actually a substitute to the non-mobile payments. Okay. So this is very standard DID setting. So let me just show you some result. Before moving on. just one thing on this naive versus sophisticated users. So from the summary statistics, we can see by nature, they are not quite comparable. So this is why before using the DID settings, so we also conduct the propensity score matching to make them to be more comparable. So you can see the matching quality actually reasonably well. And the pre-trained test basically passed the test. And let me show you just the main result by looking at the match sample maybe from the bottom. So we can see in terms of trading frequency and transaction values, both are actually increased substantially after this introduction of WeChat payment. And if we look at 3 different channels, like the PC channel existing mobile payment, like Alipay and Apple Pay, versus offline payment like credit card, if we look at the shares, we can see even the increase in the mobile payment also help the share of the existing mobile payment by about 5% in terms of frequency and 3% in terms of transaction values. But there will be a spillover effect on both the PC channel and the credit cards. Okay, these non-mobile payments declined substantially, and the results are pretty robust. If we look at by the types, so most of the results are on the grocery shoppings and dinings and service and so on and so forth. If we look at the transaction values, so we can see the largest decline or spillover actually comes from the smaller amount, okay, from 0 to 300 RMB. This gets the largest amount. So overall, you can see there are more or less some spillovers, okay, but for the larger transaction values, so the spillover effect is smaller. Okay, if we look at the dynamics, so think about the introduction of WeChat Pay from January 2018. So this result actually shows us a cumulative effect over time. So if we look at the existing mobile payment here, for example, panel B in terms of shares, they're boosting up the existing mobile payment, like other mobile payment platforms shares over time, and also in terms of spillover on credit card transactions, the spillover actually getting more and more over time as well. Okay, so let me skip this page. Robustness, use different matching algorithm, result is still there. If we, instead of monthly data, using weekly data, the results are also qualitatively similar. Okay, so admittedly, our data has some limitations. So 3 limitations mostly. One is about internal validity versus external validity. Because our sample actually from a foreign commercial bank, so comparing to overall sample, they are richer and younger. So may not speak up to the general population. And secondly, we only have like 1 bank data. So it may not fully capture, the overall portfolio or household consumptions of each user if they have different bank account, for example. But there is a trade-off between the completeness and details. So our merit of the data is we have all the detailed transactions. And lastly is about this limited time span. So we only have like 1 year data here. But hopefully, we are still talking to this bank. Hopefully we can get more data and have a longer time coverage in the future. Okay. So that's all for my result. To wrap up, so basically we find this WeChat Pay introduction actually will increase both the frequency and the transaction values. And the platform competition, we will treat it more as a complementary to the other mobile platforms and the spillover effect on the non-mobile payment. All right, thank you very much.
Thank you, Guodeng. The discussant will be Elena from the board. Elena, please, you have 7 minutes.
Thank you very much. All right, and Well, first of all, thank you very much to the organizers for organizing such a wonderful conference in such a gorgeous location. It's so great to see friendly faces again and new friends that I'm sure will be friendly next time. I'm from the Federal Reserve Board, and as always, everything that I say does not represent the view of the Board of Governors or the system as a whole. So I'll start by saying this paper is very, very cool, and one of the probably, the main reason is there's this general growth in more innovative payment methods, such as mobile payment transactions. They're growing a lot, and we actually should understand a little bit how consumers make choices of payments with these new players in the system as they enter, and consider both the competition not just with the existing payment methods, but also between them. And so in general, it's also interesting because looking at any studies that are able to use transaction-level data really allows us to understand how the adoption of any new payment system really impacts the ecosystem. And what I mean by that, and I'll go back to that in the end, is that we can, and maybe that's my point of view from the Fed, is also looking at the fact of who are we leaving behind. And every time that we have a new payment method, we can think about, are we leaving more people behind because we're not considering those that cannot adopt this new payment method, or are we actually able to increase the equality of payment adoption? And I think that this is a particularly interesting adoption for that case, and I'll go back to that at the end. And then from the perspective, again, of being an IO economist, I'm thinking about the fact that mobile payments specifically are particularly interesting because it's not just an extra payment method, but in particular here because we're also talking about a payment method that gets put on top of essentially a chat system. It almost creates a one-stop shopping for payments. So suddenly you're sending chats, and at the same time you can also do your banking. It's almost like a one app do it all kind of thing. And so it's almost kind of this interesting perspective of saying, conditional on you already using one of these apps, you might suddenly actually adopt a whole other range of services simply because you're now able to, there's no cost to you to now yet add another app, another account, etc. So the first thing when I was reading about this is that I would like to have a bit more information, and this is entirely out of my own ignorance about the players in this market. So in particular, the author does a very good job just generally talking about how the main two players, WeChat and Alipay, are very, very important. But just thinking about the overall industry, how big are these apps? And in particular, how big is WeChat in terms of an already adopted chat system by the population in such a way that as soon as they actually include a new service, they will be almost automatically adopted by a larger share. And so what I mean by that is, could they potentially just quickly take over the market? And now I know that the author here just looks at one specifically bank account that adopts it when WeChat Pay already existed. But the idea here is how fast can WeChat Pay simply grow, and how fast, therefore, can, for example, for this particular bank, can it become almost the standard payment method, quote unquote, for those cards. So going back to this idea that I talked about at the beginning, again, there's nothing really particularly new. I think the author did a fantastic job thinking about, for example, these naive and sophisticated users. But we can think about relating this to concepts that we regularly talk about, right? And one of them, again, is the one-stop shopping, a concept that I was thinking about at the beginning. With this concept in mind, we can say, well, maybe I simply already prefer using a system, a method, whatever it is, within something that I already use. And so again, it would be almost interesting to really define this usage and these transactions from the perspective of, can we assign this value? And here I'm thinking, well, maybe the sophisticated consumers that were already using Alipay, they already wanted to use mobile payment methods, right? They were already adopting something else, but now they can do it all at once. They're already WeChat users, and now they don't have to go and switch up between one thing and the other. They can do all their chatting and payment all within one single thing, and maybe now they move over and all the transaction happens within WeChat Pay. So this would be particularly interesting, again, if you're able to focus on these Alipay users, that suddenly you see that they adopt WeChat Pay a lot more. And the other side is really what the author already does it from the perspective of convenience, which is instead, you can have that simply, you don't have a particular preference for mobile payment methods, but conditional on that happening within a service that you already use, you simply value that one-stop shopping. And so maybe what the author currently calls naive consumers that simply adopt it out of convenience, it might simply be this switching cost that doesn't exist the second that you have an app that provides the service for you. In other words, you actually don't care about what payment method really, you are indifferent to the mobile payment method, but conditional on it being given to you at a zero switching cost, you're going to adopt it. All right. So then the data. So my point on the data is that, well, the data set is great, right? You're following every transaction. But I already know, because I wasn't clear, but the author was already talking about it at the end of the transactions, they don't observe, unfortunately, other type of transactions, such as the fact of whatever cash transactions they could be doing. But one thing that I thought about is that, of course, this is specifically to one specific card and for one particular bank. Excuse me. And so what happens here is that it could be that some of these users were in fact not naive. They were already using WeChat Pay. They already liked WeChat Pay. Maybe they already liked the whole one-stop shopping thing, but they were just using other cards, right? And I'm thinking about the fact that, you know, I have multiple credit cards in the US. If you look at my Visa, you think I only shop at Whole Foods and in Europe, because that's the only time I use my Visa. Every other time, I use my American Express. So what might happen here is that actually some of these naive consumers are actually quite sophisticated. And so here, just having, the paper would be highly improved just by having extra statistics on cards and banks per person, for example, just sort of giving some extra evidence that what the author is finding is in fact what they're finding. And now two more sort of general comments. One of them is, I wonder how much this relates in general to super apps in China, something that I know very little about relative to what I would like to know. And it's just the fact that I've seen research on the fact that once you have super apps in China, they are very good at, for example, offering small credits to consumers and whatnot. And so I was thinking about what happens if within this one-stop shopping platform, you're already chatting, now suddenly maybe you're offered also the option to buy now, pay later, you're offered the small credits. Now suddenly your increasing consumption might not literally just be out of your card is now on WeChat Pay, it might be related to these multiple services being offered at the same time. So maybe just a discussion on it would be nice. And then finally, going back to the point of inequality, I always find it interesting to actually think a little bit about who we're leaving behind when we talk about innovation in general in payments. I'm thinking here about how in many countries there's a very, very large digital divide. Think about rural areas. Even in very, very developed countries, in the United States, rural areas have a very large digital divide relative to very urban areas. It affects many different fields. Banking is just one of them. You also have telehealth as another big issue. So I mean, you could really talk about this forever. But the point to it is really that a lot of the times when we think about innovations, we think about including, sorry, I'm at negative 1 minute. But we think about maybe improving sort of the situation, but we actually lead to a short-term worsening of the effect. And so one thing that I think would be really cool here is that because it's within a chess system, this might actually be one of those cases where this may be an equalizer. This is actually something that everybody uses. And that because everybody uses it, we actually have an innovation that does not leave anybody behind. Very, very interesting paper. I'm going to leave before Martin kills me. And that's it. Thank you.
No worries. Thank you, Eleanor. Great discussion. We have now time for a general discussion. Who wants to come in?
Hello, Paul Pichler from the University of Vienna. So I was wondering whether so I'm a macroeconomist, and I was wondering whether you're worried about some macroeconomic effects that might be going on in this time period that you're studying. So one of your main results, for example, is that people start spending more on a particular set of goods. Are you taking care of potential macroeconomic reasons why in this time period or around this time spending went up?
Yeah, thanks for the excellent question. Actually, so in the current setting, one thing is we actually control the time fixed effect, like a monthly fixed effect. I think that can capture a lot of like macro indicators. And secondly, I think we can probably adding some macro indicators or variables into our controls directly. We didn't do that yet, but yes, I agree. We should add these variables to see the relevance of some macro indicators. Thank you. And also, Thank you very much for the enormous great discussion. Maybe I just address one point here before moving on to other open questions. Regarding the multi-mobile payment platform users, like say someone already used WeChat Pay before this introduction in this particular bank, I totally agree. Those actually are also classified as our sophisticated investors. Very likely to be classified as sophisticated investors because, users. Because in China, actually, it's very hard for someone use mobile payment platform only focus on one single platform. So the reason is, in different contexts, for example, some merchant only accept Alipay and some others may only accept WeChat Pay. So as long as you start using mobile payment, probably you need to install like both apps on your cell phone and start to use them in different contexts. And so then that's why we define sophisticated users as someone whoever used mobile payment like Alipay or Apple Pay before January 2018. That's the introduction of WeChat Pay to this particular bank. So for those kind of users, if they already used Alipay or Apple Pay before, it's very likely if they use WeChat Pay, they already know WeChat Pay before. So these are like our sophisticated investors. So we actually mostly look at the naive investors' behavior comparing to this.
Okay, let's take
all other points are well taken. Thank you.
Let's take the next question from the floor. Franz, you were...
Yeah, my question is related to what Paul already asked, but is more micro-based. You emphasize these heterogeneous effects between the naive and the sophisticated, but also between different kinds of spendings. And one of your general results was that people buy more these low price goods. Usually these low price goods are low quality goods. Can you say anything about do these people then spend more on low quality goods? And I remember a paper which was presented at a former central bank conference with a title, I don't remember exactly, but it was in the vein, use more cash to buy less trash.
Yeah, thanks for the question. Very, very, very good question. So here, unfortunately, we cannot really capture the quality of their spendings on particular products. Let's say we know the categories, but we cannot see whether it's a high quality or low quality. However, we can classify, their spendings in different categories. For example, grocery shopping, or if you buy furniture like durable goods and so on and so forth. But what we really observe this increase in the mobile payment is mostly on your daily spendings. This is like a small amount but higher frequencies. Yes.
Okay, thank you very much. Well, then let us thank the speaker and the discussion before we move on to the next paper.
Thank you.
The next paper is going to be presented by Hiroshi, Cash Demand and Cash Usage Evidence from Japan. Please. 20 minutes.
Okay. Good evening, everybody. Thank you for having me here at this wonderful conference again. And I have to especially thank Fumiko giving me some kind comments before I present that she found some errors here. So I can do whatever I can do. So my talk today is about this guy, cash reserves in Japan, okay? The background of my talk is Japan's cash puzzle. You see, Japan's cashless payment ratio, which is a share of GDP consumer spending paid by credit card, electric money, card payments, and debit card, is increasing about 20% in 2017, and now currently it's about 40%. So Japanese cashless payment is expanding. However, as you know well, cash divided by nominal GDP in Japan is still 22.5% in 2020, which is quite high in terms of any standard in the advanced economies. And against what derives this result is, my estimates suggest about half of the Japanese currencies for the sake of holding, about 60 trillion yen. And what does this mean? If you take a look at the flow of funds statistics by the household financial assets as of March of 2024, it is well known that Japanese have a lot of bank deposit. Half of the financial asset is bank deposit, but the C currency also explains about 5% of the Japanese asset holdings. In Europe, it's 3%. So Japanese tend to have less equity, have a lot of deposit, but remember, they do have also a lot of currencies. That's what this cash holding explains. And against this background, there are two policies to reduce Japanese cash use. The one is cashless payment promotion policy to reduce cash usage for a transaction in a point of sale. And the well-known one is a point reward project for consumer using cashless payment from October 2019 to June 22. If you pay by credit card, you get discount of 2% or 5% for the government. And also there are another project going on. And that's well known in Japan. There's another project. It's called Doubling Asset-Based Income Plan from October 2012, initiated by Kishida administration. He is going to resign maybe. And that promotes investing in high-risk financial assets to reduce cash demand for store value. Remember, as I said, Japanese have a lot of safe assets. So government wanted to bring those money to here. So Financial Service Authority plans to double the number of Nippon individual saving accounts. This is a special investment account that have favorable treatment for taxes for investment. And they try to invest in high-risk financial assets to reduce cash demand for store value by they wanted to make this number of accounts double in 5 years through tax incentive for investment in riskier financial assets. And also, surprisingly, there is an institution called Japan Financial Literacy and Education Corporation. This was established this year. This has got mandate, plan to double the number of times financial education is provided, and participants to increase the level of financial literacy. That's what government tried to induce people's money to investment trust. The question here is two policies are independently implemented in Japan, cashless payment promotion policy and also doubling asset income plan policy. And the second policy will focus on financial education to increase the level of financial literacy in Japan. So from policy 2 to policy 1, higher financial literacy may correlate with adoption of the cashless payment and lower transaction cash demand. And also from the first cashless payment policy to the doubling asset income plan, cashless payment promotion may relate to a lower cash ratio to total financial asset holding. But the question here is, how those policies are related, and also how this financial education plan works. Do financially literate people have lower cash ratio? That's a question that wasn't discussed well in Japan. And why this question is important is if you look at the survey paper of Oesterreichische in the JAL, he says that what should government policy be if cash is hardly used as a payment method, but is heavily used as a store value or holding purpose. Actually, doubling asset-based income plan seems to be a case study for a policy to reducing cash holding in Japan. And to answer this question, we need data because nobody tried to see cash holding or transaction cash in Japan. So I prepared a data set as of July of 2021 using a survey of panel of consumers, and they took a look at the data on the cash demand for day-to-day transaction. I call this COH, cash on hand, and also cash demand for holding, CAH, cash at home, and also have a financial literacy question, high, middle, low. It was based on a big 3 financial literacy question, compound interest rate, inflation, real value of cash, and also diversification of stocks. No, please do not confuse. This is for investment in risky asset, not for financial sophistication. You guys are talking about payment. And also, I checked the amount of financial asset holding, excluding cash. Let me call this one as FA. And why don't we compute the ratio of cash on hand against the financial asset plus cash on hand, and also cash at home ratio, cash at home divided by FA plus cash at home. So we wanted to see how this cash ratio works to see, whether financial literacy will lead to lower cash ratio. And to do this, we need data on the financial asset holdings and cash on hand. We have luckily 2157 people respond to this question together. And I just collect the data by range, 0 financial assets, 0 to 2.5 million, 2.5 to 5 million, and something like this. This is a very wealthy people, more than 220 million. You see, the red figure is a sale percentage over 10%. So the income distribution of financial assets is, there are fat tail to the left, and also there are some wealthy people. For the distribution of cash on hand, below 1,000 yen, 1,000 to 5,000, 5,000 to 10,000, 10,000 to 50,000, over 50,000. And the majority of the people have between 1,000 to 50,000. But there are some people, just 3%, having a lot of cash in your wallet. And by the way, here I said 1,000 yen, Japanese, 1,000 yen is about 6.3 euro, or $7 US, okay? And regarding the cash at home, so storage, I also ask beyond 10,000, 10 to 50, 50 to 100, 100 to 200, 200 to 300, 300 to 500, 500 to 10,000, and over million. Most of the people are reasonably having very low end here. Most of the people are actually locating here. Cash at home beyond between 10,000 to 50,000. But there are several people, 3% have a lot of cash, and what these guys are doing. And if you cross-tabulate financial asset holdings and cash on hand, you see this purple one is the most influential cell, which has a lot of observations. And the red one is very few observations, which wouldn't be so influential. Naturally, zero asset, financial asset, and having moderate cash, and also relatively small financial assets, and relatively small cash holding is a dominant player. But see, for the people having between 10K, between 50K, you see very wealthy people also have a lot of cash. But the problem here is how can I compute cash ratio from here? I only know by ranges, right? So we cannot divide this number for this one. So what I can do, but it is possible to compute the upper bound and lower bound of each combination. For example, if take FA 0 to 2.5 million and between COH 1 to K, the minimum lower bound has to be take 1 as a smallest value and take 25,000 as a denominator plus 1. The maximum is easily computed by 5 divided 5 plus 0. But you still have the 100% people because this is by definition because they have no financial asset other than cash. But so it's inevitable. But see the other part, for the influential cells, you see the lower bound, upper bound is very wide, so that those three bounds have a huge overlap. So it's very difficult to differentiate. So hopefully we can do some quantile regression, but because there are so many overlap, it seems a bit difficult to run standard quantile regressions. So if you do the same exercise for a cash at home, you see some clusters of observation in the northeast part of the distribution. And if you compute the lower bound, upper bound, the situation is the same. You again have the huge overlaps. So how can I deal with the overlap? I propose two ways. The one way is, I said for the sake of COH mean B, why don't we take the mean of the upper bound and lower bound and compute the ratio? So if you do that, the mean of the upper bound and lower bound will give you some different number for the overlapped ranges. This is the most influential one. We have no way to deal with 100% people, but for the other people, we see reasonably different number, and we can make a ranking for the cash ratio for those people. And the other way is why don't we use the median of those ranges? For example, between 1K and 5K, you can use 3, and between 0 to 2,500, you can use 1250 as a mean. You might think I'm cheating for here. I use some consumer surveys, very wealthy households, financial data, financial asset data for the wealthy one. So I approximate this one from that other survey. And if you do that exercise, please see this one. If you classify green wines low financial literacy, red wines middle financial literacy, and blue wines high financial literacy, you see green one has a spike here, and there are several spikes here, and blue one has a spikes to the left-hand side. So you naturally see there seems some negative correlation between cash ratio and financial literacy level. The same is true for if you use a median of each ranges, so the data doesn't change so much. And the same is true for the amount of cash held at home. You see some approximation of the distribution will give you the similar result, as you can see from here. Again, you see, low literacy people have 100% a lot observation, and the high literacy people tend to have lower end. So again, if you use cash at home, you have negative correlation between cash ratio and financial literacy. And so far, we only see a correlation by plot. So why don't we have conditional correlation between cash ratio and financial literacy by running a regression? I can run OLS regression for IJ can be cash ratio, and X is a conditional variable, area of residence, age, gender, occupation, educational attainment, annual household income, and also financial literacy levels. And delta has to be the parameter to be estimated. Remember, for cash on hand and cash at home by level, you know the interval, so you can use the standard interval regression. But cash ratio, you do OLS. And if you run this regression on a cash ratio, you see the literacy high level and the middle level dummy variable is a negative and statistically significant. So high literacy people tend to have about 20% point lower cash ratio compared with low literacy people. And the middle literacy people also have about 13 to 16 point lower level of cash ratio. Cash ratio is low for the people who have high income and for the people who have high educational backgrounds. And if you plot the point estimates by the regression, you see high literacy people's estimates tend to be located to the lower end of the distribution, and the low literacy people's predicted value of cash ratio tend to have a higher levels of estimates. So we can say cash ratio seems to be lower for financially literate people. This is true for both cash on hand and cash at home. And if you run regression for using cash on hand level and cash at home level, the result completely changed. For the cash on hand, high literacy people tend to have more cash, contrary to the cash ratio. And for the cash at home, we don't have a statistically significant result. And if you plot the point estimates by the regression, you see high literacy people tend to be located to the higher end regarding the predicted cash on hand. And regarding the cash at home, as I said, there is no statistically significant result. Actually, middle people seems to be located to the most higher end, and the high literacy people seems to be located more to the right of the low literacy people, but we don't have a clear, because we don't have a statistically insignificant parameter estimate, so we don't know what's going on. And finally, does the cashless promotion policy have something to do with the cash ratio? I tried to figure out several results, but what I found is that this survey has a question about the intention of the use of cashless payment at the stores that accept cashless payment. And the people called cash user is I would make payment by cash anyway. And the cashless user is I'm stop payment by cash now. And the future cashless users says that I may be stop paying by cash in the future. So if you compare those people's estimates, point estimates of cash on hand, cash ratio, cash user seems to have a higher cash ratio. So what is the contribution of my study is, this study's unique point is that you have cash on hand and cash at home, and financial literacy and financial holding all together, while most of the Japanese studies beforehand either have those information combined or no information at all. And the financial literacy survey only have financial literacy data, but no idea about cash, and so forth. So this is a very unique study, at least in the Japanese context, and I don't have time to talk about the foreign studies, so if time permits, I'll come back. And there are a bunch of future work lists. And, we need some theoretical model to understand what's going on. We don't have any structure model, so it's not possible to interpret this, mechanical way. And it seems to me better to ask cash ratio directly rather than approximate in this paper. So if I done another survey, I hope to ask cash ratio directly. And hopefully, it will be nice if I can establish guideline for financial literacy improvement by the government to reduce Japan's cash ratio. Maybe, for example, I don't know if this is the right number or not, but the European level is 3% or something like that. And also, in the finance, people often talks about risky versus non-risky assets, and the large bulk of the safe assets in Japan is actually bank deposit. So we hope to incorporate this effect as well. So let me wrap up. Higher financial literacy seems to be related to lower cash ratio for both cash on hand and cash at home. So increasing financial literacy seems to be a promising way to reduce Japan's cash ratio. But I don't claim any causality because it's just a correlation. And what is puzzling is the higher financial literacy in terms of investment, investment in risky assets doesn't seem to be related to less cash demand. Rather, it's more cash on hand demand. So we need more theory to explain what's going on. And regarding the cashless promotion policy, it seems to be that being cashless now or in the future seems to relate to lower cash ratio. That maybe eventually, if you don't use cash every day, you are likely to not accumulate cash together. And in the previous study, someone talks about super apps, and Japanese super apps also encourage people to invest more to the, investment trust or something like that. So in that way, cashless payment may be reducing cash holding for the sake of investment as well. That seems to be the next things that I have to do. Okay, thank you.
Thank you very much, Hiroshi. The discussant is Fumiko.
Is my slide coming? Well, thanks for the opportunity to discuss this paper by Hiroshi. Very interesting and very policy relevant. As you know, Japan is cash-heavy economy, and government tried to shift from cash to digital, and cash as a transaction purpose as well as store value purpose. They want to shift from cash to something more digital or risky high-yield financial assets. So Hiroshi did a really nice job to summarize, these two independent policy and then each policy's actions and how these two policy and actions interplay. And his main question is, does increasing financial literacy help achieve these two policy goals? So, I just quickly summarize the paper contribution before I go to my comments. But mainly, he examined whether financial literacy is negatively correlated with two cash ratios: cash on hand ratio, cash at home ratio, as well as whether it's negatively correlated with two cash levels, so COH level itself and the CAH level. And to me, the contribution of this paper is he really, to answer this question, he conducted surveys through the private company. So he asked questions about cash holding for transactional and store of value purpose separately. And in the same surveys, he asked 3 standardized financial literacy questions. So I think that's really, the contribution of this study. The main result is negative correlation between financial literacy and the two cash ratios. These are really strong when using all respondents. And revised paper he didn't include, but original paper he had something like, okay, so now let's just look at the respondents who own risky assets. And then suddenly most of this negative correlation disappeared. So something going on there. And the cash on hand level is strongly positively correlated with financial literacy, but cash at hand level is not. So again, the first result and the second result, we think like, oh, what's going on? So, so that's the main one of my comments. So my comment, 3 major areas. I don't know if I have time to go through all, and as well as minor comments. So let's start with CAH ratio. So here's the actual distribution. He also showed the chart, but I divided in the ratio from 0 to 1, 1 to 10, and so on to 100. So you can see the distribution is, really skewed, right? So, many people are less than 1, and some people are 100. So, and then divided based on the financial asset size. So, if people do not have financial asset, the cash COH ratio is 100. And then, if people have some or moderate amount of financial asset, then they are more likely less than 1. So so this is, nutshell. So how these ratio heavily related the financial asset size. But predictive distribution, maybe this is based on the previous version, but have nice this shape for even if high financial level and middle and low, but it's not really the actual ratio. So I have hard time to think about actual versus predicted COH ratio, the same way CAH ratio. So, so the ratio significantly affected, and among consumers who hold financial asset, the two ratios are extremely small range. So is it really useful to think about the effect of government actions? So potential alternative measure may be more like the ratio, the COH divided by monthly or weekly spending. That will give you more good range and maybe nice distribution rather than this too skewed distribution. Otherwise, I think when you analyze or interpret the result, the level itself might be better, better measure, or at least COH ratio is estimated using a sample of consumers with financial asset, positive financial asset. So that's one of my comments. Still have time? Okay, okay. Another comment is financial literacy variables. So 3 questions. So you you did something, 3 category dummies by using the correct answer, incorrect answer, don't know answer. So the don't know answer is not necessarily, so you created score and don't count don't know. So what he did is correct answer minus incorrect answer, and then exclude don't know answer, and then categorize by high, middle, and low. But is it really, did you get something from there? Reading it is, I need to write down this table, and if this doesn't get, improve your estimation, maybe, referee will give you some comments. So alternatively, using score itself can capture more, financial literacy variables. And also alternatively, you can just use each questions, correct answer for each of the questions, and identify which questions affect more, answering which question correctly affects more on the cash holding levels or ratio. And then policy implication. So the paper mailing analyzed the interplay from policy 2 to policy 1, right? So how the financial literacy affects the cash holding levels. And the result is, obviously negative relationship between the cash on hand level and financial literacy, but the result shows just correlation, not causality. So how we should think about. So, the high financial literacy people may have high income. That's why they have, use more cash. If that's the case, even if you increase the literacy, it probably doesn't change much. the paper also analyzed the interplay between the policy 1 to policy 2, but there I don't see any, for that analysis, financial literacy doesn't affect anything, right? So reading the paper, I was at loss. So maybe this is an appendix type of thing. Yeah, and then also how to interpret the result is extremely hard. So anyway, and then I will go to some minor comment. Cash on hand, cash at home. So 2 questions. How much cash do you usually carry with you? And cash at home is how much cash do you keep at home for savings and emerging spending? But maybe another reasons for keeping cash at home for planned transaction in the near future. So I go back to Japan at least once a year, and every time I go there, I need to carry cash. Even though I use a card at the store, each store has different prepaid card. And my mom gave me prepaid card. Here, you can use it. I don't know how much prepaid card has value, so I need to carry cash. So that way, Japanese people keep cash at home in case, prepaid card, the amount is really low. So maybe you can ask, total amount cash holding, and then you can divide into 3 buckets or something like that. And this is really minor point, so I can skip. The last point, I was a bit surprised by the low cash at home level. So 10K to 100K yen is, most people are in that range, I think. But the aggregate level is such a huge, 5% of the, one of the chart you show is macro level, it's much higher. I don't think this can count, aggregate to that level. So there may be some external validation if this survey really captures the cash at home. And okay, yeah. So other comments I can send them to you. Thank you.
Thank you.
Thank you, Fumiko. Let's have a round of questions, comments in the back.
Maria Elena, Philippine from Uppsala University. Very interesting paper. So you mentioned that there are 3 levels of financial literacy, so low, medium, and high. But if you use the big 3 questions, there should be 4. So there should be 0 if you answer all questions wrongly, 1, 2, and 3. So the 0 group, so the let's call financial illiterate group. How do you handle this?
Below 0, 1 or 2, 3 is grouping. High literacy people has 3 points. Middle has 1 or 2. And the below low literacy group has 0 or 0 between -3. Because if you make wrong answer, I assign them -1. So the maximum number should be 3, but the lowest number is -3. And I don't count, don't answer as 0, okay? It's Hayashi-san's comment is also related. This is a method of computing financial literacy level used by Bank of Canada's method of payment survey. And I try to make it consistent with their estimates. That's the reason I use this particular measure. And This measure and the usual big three question score has a correlation about 0.8 or 0.9, so it's quite similar.
Okay, thank you. There's a question there.
Adam Głogowski, National Bank of Poland. Just couple of comments. First, looking at the model, I was wondering to what extent, for example, financial literacy, income, and education are correlated, and whether that might be a potential problem from the econometric point of view. And second, I would just support the comment that this measure of financial literacy, it focuses very much on the knowledge that you would need for portfolio allocation investment decision. It's very, I would say it's suited for the cash at home or cash hoarding, but doesn't really apply to how you transact. Thank you.
Thank you very much. Of course, it is true that the financial literacy is also related with education and gender and income. That's correct. And the Hayek-san says that for the sake of making policy recommendations, this indigeneity has to be addressed, and we need some instrument available. And the usual financial literacy literature try to take the scores of math when he is senior high school before making investments or something like that. So the next survey, I would like to have experience of getting education, financial education in undergrad or something like that would be an appropriate way. And actually, what you are saying is correct. This financial literacy score is particularly intended for making a portfolio choice, not for a payment choice. And I'm getting more and more convinced that for the sake of payment, we need different measure, because the key driver of Japanese cashless payment is, as you see, QR code payment, which is used by everybody, even students. So they don't make investment, so they should have some other measures. So I fully agree with you. So it must be misleading to talk this literacy seems to be directly related to adoption of payment methods.
Thank you very much for this work. Wanted to ask you about the motivations that the two Japanese government entities had for promoting changes to cash. One of them to discourage hoarding, and then the METI one, which was about cashless payments. Now, I wanted to ask whether your survey can shine some light on where there might be a potential tussle between the interests of Japanese citizens to make payments using cash and the objectives of METI with respect to encouraging them, especially in light of these observations about differences with financial literacy. Thanks.
I have nothing to say about that, but can I get my slide back here? About the, METI's policy has a substantial impact on Japanese consumer choice. It seems to reduce the use of cash and increase the use of electric money and also QR code payment. I have another paper to address that. And regarding there are some there is some literature. I have some companion paper, and this was Japanese cash ratio measured by the frequency of transaction. It's more than 50%. And the Japanese government, this is a point reward project for the METI, it reduces the cash ratio quite substantially. There is some COVID-19, but my counterfactual suggests PRP effect seems to be at least 0.6%. So you are right. And also, please be aware that the Kishida administration's policy, when I say that the Japanese government have two policies, as it's related to Hayashi-san's comment that as I said before, most of the safe assets are in deposit, and as Hayashi-san said correctly, the cash held was not so big compared with this one. And the Kishida administration target was about, why don't we have more investment here, either equity or investment trust. It doesn't say anything about cash. But it naturally means you have to reduce cash flow as well. So that's a little bit of my exaggeration, maybe. So government people never thought about they have to also attack to the cash holding. So that seems to be also related to your second comment.
Thank you very much. I had more questions, but please allow me, in the interest of time and to keep time discipline, to close the session here nevertheless. You might have an opportunity to bilaterally raise these questions. And let me first thank again Hiroshi and the discussant.
Thank you.
Thank you.